Hello students, how are you all? I hope you are doing well. In the CA Foundation Accounting Marathon Part 1, already we have uploaded. Part 1 covers these 7 chapters plus final accounts of manufacturing entities and non-manufacturing entity. Total chapter is preparation of final accounts of sole proprietors. Here it consists of non-manufacturing entity and manufacturing entity. Now, in this video, in this part 2 video, we are going to cover financial statements of not-for-profit organizations and accounts from incomplete records. At the same time, partnership and LLP accounts, whole partnership and LLP accounts. Now, our CA Foundation accounting is going to be 3 parts. Marathon is going to be 3 parts. Part 1 already uploaded. This is part 2 and part 3 consists of whole company accounts. There is one exclusive part for company accounts. Is it clear, students? Yes. So what is the importance of these partnership accounts and other chapters? See, partnership accounts alone covers 22 to 25 marks in the previous examination. This is very, very important. That too, this chapter has 6 individual chapters. Look at this unit, category C, partnership and LLP accounts consist of 6 individual units. So we need to cover a lot of things. And this sixth part is introduced in the new syllabus. In the old syllabus, there is no concept of dissolution of partnership firm and LLP, but they have introduced newly. Observe here I have given past 4 attempts. On average, he is asking for 22 marks from partnership accounts. Minimum 2 questions they ask. 2 questions, descriptive question, and maybe 1 or 2 true or false statements. Altogether 22 to 25 marks. So if you watch this marathon thoroughly, you can cover approximately 30 to 35 marks. How, sir? 22 marks are from partnership accounts and the remaining marks are from financial statements of not-for-profit organization and accounts from incomplete records. If you observe from these 3 chapters, they are giving on average 25 marks. On average, they are giving. Observe carefully. Compulsorily you get a question from financial statements of not-for-profit organization and accounts from incomplete records. Compulsory questions. They may be range from 5 to 10 marks from both chapters. Accounts from incomplete records, sometimes they may ask for 5 marks or sometimes they may ask for 10 to 12 marks. And financial statements of not-for-profit organizations, they will ask for 10 marks. Sure, for sure. 10 marks for sure. Is it clear, students? So make use of this part 2 marathon thoroughly. Don't skip even single minute. Why, sir? Here we have covered most maximum possible concepts and with some problems also. Is it clear, students? Yes. Now we start our marathon with accounts from incomplete records. Then after financial statements of not-for-profit organization. Then after partnership accounts one by one. Is it clear, students? So let's enter into the video. For a discussion with the accounts from incomplete records. Then after NPO, not for profit organization. Right. So accounts from incomplete records, if you observe, based on the 3 attempts, sometimes they are giving a question on accounts from incomplete records for 5 marks and sometimes they are giving for 8 marks or 10 marks. So anyway, we get 3 problems from all these 3 chapters, but we don't know for how many marks we get. But damn sure NPO we get for 10 marks. So here ICAI is giving choice, not choice. Sometimes they are giving 10 to 12 marks problem from final accounts and sometimes they are giving a problem on incomplete. Is it clear? Right. Now we start our discussion with the types of problems we get in incomplete records. Types of problems which we get in incomplete records. This is incomplete records. What are the various types of problems we get from incomplete records? Observe carefully. Okay. Generally, we get 2 types of problems from incomplete records. One is preparation of statement of affairs and calculation of profit. And second one is Conversion method. Conversion method, what we do, we complete the incomplete information into complete information. From there we prepare financial statements, trading account, profit and loss account, and balance sheet. Sir, which type of problem we get in the exam, sir? We cannot say that. Sometimes they may ask statement of affairs method, sometimes they may ask conversion method. Hope you are following. Yes, sir. What is the difference between final accounts of sole proprietorship and accounts from incomplete records? Final accounts of sole proprietorship, they give you trial balance. They are giving trial balance means they have followed accounting cycle. What is our accounting cycle? First we identify the transaction, then after we record the transaction in journal, then after posting, totaling, casting. From there we prepare trial balance. From trial balance we prepare financial statements, trading account, profit and loss account, and balance sheet. Unless you have trial balance, how can we prepare financial statements? It is not possible. So in final accounts of sole proprietorship, they have given trial balance means they have followed accounting cycle. They had proper recording. They have recorded all the transactions properly. But under incomplete records, here the businesses may not follow complete record system. What we have to do? But even though these small businesses would like to know how much profit they have earned and what is their financial position. In such a situation, what we do is we first collect the information from the proprietor. Based on the information which we have collected, first we record them in the books of accounts. This incomplete record we record as complete system. From there we prepare a trial balance. From trial balance we prepare financial statements. But in the examination they give you the incomplete information. You need not to prepare any trial balance, but you have to prepare financial statements. That is the challenge students are facing. If you have trial balance and adjustments, it is easy to prepare financial statements. But when incomplete information is given, from incomplete information you are being asked to prepare financial statements. Hope you are following, students. Yes. Now look at. First we see problems on statement of affairs. Then after we see problems on conversion method. Under statement of affairs, what we do is we collect the information about, generally to calculate profit or loss, which information we need? Income minus expenses. Which information we need? Income minus expenses. Okay, but here to collect all income information and expenses information from the proprietor, it becomes very difficult. Instead of collecting incomes and expenses, what we do is we collect assets and liabilities information. So actually we have learnt a small equation called assets is equal to liabilities plus capital. Yes or no? The same formula we follow. We prepare statement of affairs at the beginning of the year, at the same time at the end of the year. If you prepare statement of affairs at the beginning of the year, we can come to know that opening capital. If you prepare statement of affairs at the end of the year, we come to know that closing capital. By comparing this closing capital and opening capital, we can calculate easily profit or loss of the business. This is the technique which we follow under statement of affairs method. Is it clear, students? So how do we prepare statement of affairs? Tell me. We collect the information of assets and liabilities. The difference between assets and liabilities is nothing but capital. If you prepare statement of affairs at the beginning of the year, then it is opening statement of affairs. If you prepare the statement of affairs at the end of the year, then it is called closing statement of affairs. Okay, now look at some problems we try to solve on this concept. Observe carefully. Very simple. Statement of affairs problems are very simple, students. But if you get conversion method problems, now that becomes little bit difficult. Yes. Look at illustration 3 first. Here, assets and liabilities of Mr. X as on 31st March 2021 and 31st March 2022 are as follows. They are giving information on 31st March 2021 opening, 31st March 2022 closing. Right? Look at one by one. So assets. This is the opening date. Asset. Okay. 1 lakh. Furniture 50,000. Inventory 1,20,000. Asset. Sundry debtors. We show it on the credit side. Sorry. Asset side of balance sheet. Cash at bank. Asset side of balance sheet. Next, cash in hand. Asset side of balance sheet. After that, liabilities, loan, liability, sundry creditors, liability. If you draft this information on 31st March 2021, we get opening capital. We get opening capital. Look at how much opening capital we got, 2,41,200. At the same time, now come to information on 31st March 2022. What is the information on 31st March 2022? They said building. Yes, building 1 lakh. Building 1 lakh, and here they have given some adjustments. Look at, decided to depreciate building by 2.5% per annum. Means from this 1 lakh, now what we have to do is 1 lakh minus 2.5% depreciation, 2,500. Means what is the value of building on 31st March 2022? 97,500. 97,500. Thereafter, furniture depreciate by 10%. What is the furniture value here? The furniture value is 50,000. Depreciate 10%, 5,000. What is the new value of furniture? 45,000. 45,000. Okay. Next they said life insurance policy of the proprietor was matured. Okay, fine. Now next asset, look at inventory, 2,70,000 asset, sundry debtors 90,000 asset, cash at bank 85,000 asset. Next cash in hand 3,200 asset, and loan liability 80,000, and sundry creditors 70,000 liability. So that we got here closing capital. We got here closing capital. Yes. Now try to observe here. We have a formula, that means in case of sole proprietorship, when we are preparing balance sheet, in case of sole proprietorship, when we are preparing balance sheet, we have followed here, we have taken opening capital plus additional capital plus interest on capital plus net profit. We have taken all these things now. Yes sir. And from this what we did, we have deducted drawings. We have deducted drawings minus any goods withdrawn minus life insurance premium paid, minus net loss. This is we followed in case of sole proprietorship final accounts to calculate capital. Now after doing all these adjustments, what we got closing capital. After doing all these adjustments, what we got closing capital. Now by using this, what we are going to do is all these adjustments now we do. After doing all these adjustments, now we are able to calculate net profit or net loss. By comparing this opening capital and closing capital, now we are going to calculate net profit. So what is the formula for this? Simple. Net profit is equal to closing capital. Here the formula is reverse. Closing capital plus drawings. Closing capital plus drawings minus opening capital minus additional capital. Simple logic. Net profit is equal to closing capital plus drawings. Reverse. We can go from here. Reverse. Okay. Closing capital plus drawings minus opening capital minus additional capital minus interest on capital. All these things we have to deduct. The same logic we follow now. Look at here. See. Here closing capital is 4,40,700. Closing capital is 4,40,700. Less fresh capital introduced how much? 40,000. They said in the problem they have introduced fresh capital 40,000. Okay, and they have withdrawn 2,000 rupees per month. 2,000 rupees per month into 12 months, 24,000 they have withdrawn. Add 24,000. Add. How much amount we are getting? 4,24,700. From this deduct opening capital, or else we can do like this. How? 4,40,700 plus how much drawings here? 24,000 minus what is the opening capital? 2,40,200 plus 40,000 is closing capital. Sorry, additional capital. How much we get here? Calculate. 4,40,700 plus 24,000 minus 241,200 minus 40,000. How much we are getting here? 1,83,500. This is our net profit. Observe carefully. Yes, whatever the technique we have followed, that means whatever the procedure we followed in case of final accounts of sole proprietorship for calculation closing capital, the same formula we are taking, just we are calculating net profit by using this simple equation. Okay, now let's look at illustration 5. This is very important, students. This is very important, observe carefully. The income tax officer, on assessing the income of Sri Moti for the financial year 2020-21 and 21-22, 2 years information they are giving, feels that Sri Moti has not disclosed the full income. Here the income tax officer is thinking that Sri Moti, he has not disclosed full income. Okay, fine. He gives you the following particulars of assets and liabilities of Sri Moti as on 1st April 2020 and 1st April 2022. Observe here, 1st April 2020 and 1st April 2022 means 2 years. 2 years information they are giving. Now we have to prepare statement of affairs for 2 years. First observe 1/4/2020. What are the various assets we have? 25,500 asset. Inventory 56,000 asset. Sundry debtors asset 41,500. Land and building 1,90,000. Wife's jewelry 75,000. Okay, these are the assets we have. Now liabilities owing to Moti's brother, liability on the liability side, sundry creditors. By using this information, we can calculate opening capital. Opening capital on 1/4/2020. We can calculate. Now look at on this date, what are the various assets we have? Cash in hand, inventory asset, sundry debtors asset. Next, land and building asset, motor car asset, wife's jewelry asset. Right. Now liabilities. Loan to Moti's brothers. This is also asset. Loan given to Moti's brothers 20,000 and sundry creditors liability 55,000. By using this information, what we can calculate is closing capital on 31st March 2022 we can calculate. Here they have given 1/4/2022 information. This is opening on 1/4/2022, closing on 31st March 2022. So that we can calculate closing capital on 31st/3/2022. And by comparing these two capitals, we can calculate the income of Mr. Moti. Look at. Observe here. On 1/4/2024, total assets minus total liabilities. This is the opening capital. And on 1/4/2022, these are the total assets minus total liability. This is closing capital. Now tell me how much amount he has withdrawn. He has withdrawn for 2 years 4,000 per month. 4,000 per month. So 24 months. Here you have to take 24 months, not 1 month. Sorry, 1 year. 24 months we have to take. 24 into 4,000. How much? 96,000. Tell me what is the closing capital here? Closing capital 5,65,000. Closing capital is 5,65,000 plus how much amount withdrawn? 96,000. 96,000. Okay. Next, what is the opening capital? 3,13,000 minus 3,13,000. Now tell me what is his profit? 5,65,000 plus 96,000 minus 3,13,000. Actually, his profit is 3,48,000 for 2 years. His profit is 3,48,000 for 2 years. But how much profit he has disclosed? 1,05,000 for 2021 and 1,23,000 for 21-22. Means how much short profit he has disclosed? 1,05,000 minus 123. He has disclosed 1,20,000 rupees short profit. He has disclosed 1,20,000 rupees short profit. Yes or no, students? So this is your answer. How this problem is different from previous problem? Tell me how this problem is different from previous problem. In the previous problem we have just calculated what is his profit, but in illustration 5 we have calculated what is his profit for 2 years, and this we compared with the profit which he has disclosed to the income tax officer, and we identified the difference of profit. We have identified the difference of profit. Yes. How much is the difference of profit? 1,25,000. So income tax officer contention is clear. What is that? Mr. Moti disclosed or suppressed his income. Yes. How much income? We have calculated. How much it is? 1,20,000. This is how we calculate. We have calculated profit of the incomplete profit of the small businesses by following statement of affairs method. Statement of affairs method. Okay. Now we come to important method, that is conversion method. Under conversion method, what we have to do? Tell me. First, all the incomplete information we take, we complete that information. That means we record for every transaction double entry. We follow for each transaction double entry. Means we record that the transaction in journal, we post them into ledger, and we prepare trial balance. But in the examination problems, it is not possible to record all the entries, postings, preparation of trial balance. No, straight away, all these things we have to keep in mind. Okay, for this information, this is the entry I have to record. This is posted to so and so accounts, and these accounts are balanced. From these accounts, I prepare trial balance like this. From trial balance, straight away, I will go to the profit and trading account, profit and loss account, and the balance sheet. This is how we have to check. Okay, now just a minute. Yes, when we are following conversion approach, what we have to do is first do one thing. Actually, preparation of financial statements means what? Trading account, profit and loss account, and balance sheet. But under this method, under incomplete records, what we have to do is, in addition to trading account, profit and loss account, and balance sheet, we have to do certain adjustments and compulsory adjustments. Compulsory adjustments. What are they, sir? Simple. Look at the first step. What we have to follow: prepare the formats of the trading account, profit and loss account, and balance sheet. This is as usual. We draw these formats. Second one, prepare cash and bank summary. Sometimes they may not give opening balance of cash and banks or closing balance of cash and banks, or sometimes they give you some missing amounts. These missing amounts we can calculate by preparing cash and bank summary. Practically we prepare cash book na? Yes, the same cash book now we have to prepare as a working note. Next, prepare total debtors account. Why should we prepare debtors account? Why? Because sometimes they may not give opening balance of debtors. Sometimes they may not give closing balance of debtors. Sometimes the missing figure may be how much amount collected by debtors. To know that this total debtors, practically we prepare debtors account na? Same approach we follow here. At the same time, bills receivable account also we have to prepare. There is a linkage between total debtors account and bills receivable account. We have to link between debtors and bills receivable. At the same time, total creditors and bills payable. Compulsorily, total debtors account, total creditors account we have to prepare. If there are some bills receivables and bills payable, then only we prepare bills receivable account and bills payable account. Otherwise, we ignore. But debtors, creditors account, cash and bank summary, compulsorily we prepare. Right. Next, prepare an opening statement of affairs. If opening capital is not given, I repeat, if opening capital is not given, then we prepare opening statement of affairs to know the opening capital. To prepare opening statement of affairs, we need the assets and liabilities information at the beginning of the year. Yes. So that information also we have to grab. Whatever we do from the given problem, what you have, they give you information, that information you have to convert into trading account, P&L account, and balance sheet. That's it. How you prepare, I don't mind, but I will give you the information. You convert that information into trading account, P&L account, and balance sheet. So here we have to utilize our techniques. Next, any other account if required. Suppose sometimes asset account may be required to know how much depreciation to be charged, or how much asset purchase, whether any asset is purchased during the year, or when any other asset is sold during the year, like this. So we have to prepare all these working notes. Is it clear, students? Yes. Now, to prepare debtors account, what you need to understand is, what are the probable transactions between business and debtors? What are the probable transactions between business and debtors? At the same time, to know how to prepare total creditors account, first of all, you should know what are the probable transactions between creditor and business. I repeat, what are the probable transactions between creditor and business? That you need to understand. Okay, students. Now look at, here we see the probable transactions between total creditors creditors and bills payable account. Look at, first of all, first, how the relationship between creditors and business exists with the credit sales. With the credit sales, from my point, suppose I sold goods to you. From my point of view, you are my debtor. From your point of view, I am your creditor. So goods sold or goods purchased, right? So which information they get? Opening balance of creditors they give you. Next, goods purchased on credit. For this, generally, what is the entry we record? Purchases account debit to creditor account posting by purchases. Next, bills accepted. What is the entry for bills accepted? Creditor account debit to bills payable account. So creditor account debit side, bills payable account credit side. Next, bills payable dishonored. We record the reversal entry. What is that? Bills payable account debit to creditor account. This also we post into creditors account as bills payable account. Next, cash paid to the creditors during the year. Cash paid to the creditors during the year. Entry, creditors account debit to cash or bank account. This entry we post into cash account separately, that is cash book separately and creditors account separately. Most of the information which we get in incomplete records, we record in two places. One is in working note, another is in trading account, P&L account or balance sheet. This is the basic thing you have to keep in your mind. Clear? All the items, most of the items from the problem we record in two places. Under sole proprietorship final accounts, from the trial balance we record the item in one place. From the adjustments we record in two places. Under incomplete records, what we do is we record almost all information in two places. One, working note. Two, either trading account or P&L account or balance sheet. Is it clear, everybody? Yes, sir. Next one, discount and other concessions obtained. What is the entry for discount received? Creditor account debit to discount received. Here we post this discount received on the debit side of creditor account, as well as discount received is income for us, P&L account credit. Like this we have to post. Next, returns outward. Entry, creditor account debit to purchase returns account. Creditor account credit side, purchase returns deduct from purchases. Understood, students? Next, all these transactions, if we post, no need to record. If we post like this, they looks like this. Clear? Out of this some item may be missing amount. Sometimes the opening balance may be missing. Sometimes the closing balance may be missing. Sometimes the credit purchases may be missing. To solve incomplete records problem, you need good technique and whole knowledge on accounting cycle. Right. Next, bills payable account. When bills payable and creditors both accounts are prepared, yes sir, unless you know how much bills accepted by creditor, it is not possible to prepare creditors account. For that, first balance bills payable account, identify the missing amount, and the same missing amount again posted into creditors account. Then we balance the creditors account. When total creditors, bills payable both are given, first balance bills payable account, then after go to total creditors account. Is it clear, students? When a problem comes, then we discuss once again. Now, what is the probable transactions between debtors and business? How the relationship exists between debtor and business, our customers and business? We sold goods to them. When we sell goods to them, what is the entry we record? Debtor account debit to sales account. Now the relationship exists. We prepare debtor account debit side to sales, credit sales. If we have any opening balance, we write on the debit side. Okay, next transaction, goods sold on credit over, bills receivable drawn on them. What's the entry we record? Bills receivable account debit to debtor account credit side by bills receivable. Yes or no? So if it is given in the problem that bills accepted, immediately what you have to do? You have to post this transaction in bills receivable account as well as total debtors account. Next one, bills dishonored. What is the entry for dishonor? Debtor account debit to bills receivable. The same entry is posted into both the accounts. Next, cash received from them. What's the entry for that? Cash or bank account debit to debtor account. This is posted in cash account as well as debtors account. Sales returns. What is the entry for sales returns? Sales returns account debit to debtors account. How do we record this in the examination problems tell me debtor account credit side by sales returns. Now sales returns are shown on the credit side of trading account na deduct from sales. So this is how in two places we have to show it. Next, discount allowed. Discount allowed. What is the entry we record for a discount allowed? Discount allowed account debit to credit debtor account. Debtor account credit side discount allowed. Immediately discount allowed is expense for us P&L account debit side. P&L account debit side. Like this we have to write two places. Rebate or any other concession allowed to them. Rebate is expense for us. Rebate account debit to credit debtor account. Okay. Next, receipts of bills receivable. What is the entry for receipt of bills receivable? Cash or bank account debit. Cash or bank account debit to debtor account. Cash or bank account debit to debtor account. So debtor account credit side we post. Now cash received na, this cash received we post again on the debit side of cash and bank summary. Cash and bank summary. Next, bad debts written off. Bad debts written off, what is the entry? Bad debts account debit to debtor account. Debtor account credit side we post first. Bad debt loss, immediately go to P&L account and write down. This is how we have to see one by one transaction. One by one transaction. Clear everybody? Now if you see total debtors account and bills receivable account, these two accounts looks like this. If both trade debtors and bills receivables are given, first balance bills receivable account. Balance bills receivable account. After balancing bills receivable account, next go to total debtors. Debtors account may be, missing figures may be sometimes opening balance, sometimes closing balance, sometimes the credit sales becomes missing figure, or sometimes the amount collected from debtors becomes missing amount. Is it clear? Anything may be missed, but you have to prepare total debtors account. Next, fixed asset account. You have to visualize. Okay, fixed asset account, normally what are the transactions we record? We show opening balance debit side, closing balance credit side. If any fixed asset is purchased, then what is the entry? Fixed asset account debit to cash or bank account. Fixed asset account debit side. Cash or bank summary credit side. Payment na? Yes sir. Next, if any asset is sold, then what is the entry we record? Cash or bank account debit to asset account credit side. Clear? Cash account debit side. So fixed asset account credit side we have to post. At the same time cash account debit side we have to post. And if any profit or loss on sale of asset, then if it is profit, then what is the entry we record? Fixed asset account debit to P&L account, or profit P&L account. Okay, fixed asset account debit to profit P&L account credit side profit. Next, if it is loss, then what is the entry we record? Profit and loss account debit to fixed asset account. Yes or no students? Profit on loss or loss on sale. Sorry, profit on sale or loss on sale. Next one, depreciation. Sometimes the depreciation may be missing amount. Is it clear students? Yes. Sometimes after writing depreciation, they give you depreciation. Sometimes after writing depreciation, the missing figure may be asset purchased or asset sold, anything. So this is how fixed asset account is prepared. Is it clear? Next one, distinction between business expenses and drawings. They give you some expenses. Now out of them separate business expense and drawings. Drawings are all accumulate. All the drawings accumulate, all the expenses relating to personal or proprietor accumulate and make them as drawings account. Is it clear? Next one, fresh investment by proprietor or partners. Sometimes the proprietor may invest some additional capital. Yes or no? This must be separated now. Yes. So this is considered as additional capital and added to the capital in the balance sheet. Next one. Yes, that's it students. Now if we solve one or two problems, then you can come to know that what is the important or how to solve the problems of, yeah, sometimes this type of problems they give you for 5 marks. Very simple, very simple. What they are asking, observe. This problem already given in the previous attempts. Calculate the bad debts from the following information. How we can calculate bad debts? By preparing debtors account. How can we calculate bad debts? Tell me. By preparing debtors account. Look at opening balance of debtors debit 5 lakhs, closing balance of debtors credit side buy balance C by D 7 lakhs. Next one, amount received in cash, cash account debit to debtors account by cash. Next, discount allowed, discount allowed, discount allowed account debit to debtors account by discount allowed. Next one, credit sales entry, debtors account debit to sales account 11 lakh 40,000. Next, bills receivable entry, bills receivable account debit to debtor account by bills receivable, just a minute, by bills receivable. Over. Now you balance the account. Finally, bad debts means what is the entry we record? Bad debts account debit to debtors account means debtors account credit side you should get the posting. Means if debit side is more, than credit side, the difference is considered as bad debts. Over. Generally, debtors account shows debit balance now. Yes, means amount to due from him. Already we know amount to due from him 7 lakhs. Still this account is showing debit balance. Yes, that means remaining amount considered as bad debts. So this is very important problem. Next, this is a small problem, illustration 7. You can see this. Now look at illustration 8. Very, very important problems. We try to solve 2-3 illustrations, then after RTP, then after MTP. Now look at, observe carefully. Adamji keeps his books on single entry basis. Okay, means incomplete records. The analysis of the cash book for the year ended 31st March 2022 is given. This is the cash book, students. This is just a cash book. This is just a cash book. Look at bank balance, which date 1/4/2021. Immediately you have to see whether capital balance is given or not. If capital balance is not given, we have to prepare opening statement of affairs. Opening statement of affairs. So this can be taken to the opening statement of affairs 2800. Already they have given cash book na, you need not to prepare cash book again. This 2800, take it to the opening statement of affairs. Yeah, look at 2800. Next, received from sundry debtors. Immediately open sundry debtors account. Immediately open sundry debtors account. Give posting by cash. No second thought. Yeah, by cash 48,000. Okay, so first we have to draft all the requirements. Next, cash sales. Cash sales are shown on the credit side of trading account na? Yes sir, go to credit side, write down 62,100. Just a minute, this is just 11,000 students. 11,000 is cash sales plus credit sales also we have to show na? Credit sales we can identify from debtors account. Wait for that. Next, capital brought during the year. This is nothing but additional capital. Additional capital we show on the asset side of balance sheet. See, fresh capital 6,000. Over. Next, interest on investments. You people tell me interest on investment is income for us. P&L account credit. Yes sir, P&L account credit, interest on investment. Like this you have to visualize, okay, this item whether it is taken to trading, P&L or balance sheet. At the same time, whether it is required to post in working note, that decision you have to take. Next, look at payment to sundry creditors. Sundry creditors means go to creditors account and give this posting 35,000. See, every information given in the problem is used. Every information given in the problem is used compulsorily. Compulsorily. Okay, students. Next one. Go to creditors account and give postings in creditors account. Yes, debit side to cash. Is it clear? Next, salaries. Salaries are expenses. Straight away take it to the P&L account debit side. P&L account debit side. Salaries over. Like this you try to solve as much as possible. As much as possible. Look at the time. Whether this problem can be solved within 10 minutes or 15 minutes based on the time given. Sorry, based on the marks given. You allocate time, within that time you try to solve it. If you are unable to solve this problem within that time, then ignore. Ignore means leave it. Go to the next problem. Don't unnecessarily waste time on this problem because it is incomplete records. It utna hi, bas. I cannot say anything more than that. Okay, now look at. पागल हो जाएगा हम लोग वो प्रॉब्लम को देख के. right? If we see incomplete records problem na, if the balance sheet doesn't tally na, we become mad. That's why ignore. Okay, next one, general expenses. General expenses straight away P&L account debit. General expenses 2500. Next one, rent and taxes 1500. Expense na P&L account debit. We get interest. Okay, not that interest to solve the problem. Okay, drawings are deducted from capital, so straight away go to balance sheet, closing balance sheet, and drawings 3600. Next, cash purchases. Purchases are shown on the debit side of trading account na. Yes sir, it is cash purchases. Wait, we add credit purchases also, then total purchases we show 12,000 rupees. How do we get credit purchases from creditors account? How do we get credit sales from debtors account? Next, balance at bank. This is closing balance of bank na 6400, cash in hand, closing balance of cash na 500. Both are shown on the closing balance sheet. Look at on the closing balance sheet. As much as possible you try to solve, students. You get stepwise marking. Okay, next. Over. This much of information completed. Now look at particulars of other assets. Particulars of other assets and liabilities are as follows. Observe the dates. 1st April 2021, 31st March 2022. This is beginning, this is closing. Now whatever the assets we have on the beginning of the year, with this first you prepare opening statement of affairs. With that you get opening capital. Look at the same time show these items in the appropriate place also. Means look at, first take sundry debtors. This is opening balance and this is closing balance. Go to debtors account, show 14,500 as opening balance and 17,600 as closing balance. Immediately. Okay, now look at what I am doing is I am going to debtors account. Debit side I am writing opening balance, credit side I am writing closing balance. Immediately, wait. This becomes opening asset na. Go to opening statement of affairs. Write down debtors 14,500. Over. Now, whatever the closing debtors I have 17,600. This becomes asset at the end of the year. Yes sir. Go to closing balance sheet. And write down 17,600 here. We have provision. Okay. Inner column write down 17,600. Now you people tell me, this information we have recorded in 3 places. Debtors account debit side, credit side. Opening statement of affairs, closing statement of affairs. If you write like this now, you never forget even single item. Do remember. Next one. For the next information we have, sundry creditors 5,800, opening, closing. Same. Go to creditors account, 5,400, show it as credit balance, 7,900 debit balance. Same 5,800 again we show as liability at the beginning, 7,900 as at the end of the year. Next, machinery 7,500 here, 7,500 here. First you go to opening balance sheet, show 7,500. Yes sir. Over. Next, check whether any depreciation is given. Yes sir, depreciation is given. Look at 10% is the depreciation on machinery, furniture. 10% is the depreciation on machinery and furniture. Okay, how much is the machinery value? 7,500. Deduct 10% depreciation, 750. 750 show it on the debit side of P&L account. 7,500 minus 750 show it on the credit side of asset side of new balance sheet. If you can take one by one item and write down in the appropriate place, the problem gets completed. That's it. No need to worry. Whatever the type of problem it is, you take one item and think whether it is recorded in trading account or P&L account or balance sheet or any working note. Write down the information in the appropriate place. Automatically you get final answer. Now this is the information na. All the information write down in the appropriate place. Automatically you get final answer. Is it clear, students? Say yes or no yaar. Hello students. Next one. Next one, furniture 1200. Go to opening statement of affairs and write down 1200. Now they said depreciation na how much? 10% means 120. 10% na 120. 1200 minus 120. Remaining amount closing balance sheet. Next, inventory. Inventory. This is opening inventory. Go to trading account debit side, opening inventory 3900, and go to statement of affairs, show it as a asset. Two places. Trading account debit side, statement of affairs, asset. At the same time, here they have given 5700 as closing inventory. Closing inventory, what is the treatment? Trading account credit side, one time. Go to closing balance sheet, asset. Go to closing balance sheet, asset. Over. Next, investments. Investments is asset. Go to statement of affairs, opening statement of affairs, show it as asset. And the same investments we have 5000. Go to closing statement of affairs and write down same 5000. The writing of this information is very, very important. Next one, prepare final accounts. Already we have prepared na on 31st March 2022 after providing depreciation and 800 against doubtful debts. They said 800 doubtful debts. You need not to prepare. Straight away take this doubtful debts to the P&L account debit side and come to closing balance sheet, deduct provision. Deduct provision 800. You get 16,800. That's it. Over. Now look at working note. Balance sheet of Adamji, opening state. Here what we have to do, after completion of all working notes, then come to trading account, P&L account, balance sheet. Then come to trading account, P&L account and balance sheet. Clear? Here statement of affairs is how much? 29,100. Take this 29,100 to the balance sheet. 29,100. After that, capital account. Here they have prepared capital account, or the same information you can show in the closing balance sheet asset side, sorry, liability side. Next, sales account. Here they have prepared sales account. Cash sales, credit sales. Credit sales are taken from debtors account. If you balance debtors account, then you get 51,500, that is transferred to the sales account. 11,000 cash sales, 51,500 credit sales. Next, purchases account. Cash purchases already posted now 12,000. By preparing total creditors account, here total creditors account, observe opening balance we have, cash paid we have, and closing balance we have. The difference is nothing but purchases. The difference is nothing but purchases. This is credit purchases. Already we have purchased goods worth of 12,000 plus 37,100. Total purchase 49,100. Now go to trading account here. Complete the trading account, calculate gross profit, bring that gross profit to profit and loss account. Now calculate net profit or net loss, bring that net profit or net loss to balance sheet. Now balance sheet total. If you take one by one item na, automatically your final answer gets correct. Is it clear? This is our problem. Problem number 8. Now look at the another problem. Incomplete records problem, they may give you in different manners. Different manner. You cannot imagine. They may give you the information in different manner. Here how they have given information, tell me. They have given cash book summary and they also given some assets and liabilities information at the beginning. Sometimes this is summary of cash book, na, receipts to payments they have given, but sometimes what they do, they give you just information. They will not give you this cash book. You have to prepare cash book. That problem we see now. Look at. Yeah. Illustration 9. Come to illustration 9 once. From the following data furnished by Mr. Manoj, you are required to prepare trading and profit and loss account for the year ended 31st March 2022 and balance sheet as on that date. All working should form part of your answer. Okay, anyway we do working notes now. Yes sir. Now look at one by one information. First, draw all the required formats. What are the formats we have to draw? Tell me. First, trading account, profit and loss account, balance sheet. Apart from this, if opening capital is not given, then prepare opening statement of affairs. Anyway, we have to prepare total debtors account, total creditors account. If bills receivable is there, bills receivable account. If bills payable is there, bills payable account. If cash and bank balances are not given, any missing amount, or in any problem, cash and bank summary is not given, you have to compulsorily prepare cash and bank summary. Clear? Now look at here. The information is given as on 1st April 2021 and 31st March 2022, opening and closing. Immediately after looking creditors, what you have to do? Open creditors account, show opening balance and closing balance. Over. After looking creditors, what we have to do is open creditors account, show opening balance credit side, closing balance debit side. Over. Next, sundry expenses. If statement of affairs is not given, opening statement of affairs or opening capital is not given, this 15,770 show it as liability at the beginning, and this 12,400 show it as liability at the end. Three places: creditors account, credit side, opening balance, debit side, closing balance. Opening statement of affairs liability, closing statement of affairs liability. In these many places you have to write. Is it clear? Next one, sundry expenses outstanding. Still outstanding 600 here, 330 here. Okay, fine, we wait. Sundry assets 11,610, 12,040. Here prepare sundry assets account. It is better to, because here the asset value is changed. Observe. When the asset value not changed, you need not to prepare any asset account. But when asset value is changed, try to prepare asset account. This becomes opening balance and this becomes closing balance. Other information we try to post it. Inventory in trade. This is opening stock and this is closing stock now. Opening stock trading account debit side. Closing stock trading account credit side. Again, opening stock, opening statement of affairs asset side. Closing stock, closing balance sheet asset side. Over. Next, cash in hand and at bank. Opening statement of affairs asset side. This is 8,080, closing balance sheet asset side. If you prepare cash in hand and at bank account, then separately we have to write to balance brought down, by balance C by D. To balance brought down, by balance C by D. I will show you just a minute. Look at combined cash and bank account. To balance B by D 6960, by balance C by D 8080. Next. Yeah. Opening balance sheet prepared. Look at assets and liabilities information recorded. If you can solve the problem like this now, first you have thorough clarity in your mind. Yes, this item is taken to this place. Then after easily you can solve the problem. Next, look at next item, cash and discount credited to debtors. Cash and discount both credited to debtors account. Now we go to debtors account credit side. Actually this should be bifurcated. How much cash received, how much discount allowed. To bifurcate this, we have some hint that we can see. Next, cash. Okay, sales return entry. Sales returns account debit to debtor account credit side. Sales return trading account credit side deduct from sales. Next, bad debts are recorded in first P&L account debit, bad debts, yes sir, again debtors account credit side. Two places we have to write. Next, sales, cash sales, credit sales, 71,810. If you know cash sales na, then automatically you can calculate credit sales. If you know credit sales na, then automatically you can calculate cash sales. Hope you are following. Yes sir. But anyway, the total sales are taken to the credit side of trading account. Next, discount allowed by trade creditors. Discount allowed by trade creditors is income for us, credit side of P&L account, and this amount again we show it on the debit side of creditors account. Next, purchase returns. Purchase returns entry, creditor account debit to purchase return. Creditor account debit side, purchase returns deduct from purchases on the debit side of trading account. Next, additional capital into bank. What is the entry we record? Bank account debit to capital account. Additional capital na. So first what we do? Post this in the combined capital account. See, capital 8,500. Again go to balance sheet, add additional capital 8,500. If you solve one by one item na, then you can come to know that the real adjustments. Next, realizations from debtors paid into bank. Realizations from debtors paid into bank means we have received amount from debtors now. The same amount we posted into bank. Entry, bank account debit to debtors account. Here observe how much amount we credited to debtors account. Cash and discount 64,000. From 64,000, how much amount you collected from debtors cash in the form of cash? 62,500. Means 1500 rupees is discount. 1500 discount. Yes, this is the hint we have to apply. Total amount they said credited to debtors account 64,000, whereas how much amount received actually 62,500, means 1500 is a discount, and this 1500 discount is shown on the debit side of profit and loss account. Clear? Next one. Next, okay, cash purchases. Cash purchases. Straight away, cash account credit side. Cash account credit side. Look at cash and bank summary. Purchases. Cash purchases. Yes, 1030. Next, cash expenses. First, write down in the cash and bank summary credit side. After that, go to P&L account debit side and write down expenses. Paid by check for machinery purchased. We have purchased machinery during the year and we have paid check. I told you already, prepare machinery account. Prepare machinery account. It is better to prepare machinery account. Look at machinery account. Yeah, machinery account they have not prepared, but you can prepare that. Observe, 11,610 is the opening balance, plus during the year how much machinery purchased, sorry, sundry asset. During the year how much machinery purchased, tell me. For 430, add 430, means total become 12,040 na? Total become 12,040. Yes sir, in the new balance sheet, that means closing balance sheet, we write 12,040. Here they said there is no information relating to depreciation. That's why we have ignored the depreciation. They have given hint point, look at, no depreciation on fixed assets. Next one. Next one. Household expenses drawn from bank. This is nothing but drawings. Drawings account debit to bank account. So first cash and bank summary credit side. After that drawings. Drawings are deducted from capital. Next, cash paid into bank. This is contra entry. This is contra entry. Observe carefully. Contra entry. Debit side 5,000. At the same time credit side 5,000. Contra entry. Next, cash drawn from bank. Again, this is also contra entry. Cash account debit to bank account. Contra entry. Look at 9,240. 9,240 debit, 9,240 credit, because it is combined cash and bank summary. Next, cash in hand opening balance. Cash in hand opening balance. Cash in hand given, and observe carefully here. They said cash in hand and cash at bank closing, how much they have given? 8,080. 8,080 they have combinedly given 8,080 minus, at the end they said cash in hand on 31st 3 2022 1200, means remaining 6,680 cash at bank. Remaining 6,880 cash at bank. Yes or no? Yes sir. Look at, but anyway they have given it here combinedly, but at the time of showing in the balance sheet, you can show it separately or combinedly, no problem. Next, that's it. Next, checks issued to trade creditors. Entry for checks issued. Creditors account debit to bank account. Creditors account debit side. Creditors account debit side and bank account credit side. Over. So all information almost we have taken to various places. Now what you have to do is go to working note first, balance combined cash and bank summary. Here we are getting the balancing figure as cash sales. We are getting the balancing summary as cash sales. This is important. Next, total debtors account, balance total debtors account, you are getting opening balance as balancing figure. Look at, identifying the balancing figure is very, very important, students. Next, creditors account, observe what is the balancing figure here? Opening balance 15,770. 15,770. Next one, this is closing statement of affairs, opening statement of affairs. What is the balancing figure? Opening capital 26,770. Next, here they said they have given one adjustment for expenses paid in cash. If you observe how much expenses we have paid, cash expenses 9,570 cash expenses paid. But if you observe at the beginning of the year, how much is outstanding? 600. Means current year we have paid? Yes sir, deduct 600 rupees. Because this amount out of 9,570, 600 is relating to previous year. We should not show it in the current year P&L account. 9,570 minus 600. So we get 8,970 plus current year still outstanding 300 na, add, sorry, 330 na, add 330. Then total becomes 9,300. And this 9,300 we show in the P&L account debit side, on the debit side of P&L account. 9,300. Is it clear, students? Discount 1,500, bad debts. Like this we complete the problem. As much as possible you try to complete. As much of as possible. Clear? Now we look at the next problem. Illustration 10. Almost in the RTP and MTP also they have given similar type of problems with a slight modification. Okay, so I will explain illustration 10. You people try to solve RTP and MTP problems. If you get any doubt, you can send me to my personal number, Telegram. I will respond as much early as possible. Okay, now look at illustration 10. After completion of this chapter, we start a NPO chapter, not for profit organization chapter. Now look at illustration 10. Mr. Anup runs a wholesale business wherein all purchases and sales are made on credit. Yeah, first condition is what? All purchases and sales are made on credit. No cash purchases, no cash sales. No cash purchases, no cash sales. Okay now. Next, he furnishes the following closing balances. Closing balances. He said following closing balances. 31st March 2021 and 31st March 2022. 31st March 2021 is the closing date for the financial year 2021. The same becomes opening on 1st April 2021. 1st April 2021. With these balances, we prepare statement of affairs, opening statement of affairs, so that we can calculate opening capital. And these are the closing balances. We take them to the closing balance sheet. If any fixed asset requires any adjustment for depreciation or something, then we do it accordingly. Otherwise, we take as it is to the closing balance sheet. Clear, students? If you get this type of information, it is very interesting, because this every item we have to write in 2-3 places. 3 places. Sundry debtors, opening balance, closing balance. Opening statement of affairs, asset, closing statement of affairs. 4 times we have to write. Don't forget this. Okay. Now look at sundry debtors, opening balance 70,000, closing balance 92,000. What I am doing is, this is something interesting, students. Observe carefully. Sundry debtors, opening balance 70, closing balance 92. And I am preparing opening statement of affairs also. Debtors 70,000 and closing balance sheet debtor 92,000. Hope you are following. Yes, students. Thumbs up. Thumbs up. Not that thumbs up. Like. Next. Bills receivable, opening balance 15,000. Bills payable 6,000. Bills receivable, open bills receivable account. Opening balance 15, closing balance 6,000. 15,000 again, closing statement, opening statement of affairs asset 6,000. Closing balance sheet. Next one, bills payable 12,000, 14,000. 12,000 bills, open bills payable account. Opening balance 12,000, closing balance 14,000. Bills payable liability, opening statement of affairs liability side, closing balance sheet liability side. Next, sundry creditors. Sundry creditors, opening balance 40, closing balance 56. Again, 40,000 is shown on the liability side of opening statement of affairs. 56,000 rupees is shown on the liability side of closing balance sheet. Next, inventory. This is opening inventory now, and this is closing inventory. First, go to trading account. Opening inventory, 2 opening stock 1,10,000. By closing stock 1,90,000. Visualize. Again 1,10,000 is shown on the asset side of opening statement of affairs, and 1,90,000 is shown on the assets side of closing balance sheet. Next, bank 90,000, 87,000. Immediately open bank account, cash account also. Both balances given na. Open 2-column cash book, cash with cash and bank column. Open 2-column cash book with cash and bank column. Before that, 90,000 opening statement of affairs, asset side. 87,000 closing balance sheet, asset side. When you open bank account now, opening balance 90, closing balance 87. Cash now, opening statement of affairs, asset 5,300, closing balance sheet, asset. Immediately we open working note now, this becomes opening balance, to balance B by D. Look at, I will show you cash and bank accounts. Just a minute. Yes, look at summary of cash and bank. 2-column cash book. It's like 2-column cash book. Cash and bank. Opening balance 5,200, 90,000. Next, closing balance 5,300, 87,000. This problem becomes little bit lengthy problem, students. Lengthy problem. Now look at. Okay. Observe carefully. Okay. Next. Summary of cash transactions during the year 21-22. Summary of cash transactions during the year 21-22. Now, from here, what we do is, first we record this transaction, whether it is cash or bank, in the cash and bank summary. After that, from there, we take it to the either trading or P&L or balance sheet or any working note, means debtors account, creditors account, like that. Okay, look at. Deposited to bank after payment of shop expenses, means indirectly they are giving shop expenses. What are the shop expenses? Tell me. 600 per month, means 12 months 7,200. First of all, shop expense, write down on the payment side 7,200. Immediately it is expense na, P&L account debit. Next one, salary 9,200 per month. Salary 9,200 per month. So 9,200 into 12 months. 9,200 into 12 months. Total 1,10,400 on the payment side first. 1,10,400 on the payment side. Just a minute. Salary 1,10,400 on the payment side of cash column, and shop expenses. Again, both are taken to the P&L account debit side. Salary, shop expenses. Hope you are following. Yes, sir. Next one. Next, personal expenses means drawings. 1,400 per month. So 1,400 into 12. 16,800 drawings. Okay. After all these cash expenses, how much you have deposited? 7,62,750. It is contra entry. Bank account debit to cash account. Look at. Drawings 16,800. Next, see, contra entry 7,62,750, 7,62,750 contra entry. After that, drawings 16,800. Like this, we have to write one by one item. Next. Yes. Now come to next items. Cash withdrawn from bank 1,21,000. Again, this is contra entry. So this is shown on the summary of cash and bank transaction. Next, cash payment to suppliers. Creditor account debit to cash or bank account. Creditor account debit side, bank account credit side. For suppliers, and 25,000 for furniture. We have purchased furniture. Furniture account debit to bank account. Bank column credit side. Sorry, this is cash payment na. Yes. Cash column 25,000, and furniture is asset na, balance sheet asset side. Next, checks collected from customers but dishonored. We have collected checks from customer. First, what is the entry we have to write? Bank account debit to customer's account. This is the first entry we have to write. Bank account debit to customer account means bank column entry, customer account credit side entry. Now the same check is dishonored. The same check is dishonored. Again, the above entry is just reversed. What is the reversal entry? Debtor account debit to bank account. Sir, shall we ignore this? No, 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 don't ignore. Compulsorily you have to show as note. That means you have to mention this in the cash and bank summary. Next, bills accepted by customer. What is the entry? Bills receivable account debit to debtors account. Bills receivable account debit side, debtors account credit side. No need to write anything in the final accounts. Bills endorsed. Generally, to whom we endorse bills? Creditors. Entry. Creditors account debit to debtors account. Creditors account debit to debtors account. Sorry. Creditors account debit to bills receivable. Sorry. Creditors account debit to bills receivable. So, creditors account debit side, bills receivable credit side. Next, bills discounted 20,000, discount 750. Entry. Bank account debit to bills receive, bank account debit 20,000, discount 750 to bills receivable 20,000 750. Sorry, 750 is excluding bill, na? 750 is excluding bill. Go to bank summary. Write down 2 bills receivable 19,250. That exclude discount. Remaining 750 is discount expense, na? P&L account debit side. P&L account debit side. Same posting we write in bills receivable account also. Bills receivable account also. Credit side. By bank, by discount. Whatever we are studying, we have to post in two places. Next, bills matured and duly collected. Entry. Bank account debit to bills receivable. Bank account, bank column debit side. Bills receivable credit side. Bills accepted means we accepted bills now. So creditors account debit to bills payable account. Both the accounts we give posting. Paid suppliers by check. Suppliers account debit, creditors account debit to bank account. So suppliers account debit side, bank column credit side. Received 20,000 on maturity of life insurance policy of the proprietor by check. This is treated as additional capital. This is treated as additional capital. What's the entry we record? Bank account debit to additional capital. And additional capital is shown on the liability side of balance sheet as a addition to the opening capital. Next, rent received 14,000 by check for the premises owned by the proprietor. Actually, these premises are owned by the proprietor. We received rent. This is also treated as additional capital. This is also treated as additional capital because who is the owner of the property? Proprietor. Proprietor received rent. Yes, that is his income now, but that is recorded in the business premises. So additional capital. Look at bank and cash summary first of all. Yes, 20,000 and rent received 14,000. This 20,000 plus 14,000, 34,000 is treated as additional capital and it is added in the balance sheet. See, 20,000, 14,000. Next, a building was purchased on 30th 11/2021 for opening a branch for 3.5 lakh. We have purchased a building on 30th 11/2021 for opening a branch for 3.5 lakh and some expenses were incurred on this building, details of which are not maintained. This point is very, very important. They said we have purchased a building for 3.5 lakh, but they did not mention how much expenses we have incurred. How much expenses we have incurred. Now what we have to do is we go to cash and bank summary. We go to cash and bank summary. Whatever the balance we get in the bank column, that balance is considered as purchase of building. In this problem, this is very, very important factor. Is it clear, students? Next one. Electricity and telephone bills paid by cash 18,700, due 2,200. Electricity and telephone. First of all, 18,700 is posted on the credit side of cash column. Next, in the P&L account, how much amount we show? 18,700 plus due amount 2,200. 18,700 plus 2,200, total 20,900 we show on the debit side of P&L account. 20,900. And the liability outstanding amount is shown on the liability side, 2,200. 2,200 telephone charges. Clear? Next, all these are cash and bank summary items. All these are cash and bank summary items. Now look at other transactions. Other transactions. What are other transactions? Claim against the firm. Claim against the firm for damage for 1,55,000 is under legal dispute. Legal expenses 17,000. The firm anticipates defeat in the suit. Means we have to create provision for this. We have to create provision for this. 1,55,000 create provision. Look at provision for claims for damages 1,55,000. Sir, what about legal expenses, sir? Legal expenses normally we pay. Debit side expense 17,000. And this provision for claims for damage, again we have to show it on the liability side of balance sheet. 1 lakh, because we have not yet paid now. If you pay, it can be ignored, but it is not paid. 1,55,000. In this problem, this point also very important. Next one. Look at goods returned to suppliers entry. Sales returns account debit. Sorry, suppliers now. Creditors account debit to purchase returns. Creditors account debit side. Purchase returns increases now. Go to trading account debit side. Deduct it from purchases. Next, goods returned by customers. Sales returns account debit to debtors account. Go to debtors account credit side. Give posting. At the same time, go to trading account credit side. Deduct from sales. Next, discount offered by suppliers means discount received. Suppliers account debit to discount received. Go to suppliers account first, working note, debit side, to discount received. And this discount received becomes income, credit side, P&L account, credit side. Discount offered to the customers, entry. Discount allowed account debit to customers account. Go to customers account, credit side, by discount allowed. Next, go to P&L account, debit side, to discount allowed, over. Next, the business is carried on at the rented premises for an annual rent of 20,000, which is outstanding at the year end. Means it's an outstanding liability. First, show it on the debit side of P&L account because it is an expense. Again on the liability side of balance sheet, over. This is how we try to solve the problem. After that, what is pending? Look at one first closing working notes. First working notes, look at sundry debtors account. After that, bills receivable account. Bills receivable account. Yes. Here, bills receivable account, there is one important point. When we are balancing bills receivable account now, when we are balancing bills receivable account shows some missing amount. Some missing amount. What is that missing amount, sir? Observe carefully. In the bills receivable account, debit side we have opening balance, credit closing balance. Next, bills accepted by debtors, bills endorsed, bill discounted, bills collected. Every information is there. Then debit side is more. Bills receivable account debit side is more. Why it is debit? Why the debit side is more? This is the question mark. So that here we have to assume it as there is 3,000 rupees difference. For this amount, the bill gets dishonored. This is very important point. 3,000 worth of bills dishonored. What is the bill dishonor entry? Debtor account debit to bills receivable account. Debtor account debit side. Debtor account debit side to bills receivable 3,000. Bills receivable account credit side by debtors 3,000. Over. Unless you complete this, it is not possible to complete debtors account. And what is the missing amount in debtors account? Look at in the debtors account, if you observe, amount collected from debtors is not given. How much amount collected from debtors? Not given. So that this amount is treated as missing figure. So these two accounts are completed. Now come to creditors account and bills payable account. In the bills payable account, the missing amount is nothing but bills honored. Bills honored. And this amount is posted to cash summary. Next, creditors account, what is the missing figure? Credit purchases. This is shown on the debit side of trading account. After that, summary of cash and bank. Here, the summary of cash and bank, missing figure on the bank column is 3,72,000. This is considered as purchase of building, and the same purchase of building is shown as an asset on the asset side of balance sheet. Next, opening statement of affairs. The balancing figure in the opening statement of affairs is opening capital. This is shown as capital at the closing balance sheet. Opening capital as closing balance sheet in closing balance sheet 2,38,200. After this, trading account balance, gross profit, and this gross profit is carried to the profit and loss account, and that is added to capital. Finally, we get total of balance sheet. This is a very lengthy problem, students. Very lengthy problem. If you get this type of problem, na, they may ask it for 10 marks or 12 marks. Clear? So this is our accounts from incomplete chapter. We have discussed three models of giving information. If you can solve these three models of giving information, na, so whatever the type of problem they give you, with the basic idea you can solve it. Suppose the question paper is very 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 tough. Yes, in any question paper, in any question paper, there is a scope to get minimum to minimum 50 marks. There is a scope to get minimum to minimum 50 marks. Don't forget this. Don't forget this. You get 50 marks out of the toughest question paper only when you answer them at least 80%. Suppose now I am solving this question, at least I have to solve it 80%. 20% I don't know, or there is no time is not sufficient for me to solve the entire problem of incomplete records. Okay, at least 70 to 80% you solve, you get proportionate marks. You get proportionate marks. Is it clear, students? Is it clear, students? Yes, sir. Right, now we take some 15 minutes break, have some dinner or have some tiffin or coffee, whatever you want. Again we meet after 15 minutes. Now the time is 8:20. We meet sharp by 8:35 or 8:40. Okay, join soon. Now we discuss. After that we discuss NPO. After completion of NPO, we start partnership today itself. Is it clear, students? Yes. Now take a break. Hello. Hello, students. Welcome back after the break. Let me check, am I audible or not? Am I audible, students? Respond. Okay. Yes. Now we start our discussion with the not for profit organizations. Very, very, very important chapter. You get compulsorily a question from this. Already we discussed, na? We get three problems from three chapters: final accounts of sole proprietorship and not for profit organizations and incomplete records. Okay, students, right? Now look at, yes. So which type of problems we get, sir? Which type of problems we get? Mainly, see, our main focus of revision lecture in these 2 days is how to solve the problem. Here I am, here the time will not permit to explain each and everything, okay, and in-depth concepts, and to cover all problems. Time is the limiting factor. That too you have to study now. That's why here my main focus is, if you get this type of problem, then how do you try to solve it? The process I will explain. I will explain the process of solving the problem. Is it clear, students? So that you can apply the same process for any number of problems. Means final accounts, there is one process. Incomplete records, there is one process. Technique. Instead of calling it as process, we can call it as technique. And to solve the problems of not for profit organization, what is the technique we have to follow? What is the technique we have to follow? For that, first you need to understand which type of problem you get in the exam. Which type of problem you get in the exam, that you need to understand. Already we understood, in case of final accounts of non-manufacturing entities, which type of problems we get? Yes, these type of problems we get. Manufacturing entity, this type of problems we get. And in case of incomplete records, which type of problems we get? Statement of affairs and conversion method. If you get a problem of statement of affairs, how do we solve? If you get a problem on conversion method, then how do we solve? All these things we have discussed now. In the same manner, if you get a problem on not for profit organization, then how do we solve it? Right. Now look at first one. Preparation of first type of problem is preparation of income and expenditure account, preparation of income and expenditure account and balance sheet from receipts and payments account and other information. This is one type of problem, and most of the times this type of problem they have asked in the exam. Next one, preparation of receipts and payments account and balance sheet from income and expenditure account and other information. Majority cases they may ask this type of problem. We have to prepare income and expenditure account and balance sheet from receipts and payments account and other information. We know the financial statements of not for profit organizations consist of receipts and payments account, income and expenditure account and balance sheet. Receipts and payments account is nothing but summary of cash and bank transactions. Income and expenditure account looks like profit and loss account, with the exception that in case of profit oriented organization, the difference between profit and loss account, the difference between debit and credit of profit and loss account is called profit, net profit or net loss. But in case of not for profit organization, we call it as surplus or deficit. If credit side is more than debit side of income and expenditure account, then we call it as surplus. If debit is more than credit, we call it as deficit. Surplus of deficit. In case of profit organizations, the profit, especially proprietorship, the profit is added to the capital account, and finally we show closing capital in the balance sheet. In case of partnership, the profit is distributed among partners. In case of companies, the profit is distributed among shareholders in the form of dividend. But in case of not for profit organization, the surplus is not distributed among its members. Surplus is added to the capital fund. Is it clear, students? Yes. Now here we try to focus on solving some problems. Observe carefully first. Yes. Yeah. First, look at the format of receipts and payments account. Debit side, what we write? Opening balance of cash and bank. Debit side, we write opening balance of cash and bank. And this receipts and payments account, here most of the students they get confusion. Why, sir? Why? Because receipts and payments account is given. From this, you have to prepare income and expenditure account. What are the transactions receipts and payments account records, and what are the transactions or which accounts we show in the P&L account? Receipts and payments account records the transactions. Transactions means opening and closing balances of cash and all receipts and all payments, whereas profit and loss account records expenses and incomes. By all the nominal accounts, ultimately we transfer to the profit and loss account and they gets closed. The problem comes from receipts and payments account, which items are taken to the profit and loss account and which items are taken to the balance sheet. In case of sole proprietorship, in case of final accounts of sole proprietorship, they give you trial balance. There we have identified which items are taken to trading account, profit and loss account and balance sheet. In case of incomplete records, we have identified whether this particular item is taken to the trading account, P&L account and balance sheet. But under not for profit organization, from receipts and payments account, here they give you receipts and payments account and other information. Receipts and payments account and other information. Now we have to identify which item is taken to income and expenditure account and which item is taken to the balance sheet and which item requires a working note. Is it clear, everybody? Yes. So understanding this receipts and payments account is very, very important. Is it clear? Now look at, observe carefully here. Right. Now this is receipts and payments account. Receipts and payments account. Receipts and payments account records receipts and payments account. Debit side we have opening balances. To balance brought down. Cash, bank. Next, buy balance carried down. Buy balance carried down. Cash, bank. Okay. First, I will talk about this. This information, opening balance and closing balance information, is taken to, here we prepare two balance sheets. One is closing balance sheet. One is closing balance sheet. And another one is opening balance sheet. In case of incomplete records, we have prepared opening statement of affairs. For what purpose? To know opening capital. At the same time, in case of not for profit organizations also, we need capital fund at the beginning of the year. At the beginning of the year, how much capital fund we have, that information we need. If it is not available in the problem, then we need to calculate how the statement of affairs is prepared, by writing the assets and liabilities on opening date. Here also same, by writing the assets and liabilities on the opening date, we prepare opening balance sheet. From this opening balance sheet, we calculate opening capital fund, and that is taken to the closing balance sheet. Look at, this is opening balance sheet. Now, whatever the opening balances we have, cash and bank, both balances are taken to the opening balance sheet. Both balances are taken to the opening balance sheet. Do remember. Yes, sir. Over. Next one, closing balance of cash and bank are taken to the closing balance sheet. Without any second thought, These two are taken, just a minute. These two are taken in closing balance sheet asset side. These two are taken on the closing balance sheet asset side over opening balance, closing balance. Clear? Next, this receipts and payments account records capital receipts. Capital receipts. Sir, what is the meaning of capital receipts? Capital receipts are nothing but not revenue receipt. Huh, yes, sir. Capital receipts nothing but not revenue receipts. Okay, what are capital receipts? Nothing but, suppose I have excuse me, I have sold one asset. I received cash. This is receipt for me. It is capital receipt because this amount I will not receive frequently, na? Yes, sir. I have taken some loan from bank, small loan from bank. So it is a capital receipt for me. And I have received some capital grants from government. Grants from government for a specific purpose. It is capital receipt for me. And I have received some donations from outsiders for a specific purpose. It is a capital receipt for me. These are recorded in the receipts and payments account. Next one, receipts and payments account also records revenue receipts. Revenue receipts. So revenue receipts are nothing but what? These are the amounts frequently the business will receive. Example, subscriptions. Subscriptions are received by the not-for-profit organizations from their members frequently, every month or every quarterly or every yearly, sometimes every once in a 6 months. And some interest or dividend or commission, whatever it may be. Not commission because it is not for profit organization. Okay, all these things, similar nature. These are revenue receipts. Okay, any um, any donation, okay, general donations or revenue donations or donations to meet some specific, not specific, for maintenance purpose, or we have received some government grant to maintain our building. All those things revenue receipts, right? Now, how can I identify whether it is a capital receipt or revenue receipt? You have to utilize your common sense. By looking that particular item, you have to classify it as revenue receipt or capital receipt. If it is revenue receipt, if it is revenue receipt, take it to the closing balance sheet. Take it to the closing balance sheet. Not all, sorry, capital receipt. Not all capital receipts are taken to the closing balance sheet. Suppose I have sold one asset. I have sold one asset. It is not shown on the liability side of balance sheet, na? It is not shown on the liability side of balance sheet. Okay, balance sheet, asset side or liability side. Observe. Next, revenue receipts are there. Revenue receipts are there. Here we prepare income and expenditure account, na? Here we prepare income and expenditure account. All revenue receipts, all revenue receipts are taken to the credit side of income and expenditure account. All revenue receipts are taken to the income and expenditure account. After bringing the revenue receipts to the income and expenditure account, we have to do certain adjustments. Sir, what are those adjustments, sir? Receipts and payments account records receipts irrespective of its year. Its year relating to. Receipts and payments account records all receipts whether they are relating to current year or previous year or next year. Irrespective of the year, it records the receipt because receipts and payments account records only receipts, na? It is receipt, sir. Yes, sir. I don't mind whether it is relating to current year or previous year or next year. I don't mind, sir. Okay, record it first. From there, you bring that revenue receipt to the income and expenditure account. After bringing revenue receipt to the income and expenditure account, do certain adjustments. If any cash paid relating, if any expense paid relating to the previous year minus, you have to remember only one thing. In the income and expenditure account, we show only current year expense and incomes. Current year expense and incomes. This is the fundamental rule. Current year expense and incomes. Expense may be paid or payable. Expense paid shown in the receipts and payments account, but incomes received are shown in the receipts and payments account. But what about expenses payable and incomes receivable, given as additional information? Given as additional information. Hope you are following, students. Next, receipts and payments account, credit side. Credit side. By capital expenses, by capital payments or capital expenses. Suppose I have purchased one building. We have purchased one building. It is my capital payment. What's the entry I record? Bank account, sorry, building account debit to bank account, receipts and payments account. Capital payment, or I have repaid the loan. Loan account debit to bank account. Or I have purchased any asset, furniture account debit to cash or bank account. All these are, all these are capital payments. All these are capital payments, do remember. Next, all these capital payments we have to show closing balance sheet asset side based on the situation, right? Next one, credit side we write by revenue expenses. Revenue expenses, observe carefully, revenue expenses. Revenue expenses, right? All revenue expenses are taken to, all revenue expenses are taken to income and expenditure account debit side. All revenue expenses are taken to income and expenditure account debit side. After bringing these expenses into income and expenditure account debit side, now what we have to do is we have to do certain adjustments. We have to do certain adjustments. This is how we prepare income and expenditure account. Observe carefully. Is it clear, students? Now we try to solve one problem. Then after you can understand. Clear? Now look at. The procedure of solving this problem also similar to our final accounts problem. That's why there is a similarity between preparation of final accounts of sole proprietorship and okay, look at here, and incomplete records and NBO. Three are preparation of financial statements, but final accounts of sole proprietorship, final accounts of incomplete accounts from incomplete records, both are similar nature. But here also preparation of final accounts of not for profit organization, that's it. But the procedure, the method is similar. Look at illustration 4 first. Following is the receipts and payments account of New Bird 40 Club for the year ended 31st March 2022. Look at first one, they have given receipts and payments account. Identify opening balance, closing balance first. So this is opening balance, sir, and this is closing balance, sir. Opening balance is shown on the debit side of opening balance sheet. Closing balance is shown on the credit side of closing balance sheet. Clear? Now, after the receipts, next, what is the next step? Identify whether it is a capital receipt or revenue receipt. Now look at subscription. Subscription always revenue receipt. Identify the year, because already I said receipts and payments account records all receipts and payments irrespective of the year it is relating to. Means it may be relating, the receipt or payment may be relating to current year or previous year outstandings or next year incomes also received in advance. But in the income and expenditure account debit side, we have to show all expenses relating to current year, whether they are paid or payable. Here we ignore previous year items, next year items. At the same time, incomes relating to current year, yes, record it irrespective whether they are received or not. And here we ignore previous year incomes, receivable, future incomes already received. Here we ignore. Only current year items we show. Okay, is this logic simple? Yes, sir. Now look at First, receipt side, identify whether it is capital receipt or revenue receipt. First, subscription is always revenue receipt. Here, year. They said 31st March 2022. What is the current year? What is the current year? 21, 22 is the current year. 21, 22 is the current year. Here they said 2021 means it is previous year. 2021 means previous year. 21, 22 is current year. In our income and expenditure account, we take only 3,55,000 current year receipt. To this, we add still receivable. Okay, now look at subscription. How much amount? Straight away, you can take 3,55,000 or put together how much? Put together how much? Tell me. 65,000 plus 3,55,000. How much? 4,20,000. Here, what they are doing is they are taking total amount first. Okay. Out of this total amount, how much amount relating to previous year? Sir, 65,000 relating to previous year. Here itself you can identify, na? Yes. Deduct that 65,000 rupees. Deduct that 65,000 rupees because it is relating to previous year. Yes, sir. Next one. Wait for other information. Next to donations. Donation 55,000 is given. Okay. Now look at if any specific information given relating to donation, then do accordingly. Otherwise, simply take it to the credit side of income and expenditure account. 55,000. Just a minute. By donation 55,000. Next one. Entrance fees. Generally, entrance fees is capitalized. Means taken to the balance sheet. It is treated as capital receipt. Unless and until they specify anything, it is treated as capital receipt shown on the liability side of balance sheet as an addition to the capital fund. If anything specified in the problem, do accordingly. They said capitalize 50% of the entrance fees. Means remaining 50% they said take it as income. P&L account, sorry, income and expenditure account credit. Out of 85,000, half amount means 42,500. 42,500 here. Is it clear, students? Yes, it is completed. Now, receipts all completed? Yes, sir. Now come to payment side. Salaries and wages. Payment, na, straight away take it to the revenue expense. Straight away take it to the income and expenditure account debit side. 1,65,000. Look at any adjustment is there. Outstanding salaries and wages. 40,000 for the year ended 31st March 2022. Current year outstanding, yes, add 40,000. Total salaries to be shown in the income and expenditure account 2,05,000. Hope you are following. Next one, office expenses. This is revenue expense. Show it on the debit side 35,000. So here you have to identify whether it is revenue expense or capital expenditure. Next one, sports equipment. Sports equipment is asset. Purchase of sports equipment is asset. But they said depreciate sports equipment by 25%. So 3,42,000 into 25%, that comes 85,500. And remaining amount balance sheet asset side. Hope you are following, students. Next one, telephone charges, revenue expense. Take it to the income and expenditure account. Telephone charges. If any outstanding is there, add. Out of these telephone charges, if any amount paid in the previous year, minus. Next one, electricity charges, revenue expense. Income and expenditure account debit side. Next, traveling and conveyance, revenue expense. Income and expenditure account debit side. Is it clear? Now, closing balance. Already I said closing balance sheet asset side. That's it. Every item from receipts and payments account considered. Now look at additional information. Outstanding subscription for the year 55,000. Still subscriptions receivable for the year 55. In our income and expenditure account, we show subscriptions relating to current year only. Now subscriptions relating to current year, how much? Received 3,55,000. Still receivable 55,000. Total becomes 4,10,000. So here what we can do, instead of taking 4,20,000, straight away you can take 3,55,000. Straight away you can take 3,55,000 plus 55,000. Total 4,10,000 you can show outer column. The same they did here. Look at here, they have taken total subscription received. From that, they deducted previous year subscriptions, current year subscriptions added. That's it. Next, outstanding salaries completed, depreciate sports equipment completed, capitalize 50% of the entrance fees completed. Prepare income and expenditure account of the club from the above particulars for the year ended 31st March 2022. This is how we prepare income and expenditure account. In some problems, the items are more. The logic is same, but this receipts and payments account contains more number of items and additional information contains more information, but the process is same. From the income and expenditure, from the receipts and payments account, we identify whether it is a capital receipt or revenue receipt. All the revenue receipts taken to the income and expenditure account credit side. After bringing the revenue receipt, do certain adjustments. Still current year receivable, add. We received previous year amount, minus. We received next year amount, minus. Do all these adjustments. Next, out of the payments, identify revenue expenses and capital expenses. All revenue expenses, first bring it to the income and expenditure account. After bringing the revenue expense to income and expenditure account, check when any other still outstanding expense is there, or any expense we have paid from current year, previous year outstanding paid in the current year, minus. If any prepaid expense is there, minus. Same logic which we have followed in case of sole proprietorship final accounts. Is it clear, students? Yes, sir. Next, this is simple problem. Yeah, this problem we have to discuss. Illustration 6, preparation of subscription account. Most of the students, they get confusion here. Why? Because lack of clarity on concept. Now look at concentrate illustration 6 so that you get clarity on subscription. Next, during the year ended 31st March 2022, the subscriptions received by the Jaipur Literary Society 4.5 lakh. First of all, what is the entry we record? Bank account debit to subscription account. What is the entry we posting by bank account 4.5 lakh? Is it clear here? Yes, sir. 4.5 lakh. Next one. These subscriptions include 20,000 received for the year ended 31st March 2022. We are in which year? 21-22. They said 20,000 relating to previous year. For the previous year subscriptions outstanding, what is the entry you have been recorded in the previous year itself? Subscription receivable account debit to subscription account. As on 31st March 21, what is the entry you have been recorded already? Subscription receivable account debit to subscription account. This is the closing entry we have recorded, or adjusting entry we have recorded. Adjusting entry. Whatever the adjustment entries you have recorded on 31st March 2021, they become reverse in the immediate financial year, that is 21-22. Whatever the adjustments you have recorded in the previous year 31-3-2021, they become reverse at the beginning of the new financial year 21-22. So what is the entry recorded for outstanding subscription? Subscription receivable account debit to subscription account. When it comes to 21-22, this becomes reverse entry. Subscription account debit to outstanding subscription 2021 20,000. Here students will face difficulty. Observe carefully. Next one. On 31st March 2022, subscription due but not received were 15,000. 31st March 2022, still we have to receive subscription. Then what is the entry we record? Subscription receivable account debit to subscription account. Subscription account credit side by subscription receivable. How much? 15,000. Next, advance subscription received for the year ended 31st March 2022 but pertaining to year 2023. Current year we received some subscription amount, but it is relating to the next financial year. Then what is the adjustment entry we record? Subscriptions account debit to subscriptions received in advance account. Adjusting entries now. So subscriptions account debit to advance subscriptions 2023 26,000. Next one, the subscriptions received in advance for the year ended 31st March 2021. Previous year we received in advance. Relating to current year 21-22. Previous year, what is the entry you have recorded? Same, subscription to subscription received in advance. Now, the same entry becomes reverse in 21-22. That is subscription received in advance account debit to subscription account. Here by advance subscription 21. After writing all these things, now you balance subscription account. Automatically you get how much amount to be transferred to the income and expenditure account. Credit side, all subscription received plus adjustments. Debit side, subscriptions adjustment. Remaining amount nothing but amount to be transferred to the income and expenditure account. This is important. Sometimes in the examination problems they may ask you differently. Means they will not give you how much subscriptions received in the current year. They will not give you how much subscriptions received in the current year, but they give you how much amount to transfer to. They give you how much amount to transfer to income and expenditure account. In that case, you balance reverse. First total debit minus total credit, then you get how much cash received during the year as subscription. This type of problem you may get for 4 marks, or the same information may be given in the problem, 10 marks or 12 marks problem. Same information may be given in the 10 marks or 12 marks problem. Clear everybody? Now look at illustration 7. Illustration 7, not illustration 7. Yeah, illustration 8 observe. Illustration 8 observe students. The following was the receipts and payments account of X Club for the year ended 31st March 2022. Okay, this is the receipts and payments account. Now identify which items are taken to income and expenditure account, which items are taken to closing balance sheet, which items are taken to opening balance sheet. When opening balance sheet is prepared, when the opening capital fund is not given. When the opening capital fund is not given, then we need to prepare opening balance sheet. When opening capital fund is given, you need not to prepare any opening balance sheet. Fine. First item, cash in hand. Cash in hand taken to the opening balance sheet. Taken to the opening balance sheet. If you want, I will show you. Yes, balance sheet on 1st April 2021. Opening balance sheet. Cash 100. Next one, balance at bank as per passbook. Balance at bank as per passbook. Deposit 2230. Current account 600. Bank interest. Okay, only these two balances. Only these two balances. This is very, very important, students. This problem now, when we was in CA IPCC in 2010, same problem carried since 2010 or previous also. Okay, earlier this chapter is there in IPCC, now they shifted to CA foundation. The same problem is carrying. Here you can, if you observe, this balance is as per passbook. Generally in our books of accounts, we show the bank balance as per our cash book. After preparing BRS, what we do, we find the ultimate balance as per our cash book and we show it in the receipts and payments account or in the balance sheet. But here, which balance they have given? Balance at bank as per passbook is given. Passbook balance is given. But in our books of accounts, which balance we have to show? Cash book balance. Cash book balance. Bank balance as per cash book. Bank balance as per cash book. Here also closing balance is given as per passbook. Observe. Deposit account we cannot say anything, but this current account compulsorily we have to do certain adjustments for this current account balance, And finally, we show bank balance as per our cash book. Very, very important, students. Now, deposit account balance, straight away we can take it to the opening balance sheet 2230. But whereas if you observe current account balance, they have shown only 300, whereas here they said current account balance is 600. But this 600 is as per passbook, but we need as per cash book. That means we have to do certain adjustments. Wait for some time. When adjustment comes, I will explain. Next, bank interest. Bank interest. Bank interest is income for us. Income and expenditure account to credit side. Bank interest 30 rupees. Means there is some adjustment. That adjustment we try to solve. Next one, donations and subscriptions. Donation and subscriptions. If nothing is given about donations, but here they have mixed subscriptions, now straight away take it to the income and expenditure account 2600. 2600. They have did some adjustment, I hope. Okay, what I will do is 2600 na. Okay, here I will write separately 2600, so that any adjustment is there, we do accordingly. Next, receipts from T's. It is income, so P and L, income and expenditure account credit. Receipts from T's 300. Here they shown 250 rupees. It may be expense. Wait for some time. Contribution to fairs. It is receipt, so credit side. Just a minute. Yeah. Here observe, contribution to fairs. Actually, it is income, but what they did here, they deducted it from expenses. So net expense how much? 300. You can do one thing. Contribution to fair you can show as income on the credit side. Expenses you can show on the debit side. No problem. Next one. Sale of equipment. We sold equipment for 80 rupees. Amounts in thousands. Okay. Take it 80. What we have to do here? Prepare equipment account. Prepare equipment account roughly. You can prepare equipment account roughly and write down the sale proceeds on the credit side, because this is asset account, no? Equipment account, credit side. Next, net proceeds of variety entertainment. Net proceeds of variety entertainment. It is revenue income, so that credit side of P&L, sorry, income and expenditure account 780. Next, donations for forthcoming tournament. Donations for forthcoming tournament. So these donations are specifically for tournament, so that these are taken to the balance sheet. These are taken to the balance sheet. Look at tournament fund donation 1000 rupees. Tournament fund donation 1000 rupees. Very, very important. Next one. With this, debit side items are completed. Now come to credit side items. Except 600 rupees, remaining every item is completed. Now come to credit side. Groundman's fee. It is revenue expense. Come to debit side here. Write down groundman's fee. Next one. 1500 moving machine. Moving machine is nothing but this is the machine which is used to clean the grounds. Okay. Right. This is asset. This is asset. Balance sheet asset side. Look at. Balance sheet asset side. Observe. Yeah. Machinery and equipment they have added. 1500 machinery. We see 250 rupees how they have added. Next. Rent of ground. Rent of ground is expense na. So P and income and expenditure account to debit side. Rent of ground 250. Next. 400 fares. Contribution for fares na we have. So 400 is the total expense, but we received some donation 100 rupees contributions, and the remaining amount is 300. Net amount we have incurred 300 rupees. Next, 280 printing and stationery. Printing and office expenses 280. Printing and office expenses 280. Write down here. We see how the difference is. Next, repairs to equipment 500. repairs to equipment 500, repairs. Here they have shown 460. Sir, 500 na sir. So why they are showing 460 sir? Wait for some time. I will explain. Next, honorarium to secretary and treasurer 2021. It is relating to 2021 year. Means previous year outstanding liability we have paid in the current year. Means this comes in opening balance sheet or opening balance sheet liabilities side. Honorarium 400. Honorarium 400. Clear? Next one. Next, balance at bank as per passbook. Deposit account 3090. Deposit account 3090. Show it as it is on the asset side of balance sheet. Deposit 3090. And 150 rupees current account balance. Wait for some time, because we need to do certain adjustment. Cash in hand 250. Show it as it is 250 rupees cash in hand as an asset. Yes. Now come to the important adjustments. Here they have given April 1st 2021, March 31st 2022. April 1st 2021, March 31st 2022. Look at subscription due. How much subscription due? 150. This is shown first on the asset side of opening balance sheet, 150. And the same 150 rupees we receive in the current year na? Yes sir. Same 150 rupees we receive in the current year. Yes sir. Means that should be deducted. That should be deducted. 2600 subscriptions received. From that 150 rupees you deduct, because it is relating to previous year. Okay. Now what is the relating amount to the current year? 100. Means 2000. How much here we get? 2450 plus 100 rupees relating to current year na. So total amount 2550 subscription we show on the credit side of subscription account. That means income and expenditure account. And 100 rupees still receivable na. Balance sheet asset. 100 rupees still receivable. Next, amount due for printing 100. Actually, how much amount paid for printing? Amount paid for printing is 280. Observe carefully. Amount paid for printing is 280. Out of this, what is the expense relating to the previous year? 100. It is relating to previous year. How can we show in the current year? Ignore. So 180 rupees. And still receivable for the current year 80. So 180 plus 80, 260. 180 plus 80, 260. Total 260 rupees we show on the debit side of income and expenditure account. And what about outstanding amounts? Closing outstanding liability. Closing outstanding liability. Printing 80. And opening liability. Outstanding expenses. Here they have given outstanding expenses and honorarium. Outstanding expenses 100. 400 plus 100, 500 total. Clear? Next one. This one is very, very important, students. Checks unpresented being payment for repairs. You take BRS here. You take BRS here. We have balance as per passbook. We have balance as per passbook. How much? 600. Passbook balance, how much we have? 600. If you observe, 300 rupees checks we have issued. 300 rupees checks we have issued, but not presented. But not presented. What we do? Checks issued but not presented. From passbook balance, what we do? We deduct na. Checks issued, cash book balance decrease, we deduct. Now, as per cash book, what is your bank balance? 300 rupees. The same 300 rupees originally we show here. Cash in current account 300. This is the logic. 600 rupees originally as per passbook we have. Checks issued but not presented, minus 300. Now what is bank balance as per your cash book? 300, sir. Here I have shown. Look at. Next one. Here checks issued but not presented, sir. 260. Okay, wait. As per passbook, how much is your balance? 260, sir. Checks issued na. Checks issued. Sorry, not 260. Just a minute. As per passbook, what is your balance? Tell me. As per passbook, what is your balance? 150. As per passbook, what is your balance? 150. Checks issued but not presented means 260 minus. Checks issued, cash book balance decrease. If you see bank balance as per cash book, it is negative. It is negative. Why? Because checks are not presented. Checks are not presented. So this 150 rupees negative balance we show as overdraft in the closing balance sheet, 120 bank overdraft. Is it clear, students? Next observe carefully. Here they have given repairs to equipment 500. Repairs to equipment 500. Okay. 500 rupees total amount paid. But out of this, already relating to previous year, how much? 300 rupees. Checks I have issued, but checks presented in the current financial year. Checks presented in the current financial year. 300 minus 500 minus 300. How much we get? 200 rupees. Still for 260 rupees. Still for 260 rupees, checks not presented. Means this also relating to current year 260. Total 460 rupees we consider as repairs to equipment. The same 460 they showed on the debit side of income and expenditure account. Very, very important. Next one. Next, estimated value of machinery and equipment. Opening machinery is how much? 800. Closing machinery is how much? 1750. 800 opening balance sheet asset. During the year we have purchased for 1500. Now total we should have 2300. During the year we have purchased a moving machine. Now 1500. So 2300 total. But how much amount they have shown? 1750. How much amount we have shown? 1750. Closing balance. Difference of 250 plus 300, 550 rupees. Depreciation. Depreciation. Look at 550. Yes or no? And we sold equipment now. We sold equipment now, and that is deducted. We sold equipment and that is deducted. Observe carefully. Is it clear, students? Yes. Now look at remaining amount 470 rupees. Is it clear? Right, sir. Next one. Next one. Interest not yet entered in the passbook. Interest not yet entered in the passbook. Okay, 20. But what we do? We consider it still receivable, na? Interest still receivable 20 rupees. Total 50 rupees. Next, bonus to groundmen outstanding. Still bonus is payable 300. Okay. This 300 is liability for us. Yes, 300 bonus to groundsman. Next one. That's it. For the year ended 31st March 2022, the honorarium to the secretary and treasurer are to be increased by total of 200. Already how much amount we have paid here? 400 rupees. Now this year we are increasing the amount. So total 600 is payable. Total 600 is payable. Look at honorarium, how much amount is payable? 600. Bonus to groundmen we have to show as expense also. And this 600 becomes current year liability. 600. Next. That's it. Prepare the income and expense account and balance sheet for the period ended 31st March 2022. This much of work we have to do. Clear, everybody? Right. Now look at the next problem. Illustration 9. Illustration 9. Observe carefully. Illustration 9. The Sport Writers Club gives the following receipts and payments account for the year ended 31st March 2022. What is this? Receipts and payments account. Opening balance, already I said, show it on the asset side of opening balance sheet. Subscriptions, take it to the credit side of income and expenditure account. Credit side of income and expenditure account. Subscription, working note. We have to do certain working note. Next one, miscellaneous income, take it to the income and expenditure account, credit side, 700. Next one, interest on fixed deposit, take it to the credit side of income and expenditure account, interest on fixed deposits, 2000. Over. Now credit side, salaries, take it to the income and expenditure account, debit side. Rent and electricity, income and expenditure account, debit. Library books, asset, students. Closing balance sheet, asset side. Magazines and newspapers, income and expenditure account, debit side. Magazines and newspapers, income and expenditure account, debit side. Next one, sundry expenses, income and expenditure account, debit side. Sports equipment, asset, balance sheet, asset side. Balance C by D. This is closing balance of cash and bank. This is closing balance of cash and bank. Show it on the asset side of closing balance sheet. Next, figures of other assets and liabilities are furnished as follows. Look at other assets and liabilities. Salaries outstanding 710 at the beginning of the year. Current 110, 170. What we have to do? Salaries 12,000 a total. 12,000 paid. Out of them 710 relating to previous year plus 110 relating to current year. Difference amount, you can calculate difference and show it on the debit side of income and expenditure account. Next, outstanding rent and electricity. Outstanding rent and electricity. Already paid how much? 7,220. Relating to previous year 864. Current year relating 973. Income and expenditure account. And what about this 710 and 170? 710 opening balance sheet, 170 closing balance sheet, 864 opening balance sheet, 973 closing balance sheet as liabilities. Outstanding for magazines and newspapers. Already paid how much? 2172. 2172 paid. Out of that 226 previous year, current year 340. Current year 340. Difference amount income and expenditure account. 226 outstanding liability closing balance sheet, 340 outstanding liability, 226 opening balance sheet, 340 closing balance sheet. Next, fixed deposits 10% with bank. 20,000 asset, opening balance sheet asset, closing balance sheet is also asset. Since fixed deposits we have from the beginning of the year, total interest receivable 20,000 into 10%, 2,000 rupees interest receivable. 2,000. But look at how much interest received. 2,000. Okay. How much interest received? 2,000 plus how much interest receivable? Just a minute. Interest accrued thereon. Total interest received during the year 2000. Previous year receivable, opening balance sheet asset, deduct. Plus current year still receivable 500. Total becomes 2,000. And this 500 opening balance sheet asset, this 500 opening balance sheet liability. Next, subscription receivable. Already subscriptions received how much? Already subscriptions received 28,600. Still relating to previous year 1263. Relating to current year 1575. That's it. 1263 is shown in the opening balance sheet. 1575 shown on the in the closing balance sheet asset side. And this whatever I am writing in the brackets, that is shown on the debit side of income and expenditure account. First one, second one, third one and fourth one. First, second, third. Fourth one, interest accrued and subscription, income and expenditure account credit side. Next, prepaid expenses. Look at the expenses here. Sundry expenses, how much paid? 10,278. Already outstanding relating to previous year 417 minus 417. Relating to current year 620. Difference amount income and expenditure account debit side. 417 and 620. 417 and 620. Shown on the liability side, asset side of balance sheet. 417 opening balance sheet, 620 closing balance sheet. Furniture 9,600 opening balance sheet. During the year furniture purchased, not purchased. Okay. On furniture we have to provide depreciation. Look at the closing values of furniture and sports equipment are to be determined after charging depreciation 10% and 20% per annum. Furniture 9,600 into 10%, 960. Income and expenditure account, depreciation on furniture 960. Remaining balance balance sheet. Next, sports equipment 7,200. If you observe, 7,200 sports equipment we have beginning of the year, and 1,000 sports equipment we have from the we have purchased during the year. Total sports equipment is 8,200. 8,200 into 20%, na? 8,200 into 20%, 1640 is the depreciation on equipment. From 8,200, 1640 deduct, show the remaining amount on the asset side of balance sheet. Next one, library books. Actually, library books, how much we have? 5,000. During the year, we have purchased library books for 1,000. So 5,000 first opening balance sheet. 5,000 plus 1,000 That is equal to total 6,000 rupees we have to show on the asset side of closing balance sheet. But what they said, look at, if any during the club library books are revalued at the end of every year, and the value at the end of March was 5,250. Actually library books we should have 6,000 now, but how much we have? 5,250. Whatever 750 depreciation, and this depreciation is nothing but 750 over. This is opening balance sheet. Balance the opening balance sheet. We can calculate capital fund. This is taken to the closing balance sheet. Capital fund 47,000. Now balance income and expenditure account. We get either surplus or deficit. Either surplus or deficit. In this problem we have deficit. Excess of expenditure over income. This is deducted from capital fund. After that, show one by one asset. Now balance. You get the same total total assets, total liabilities. Now working notes, observe. Here whatever we have done, all these things they have done as a working note. Look at this working note. That's it. Now look at illustration 10. Observe illustration 10. This is another important problem. First one, the income and expenditure account of youth club. The income and expenditure account of youth club for the year 2022 is as follows. Look at one by one. This is income and expenditure account. From this income and expenditure account, which account we have to prepare? Receipts and payments account and balance sheet. Observe, second type of problem. Prepare receipts and payments account for 22 and balance sheet at the year end. Here whatever the previously whatever the approach we have followed, now simply this is quite opposite. Sir, what is that quite opposite, sir? Income and expenditure account, debit side, what we write? Expenses relating to current year. That too paid, payable. Paid plus payable. Here it is, here in the on the credit side of income and expenditure account we write income relating to current year only, income received or income receivable. Income received and income receivable. Observe carefully. But when we are preparing receipts and payments account now, what we need? We need only paid and received. Paid means expense actually paid. Income means income actually received. Expense may be paid relating to current year or previous year, or sometimes it may be prepaid expense also. Incomes received may be relating to current year or previous year or next years also. So by taking the expenses paid and incomes received from income and expenditure account, we have to do certain adjustments. And from additional information, we have to identify what is capital receipts and what are capital payments. Because capital receipts information, capital payments information, income and expenditure account does not disclose. Is it clear, students? That's why we have to identify capital receipts and capital payments from additional information. By taking capital receipts and capital payments from additional information, we prepare this receipts and payments account. It is quite interesting. Incomplete records problem, NPO problem, these are quite interesting. Now look at how do we solve that. Observe illustration 10. Here identify, see here all expenses are revenue expense, all incomes are revenue incomes. Is it clear? Now look at salaries. This is expenditure na. All the expenses we have to take it to the receipts and payments account credit side. And in the income and expenditure account, we show cash expenses plus non-cash expenses. I repeat, in income and expenditure account, we show cash expenses, non-cash expenses also. Cash expenses and non-cash expenses. Yes sir, no students? Yes sir. Now salaries, cash expense. General expenses, cash expense. Audit fee, cash expense. Secretary honorarium. All these items straight away take it to the credit side of income and expenditure account. If any item requires adjustment, then we do accordingly. Otherwise, straight away the same amount is written on the credit side of receipts and payments account, or payments side of receipts and payments account. Stationery and printing, annual dinner expenses, interest and bank charges, depreciation. Yes, it is non-cash expense. It is not taken non-cash expense. It is not taken to the income receipts and payments account. It is taken to the concerned asset account. If you are preparing any asset account, this depreciation we take. Surplus. Surplus is not taken to the receipts and payments account. Surplus is added to the capital fund in the balance sheet. This is the care you have to take. Next, by subscription. Subscription received na receipts and payments account debit side. Entrance fees received na receipts and payments account debit side. Contribution for annual dinner, receipt. Annual sports meet, receipts, receipt. All these are receipts. By taking these amounts, we do certain adjustments from other information. Look at the other information. This account had been prepared after the following adjustments. How this income and expenditure account is prepared after following these adjustments? Look at subscriptions outstanding at the end 2021, previous year. Just a minute. Yeah, 2022 na. Yes, current year 2022. This is previous year subscription outstanding. Subscription received in advance on 450. Subscription received in advance on 31st December 2022, 270. Subscription outstanding on 31st December 2022, 750. By using this information, we prepare subscription account first. Subscription account first. Look at how subscription account looks like. Okay, I will prepare subscription account, just you can observe. Subscription account. Look at, already they have given subscription in the income and expense account. How much? 7,500 to income and expenditure account, 7,500. Okay, now they are saying at the end of 2021 it is outstanding. So what is the entry we have been passed in the last year? Subscription receivable account debit to subscription account. This becomes reverse in the current year. So how can we write? To subscription account debit to outstanding subscription 2021, 600. Next one, previous year we have received in advance 450. Previous year we have received in advance. What is the entry we have been recorded? Subscription account debit to subscription received in advance. Now this becomes reverse. Means in the subscriptions account we write credit side by subscriptions received in advance. How much? 450. Over. Next. Subscriptions received in advance on 31st December 2022. Current year, what is the adjustment entry we record? Subscriptions received, subscriptions account debit to subscriptions received in advance. So here we write to subscriptions received in advance. How much? 270. That's it. Next, subscriptions still outstanding in the current year, 750. For this, what is the entry we record? Subscriptions receivable account debit to subscriptions account. So by subscriptions receivable 750. Hope you are following. Yes sir. Now balance this account. 600 plus 7,500 plus 270, 8,370 minus 450 minus 750. How much here we are getting? 7,770. It is nothing but by bank or receipts and payments account. This is the actual amount of subscription we received during the year, and this is taken to the income and expenditure account credit side. Observe carefully. Yes. Here they have done total debit side. Finally, how much amount they have found? 7,170. Clear, students? Next one. Salaries outstanding at the beginning and at the end of the year, respectively 400 and 450. But here they have given salaries paid 4,750. Okay. But beginning, how much salaries we have to pay? 400. Means current year they reduced. Na? Current year, when they are showing it on the debit side of income and expenditure account, they reduce 400. So now we add back 400 rupees because we want to know how much of salaries actually paid. This 450 relating to previous year at the time of preparation of, at the time of preparation of, just a minute, at the time of preparation of income and expenditure account, this 400 is deducted. Now we add back. And at the end of the year, how much is outstanding? 450. At the time of preparation of income and expenditure account, this 450 is added. This 450 is added. This 450 is added in the income and expenditure account. Now what we have to do? We have to deduct. We have to deduct 450. That's it. 4,700 is the remaining amount. Next one. General expenses include insurance prepaid to the extent of 60. General expenses include insurance prepaid to the extent of 60. How much general expenses paid? 500. This includes prepaid insurance, na 60 minus. Sorry, earlier they have reduced this 60. Now we add back. Total how much we get? 560. And this 60 rupees prepaid insurance, again we show it on the asset side of balance sheet. Next one. Audit fee for 2022 is as at unpaid. Audit fee is not paid, but in the income and expenditure account they said audit fees is paid but not paid na. So this is not taken to the receipts and payments account. During 2022, audit fee for 2021 was paid amounting to 200. Here whatever the audit fees paid, it is relating to current year, but they said 2021 audit fees is paid 200. It comes in receipts and payments account. It comes in receipts and payments account. Observe carefully. Next one. The club owned a freehold lease of ground valued at 10,000. The club owned a freehold lease of ground valued at 10,000. Okay. The club had sports equipment on 1st January opening na. So freehold lease, opening balance sheet asset, closing balance sheet also asset. Next, the club had sports equipment, opening balance sheet asset 2,600, closing balance sheet also asset. But observe, did we purchase any sports equipment? No, not yet. Okay, fine. Next one. At the end of the year, after depreciation, the equipment amounted to 2,700. Means here if you prepare sports equipment account, debit side opening balance we have 2,700, closing balance we have 2,700, 2,600 debit, 2,700 credit. During the year we have provided depreciation 300. Depreciation is written on the credit side. Means total credit 3,000. Total debit 2,600. Debit side 400 rupees. They are showing less amount. It is treated as purchase of sports equipment. Purchase of sports equipment 400. So it is a payment for us. It is a payment for us. Purchase of sports equipment. Look at sports equipment purchased 400. This is how we have to see one by one item. This is how we have to see one by one item. Is it clear, students? Next one. The club has raised a bank loan of 2,000 in 2021. In 2021, the club has raised a bank loan of 2,000. Means 2021, if you prepare 2021 balance sheet, this becomes liability. Now check whether this liability is paid or not. If it is not paid, na closing balance sheet also this liability comes. If it is paid, then it comes in receipts and payments account credit side, bank loan repaid. This was outstanding throughout 2022, means loan not repaid. This comes in closing balance sheet also. This comes in closing balance sheet also. And 31st December 2022, cash in hand amounted to 1600. 31st December 2022, closing. So closing cash is how much? 1600. Go to closing balance sheet and show it here. 1600. Now if you prepare receipts and payments account, na, but in the entire problem, they did not give any opening balance of cash. They did not give any opening balance of cash. Now if you balance this receipts and payments account, now whatever the balance you get, that becomes opening balance. And this opening balance, we take it to the opening balance sheet. This opening balance, we take it to the opening balance sheet. There we find capital fund. That capital fund is taken to the closing balance sheet. Now the closing balance sheet gets closed. That is total. This is how we solve this type of problem. Next, yeah, next look at, we try to solve. Educational institution is a biggest, very big problem, students. If you get this type of problem, na, it is better to take it as choice. Why? Because it is time consuming. Sometimes earlier, na, before 2024 June attempt, they might give you NPO problem for 20 marks. NPO problem alone for 20 marks. In that case, that very lengthy problem. Very lengthy problem. In that case, it is better choice to take this problem as choice. It is better to take this problem as choice. Okay. And now we try to see RTP ones. Let us check RTP ones. Which type of problem they have given? Look at RTP. See, financial statements of not-for-profit organizations. From the following receipts and payments account of finance professionals club. Receipts and payments account they have given. Here what we have to do? Opening balance, take it to the opening balance sheet. Closing balance, take it to the closing balance sheet. Receipt side, identify whether it is capital receipt or revenue receipt. Payment side, identify whether it is capital payment or revenue payment. That's it. Look at cash in hand, cash at bank. Both are taken to the credit side of, asset side of opening balance sheet. Next, closing balances are taken to the closing balance sheet. Next, one by one, look at subscription. Subscription is revenue receipt. Take it to the income and expenditure account credit side. Take it to the income and expenditure account credit side. 22,86,000. Next, what is the next item? Donations. Donations. Donations, here they have given 10 lakhs 80,000. Look at the information about donations. Nothing is specified. Nothing is specified about donations. Now look at here. Here nothing is specified about donations. But if you observe, the amount is very big. That's why they have taken 10 lakhs 80,000 to the closing balance sheet. They have taken 10 lakh 80,000 to the closing balance sheet. Observe carefully. Where is the closing balance sheet? Okay, what is the requirement of the answer? Question. Income and expenditure account for the year ended 31st March 2024. As per the club rules, donations are to be capitalized and entrance fees is the income of club. They said donations are capitalized, means these donations are taken in the balance sheet. But entrance fees is income of the club, means we have to show on the credit side of income and expenditure account. Fine. That's why donations are ignored. Next, interest on investments. Income and expenditure account credit. Entrance fees. Entrance fees, just now they said it is treated as income of the business. It is treated as income of the business. So that income and expenditure account credit side. Entrance fees is shown on the credit side of income and expenditure account. Next, interest received from bank. Credit side of income and expenditure account. Credit side of income and expenditure account. Next, sale of old newspapers. Credit side of income and expenditure account as revenue receipt. Now look at salaries. Salaries 7,42,500. Salaries 7,42,500. Take it to the debit side of income and expenditure account. Stationery. Debit to the income and expenditure account. Billiard table. Billiard table is nothing but asset for us. Billiard table is asset for us. It's a sports club now. It's a professionals club. So there we have billiard table. So it's a game, no? You can see snooker type of game, right? Billiard table. So 8,70,000 750. It is asset. Go to balance sheet, asset side, show it on the asset side of balance sheet. Investments, asset side of balance sheet. Miscellaneous expenses, income and expenditure account debit. Furniture, asset side of balance sheet. Insurance premium, income and expenditure account debit. Cash in hand, cash at bank, over. Now look at subscription in arrears for the year ended 31st March 2024. 31st March 2024, beginning or closing? It is 31st March 2024, closing only. Closing only. Still receivable how much? 2,02,500. And subscriptions received in advance during the year 58,500. Means how do we do accounting for this? Simple. How much subscription total? 22 lakh 86,000. Still receivable how much? Still receivable 2 lakh 2,500. 2 lakh 2,500 minus received in advance 58,000. Deduct and finally whatever the amount we get, this is shown on the credit side of income and expenditure account. Observe. Subscription 22 lakh 86,000 plus 2 lakh 2,500 minus 58,500. Next one. Insurance premium prepaid 4,500. They have given insurance premium paid how much? 40,500. Out of that 4,500 is prepaid. So 5,600 is considered as current year amount and 4,500 is deducted. Look at insurance. 40,500 minus 4,500. And this 4,000 rupees is shown on the asset side of balance sheet. Next. The details with respect to stationery of accountants club is as follows. Look at stock of stationery, opening balance 7,500, closing balance 45,000. Opening balance 7,500. This is very, very important, students. The total information is relating to how much of stock of stationery consumed. I repeat, how much of stock of stationery consumed during the year. We need to calculate by using this information. Observe here, opening stock is 7,500, closing stock is 45,000. We have to prepare some working note. Look at stationery account. Opening balance 7,200, closing balance 45,000. At the same time, they have given creditors for stationery 3960. So here also prepare creditors account. Opening balance 39,000 credit, closing balance 60,000 debit. And also they have given here advance paid to for stationery purchased during the year. We have paid some advance amount. Advance amount is deducted. Look at some advance amount we have paid. Advance paid for stationery purchased 10,500. Clear? Now look at. Observe carefully. From these two accounts, creditors for stationery and stock of stationery, now we calculate how much stock of stationery consumed. If you observe the receipts and payments account, they said amount paid for stationery 1,34,550. Entry creditors account debit to bank account. So 1,34,550. Automatically, if you balance the account, look at 1,34,550 plus 60,000. 1,34,550 plus 60,000. Total becomes a, sorry, just a minute. 1,34,550 plus 60,000. Total becomes 1,94,550 minus debit 39,000 minus advance 10,500. Total 1,45,050 rupees worth of stock of stationery we have purchased on credit. What is the entry we record? Purchases account debit to supplier account. Go to purchase of stock account, stock of stationery, debit 145.50. 145.50. Now look at this much of stock we should have. 7,500 plus 145.50, total 152,550. This much of stock we should have. But closing balance, how much we have? 45,000. Closing balance, how much we have? 45,000. Difference nothing but what? How much? 150 to 550 minus 45,000. This becomes 1,07,550 worth of stock of stationery we consumed. This is taken to the income and expenditure account debit side. 1,07,550. Observe carefully. Next, in this entire problem, this concept is very important. That's it. Over. Clear? Now you can balance this income and expenditure account, and it is surplus over expenditure. Surplus, excess of income over expenditure. And this working note is very, very important. Now observe, MTP1. MTP1, observe. Yes. NPO problem they have given. Following is the receipts and payments account. I think this is similar to, yeah, I think this type of problem we have discussed. Just a minute. Okay, we see, no problem at all. Yes, look at, following is the receipts and payments account. Following is the receipts and payments account of Messrs Rainbow Club for the year ended 31st March 2025. Look at, now we have to prepare what? Income and expenditure account only. No need to prepare balance sheet. It is given for 5 marks. So you have to complete this problem within 8 to 9 minutes. Okay, now look at one by one. Cash in hand not taken to income and expenditure account. Closing balance not taken to income and expenditure account. Subscription 67,500. Take it to the income and expenditure account. Take it to the income and expenditure account. Yes. Look at Messrs Rainbow Club. By subscription, they have given 70,500. Look at subscription adjustment. Subscription received how much? 67,500. Look at the adjustments for this. 750 relating to previous year minus 3,000 relating to current year plus subscription received in advance. Last year we received, na, it is relating to current year plus 1,500 received in advance relating to next year minus. After doing all the adjustments, finally we are getting 70,500. This 70,500 is credit. Is it clear? Next one. Donation 6,750. Look at what is any information given regarding to donation. Nothing is given. So that take it to the credit side of income and expenditure account. Next. Interest on investment at 6% for the year 4,500. Check how much of investments we have first of all. Nothing is given. Nothing is given. Means straight away take 4,200 as income. Straight away 4,300 as income. Over. Next one. Fashion show proceeds. Income. 75,750. They have directed expenses. You can do one thing. All incomes are shown 75,750 and expenses you can show it on the debit side 51,000. Next one. Payments for cosmetics. Wait for some time. Next, honorarium to beautician 12,000. Honorarium to beautician 12,000 expense debit. Next one. Salaries expense debit 27,000. Next, sundry expenses expense debit 1,500. Next one, rent for building 18,000 debit. Next one, fashion show expenses 51,000. It is deducted from fashion show receipts. So net receipts how much? 24,750 net income. Next, they have given additional information. Look at stock of cosmetics and amount due to cosmetics. Same, just now we have prepared stock of stationery. Na? Same manner we have to prepare stock of cosmetics and amount due to cosmetics as working notes. Look at working notes. Cosmetics consumed account. Opening balance 15, closing balance 10,500. Creditors opening balance and closing balance. During the year, how much amount paid? 22,500. It is given in the receipts and payments account now. Yes, sir. So that how what you can calculate purchases during the year, and this 27,000 take it to the cosmetics consumed account. Balance this cosmetics consumed account, and finally we can get how much of cosmetics consumed, 31,500. This concept is very very important, students. And this 31,500 is taken to the debit side of income and expenditure account. Finally, balance we got excess of income over expenditure. This is very simple problem. It may be given for 5 marks. Okay. Next, come to MTP2. MTP2 observe. Just a minute. MTP2 observe. Which type of problem they have given in MTP2? Yes. See, they have given receipts and payments account, and they are asking us to prepare income and expenditure account and the balance sheet. Income and expenditure account and the balance sheet. They have given it for 8 marks. Look at one by one. Already this type of problem we have not covered. Okay. So in this problem, if you observe, they have given opening balance of capital fund, so that you need not to prepare opening balance sheet. Yes or no, students? Yes, sir. Yes, sir. You need not to prepare opening balance sheet. Now look at one by one item. First, you draw income and expenditure account and balance sheet. First, you draw income and expenditure account and balance sheet. Then after, take one by one item. Subscriptions received 12,50,000. Subscriptions received 12,50,000. So credit to, and we have some adjustments. Look at, this is previous year now. Previous year subscription minus straight away. Current year subscription add straight away. That's it. Subscription received in advance. Previous year we have received subscriptions in advance relating to current year. What is current year? 24-25 means add. And during the year we received subscriptions relating to next year minus over. After doing all these adjustments, whatever the amount you get, show it on the credit side of income and expenditure account. And what about this 37,500? You need not to prepare opening capital fund na, so that you need not to show 1/4/2024 assets and liabilities in any balance sheet, opening balance sheet. No, nothing. So straight away this 55,000 rupees, take it to the asset side of balance sheet, closing balance sheet, and 17,500 liability side of closing balance sheet. Over. This is the information relating to subscription received. Next, donations raised for meeting revenue expenditure. Straight away take it to the credit side of income and expenditure account. Credit side of income and expenditure account. Observe. Yes. Donations 3,75,000. Next, interest on investments 9% per annum. We have received investments 9% per annum, 2,25,000. But observe how much of investments we have. How much of investments we have? Nothing is given relating to investments. Look at the additional information. Any investment information is given? No, sir. Subscription over. Stock, amount, value of equipment, building, nothing. They didn't give any investments opening balance. Then you people tell me, how can you get 9% interest on investments unless you have investments? Means here indirectly they are asking us, you calculate investments. Yes, sir. We have received 9% interest for 2,25,000. Make it 100%. 2,25,000 divided by 9%, 25 lakhs. Unless you have excuse me, unless you have 25 lakhs worth of investments, how can you get 9% interest? So 25 lakhs investments we have to show as an asset. As an asset, very very important here. Implied adjustment. Is it clear? Next one. Next one, charity show collection, income na credit side. You can deduct expenses and charity show total received 3,12,500. You can deduct expenses, or else 3,12,500 straight away show it on the credit side, and 37,500 show it on the debit side. Next, now come to credit side. Payment for medicine. Yes, just now we have discussed one adjustment. Cosmetics consumed. Previously we have discussed stock of stationery. Now here they are asking stock of medicine. Same treatment, students. Same treatment. Here you can see there are two things interrelated. Now here you have to prepare stock of medicine account and amount due to medicine supply account. Okay. Now look at, prepare those two accounts first. Medicines purchased during the year. Medicines purchased during the year. Medicines consumed during the year. Here they have given statement wise. You can prepare account wise. Here they have given statement wise, but you can prepare account wise, no problem. Right. Now look at. So how do we prepare account wise, sir? Simple. The same information we are presenting in account wise. Observe. What is the opening balance? Due 2,25,000. Liability na credit. What is closing balance? 3,25,000. Okay. Stock of medicine. Medicine opening balance. Yes, sir. 2.5 lakh. Medicine closing balance. 3,75,000, sir. During the year, how much amount we paid for medicine? 7.5 lakh, sir. That is taken to the debit side of this account. Now balance. Now balance and tell me. 7.5 lakh plus 325 minus 225. We got 8.5 lakh. This much worth of medicines we have purchased. Take it to the stock of medicine account, 8.5 lakh. So total stock of medicine we should have 11 lakhs. But whereas we have 3,75,000. So how much stock of medicine consumed? 11 lakh minus 375. So we have 7,25,000. 7,25,000 worth of stock of medicine we have consumed. Take it to the debit side of income and expenditure account. 7,25,000. Next one. Next, honorarium to doctors, 2.5 lakh. Look at any adjustment for honorarium, nothing. So that take it straight away to the debit side of income and expenditure account. Next one, sundry expenses. Any adjustments for sundry expenses? Nothing. So straight away take it to the income and expenditure account to debit side. Next one, equipment purchased. Yes, already here how much equipment we have? 5,25,000. 5,25,000 worth of equipment we have. Okay, 5,25,000. During the year we purchased for 3,75,000. Total equipment we should have 9 lakhs. Total equipment we should have 9 lakhs. But whereas we have equipment of 7.5 lakh. What about remaining 1.5 lakh? Depreciation on equipment. Depreciation on equipment. Observe carefully. 1.5 lakh depreciation on equipment. Important adjustment. Next one, charity show expenses. Already here we have deducted. Over. Now come to additional information. Subscription over, stock of medicine over, amount due for medicine over, value of equipment over. Now look at building. At the beginning of the year we have building worth of 12 lakhs, but at the end when it comes to at the end 12 lakhs, 12 lakh 50, 12 lakhs, 50,000 difference. 50,000 difference. This 50,000 becomes depreciation. Next one, cash balance, opening given, closing given. You need not to prepare any opening balance sheet. Straight away go to closing balance sheet and show 2,25,000 rupees on the asset side. Now opening capital fund already given. Take it to the closing balance sheet liability side. 45,07,000 over. Your balance sheet also completed. Very simple problem. If you get this type of problem now, very easy. But only thing you need to understand is what is a procedure? What is step by step procedure to be followed? Here we have taken one by one item. If you start from item 1, if you end up with last item, you get correct answer. Because you are not missing even single amount. So that you get correct amount. Is it clear? This is our MTP 2 students. MTP 2. This is our total not for profit organization chapter, right? Now, uh, today I am ending the session. Tomorrow morning we start freshly partnership accounts. Partnership accounts. Actually, I thought to take till 11 o'clock, but tomorrow freshly we start partnership accounts. Now, you people do one thing. Till now, whatever we have discussed, final accounts of sole proprietor, accounts from incomplete records, and not for profit organization. These three chapters you prepare well today and tomorrow morning before 9 o'clock. You prepare well so that you get some confidence. Okay, I can score 20 to 25 marks from these three chapters. 20 to 25 marks from these three chapters. Suppose if they have given for 25 marks, if you attempt, at least you are in a position to score 20 marks at least. 20 marks at least. Is it clear, students? So do prepare, and if you have any doubts, you can send it to my personal number, that is 9573778943. You can send to this number WhatsApp or Telegram. Telegram is preferable. You can send your queries to this number Telegram. Is it clear, students? So I will try to respond as early as possible. Is it clear? That's it, students. Good night, and do prepare these three chapters. You have to complete these three chapters by tomorrow morning. Tomorrow morning we start partnership accounts and company accounts. Is it clear? Yes. That's it. We meet again in the next class. Till then, bye bye everyone. Good night. We try to cover partnership accounts, very important chapter from our examination point of view. Look at everybody. Partnership accounts consist of 6 chapters actually. From these 6 chapters, the weightage given by ICAI is 15 to 20%. This is the weightage given by ICAI, 15 to 20%. Now, we check whether we are getting the same weightage or not in the examination. Look at, based on the 3 attempts, June 2024, September 2024 and January 2025, they have asked from partnership for 22 marks, 22 marks and 25 marks. On average, he is asking minimum to minimum 22 marks from these partnership accounts. And in which question the partnership accounts may be asked? If you observe, look at question number 3B, question number 3B, question number 3B is the place fixed by ICAI for partnership accounts. One question. After that, question number 4A. Question number 4A. Okay, I will show you one more question paper also. This is September 2024 question paper. September 2024 question paper. Observe. Now here you can see this is 3A, non-manufacturing entity. 3B, admission of a partner. Is it clear? Next, 4A, retirement of a partner. This is how they are asking from partnership accounts. And I will show you recent question paper, that is January 2025 question paper also. Look at, this is 3A, non-manufacturing entities. 3B, capital ratio. 3B, capital ratio, they have asked for 5 marks. This is from Introduction to Partnership Accounts chapter. Next one, 4A. 4A, they have asked a question from death of a partner. This is for 15 marks. This is for 15 marks. Yes sir, no students? Yes sir. 4A, 15 marks. Right. Now look at, we discuss the first and foremost chapter, that is Introduction to Partnership Accounts. Sir, from Introduction to Partnership Accounts, which type of problems they are asking? First, come to Introduction of Partnership Accounts. Introduction to Partnership Accounts. Which type of problems they are asking? First, they are asking preparation of profit and loss appropriation account. Preparation of profit and loss appropriation account. Second one, calculation of capital ratio. This is very important. Calculation of capital ratio. Third type of problem they are asking, guarantee of minimum profit. Guarantee of minimum profit. Next one they are asking, and this is also very important, past adjustments. Past adjustments. After closing the books of accounts, if any mistakes happened during the previous year, how can we adjust them? Through a journal entry. That is nothing but past adjustments. These are the 4 types of problems they are asking in the examination. Clear, students? Now, first we start discussing our profit and loss appropriation account. In case of sole proprietorship, the whole profit is distributed or the whole profit is transferred to the capital account of proprietor. But in case of partnership, the profit is distributed among partners. Na? So, how this profit is appropriated among partners? To know that, we have to prepare one separate account called profit and loss appropriation account. Profit and loss appropriation account. This is extension to the profit and loss account. This is just an extension to profit and loss account. Clear, students? Right. How the partners will share the profits? It depends on partnership agreement. Based on the partnership agreement, we distribute the profit to the partners. Sir, what the partnership agreement may provide? The partnership agreement may provide for salary to the partner, commission to the partner, or any interest on capital to the partners, or any interest on drawings charged from partners. Okay, or any amount of reserve, some amount of profit may be transferred to the reserve. And after doing all these adjustments, and the remaining profit is called distributable profit to the partners, and this distributable profit may be distributed among partners in their profit sharing ratio, agreed profit sharing ratio. Is it clear? To discuss all these things, look at profit and loss appropriation account format. The trading account shows gross profit or gross loss. This gross profit or gross loss is taken to the net profit and loss account. In the profit and loss account, we get net profit or net loss. This net profit is taken to the profit and loss appropriation account. Okay, look at by net profit transferred from profit and loss account. Now, salary to the partner becomes expense for business and income for the partner. But this salary we should not mix with the salaries paid to other employees. Do remember. And commission payable to the partner is also expense from business point of view or distribution to the partners, but this commission should not be mixed with the normal commission which is shown on the debit side of P&L account. Clear, students? Now observe. So debit side to salary or commission or remuneration to partners. Sir, all partners are eligible for salary? No. Sometimes the partnership agreement may provide salary to all partners or salary to some partners. We have to see that who is eligible for receiving salary, who is eligible to receive commission, who is eligible to receive remuneration. That depends on problem to problem. Based on that, we prepare. Next, interest on capital. Interest on capital. Sir, how do we calculate interest on capital? Simple. How much capital they contributed, multiply with the rate of interest into time by 12. Right? So, to whom eligible? Sir, one partner eligible to receive interest on capital? No. All the partners are eligible to receive interest on capital. All the partners are eligible to receive interest on capital. Do remember. Next, reserves. Sir, how much amount we transfer to reserve? That depends on problem to problem. Sometimes the reserve amount may be transferred on the net profit. Whatever the net profit we have, on that net profit, some percentage we transfer to reserve. Or sometimes after doing all the adjustments, remaining amount distributed to partners as share of profit. Now, on that we calculate reserve. That depends on problem to problem again. Next, interest on drawings. Sir, how do we calculate interest on drawings? Sometimes interest on drawings directly given in the problem itself, or else we have to calculate. Now the difference is nothing but distributable profit. Look at, difference is nothing but distributable profit. And this distributable profit is distributed among partners as per their agreed ratio. Then what is the entry we got? Profit and loss appropriation account debit to partners capital account. And here partners may maintain their capital accounts under two methods. No? Partners may maintain their capital accounts under two methods. First one is fixed capital method. Second one is fluctuating capital method. If partners agreed to maintain fixed capital method, then they have to maintain two accounts for each partner. One is partner's capital account, second one is partner's current account. In this partner's capital account, we record only capital contributed by the partner and any additional capital contributed by the partner and any amount withdrawn by the partner out of capital. Means the capital account balance will be fixed. The capital account balance is fixed. till they contribute additional capital or they withdraw money from capital, out of capital. And all the remaining transactions between partnership business and partners. I repeat, all the transactions between partnership business and partners. Partnership business and partners are recorded in the other account, that is current account. Partners current account. What about fluctuating capital method, sir? In this, under fluctuating capital method, we maintain only one account for each partner. What is that? Partners capital account. All the transactions between partnership firm and business are recorded in this capital account only. Okay. So in the examination, we have to check whether partners are maintaining capitals under fixed capital method or under fluctuating capital method. Okay. Next. We try to solve one simple problem on the concept of preparation of profit and loss appropriation account. Observe carefully. Ram and Rahim start business with a capital of 50,000 and 30,000 on 1st January 2022. Rahim is entitled to salary. Who is entitled to salary? Rahim. How much? 400 per month. Here salary is expressed per month. We have to convert it into year. So 400 into 12 months. Interest is allowed on capitals and is charged on drawings at 6% per annum. Okay. Profits are to be distributed equally. How the profits are distributed? Equally after the above noted adjustments. Next, during the year, Ram withdrew 8,000 and Rahim withdrew 10,000. These are nothing but drawings. Next, the profit for the year before allowing for the terms of the partnership deed came to 30,000. What is the net profit? And this is the profit calculated in profit and loss account. Assuming the capitals be fixed. They said assuming the capitals be fixed. Means which capital method they are following? Fixed capital method. Clear? Prepare profit and loss appropriation account and the capital and current accounts relating to the partners. Here they are asking profit and loss appropriation account and capital account and current account. Two accounts for each partner. Means which method they are following? Fixed capital method. Clear, students? Now look at profit and loss appropriation account. How do we prepare? Whatever the profit we arrived in profit and loss account, that is first taken to the P&L appropriation account credit side. So by net profit 30,000. Now look at partnership agreement or partnership deed provides salary to Rahim. Now debit side to Rahim current account salary. At the same time we open Rahim current account. On the credit side we write 3,000 rupees salary. Just a minute. Yeah, Rahim current account, credit side salary 4,800. Next, what is the next one? On interest on capital. Interest on capital is allowed at 6% per annum. So 50,000 is the capital of Ram and 30,000 is the capital of Rahim. 50,000 plus 30,000, 80,000. 80,000 into 6%, 4,800 is the total interest on capital. Look at Ram current account, Rahim current account. Again, we post the same two amounts on the credit side. Of current accounts. Next one, they said interest on drawings also charged at 6% per annum. Interest on drawings also charged at 6% per annum. But here to calculate interest on drawings, what we need? How do we calculate interest on drawings? Tell me, how much amount is withdrawn by Ram? Ram withdrawn 8,000 rupees. Rahim withdrawn 10,000 rupees. Rate of interest is 6%. Here also 6%. How do we calculate interest on drawings? Generally, interest on drawings is calculated from the date of withdrawing the amount to the date of closing the books of accounts. I repeat, from the date of withdrawing the amount to the date of closing the books of accounts. But here, the date of withdrawing is missing. They have not given the date of withdrawal. In that case, we calculate interest for an average period of 6 months. We calculate interest for an average period of 6 months. So 8,000 into 6, 8,000 into 6% into 6 by 12. How much it comes? It comes 240 rupees. 240 rupees for Ram, Rahim 10,000 into 6% into 6 by 12. It comes 300 rupees for Rahim. This is important calculation here. We have done all the adjustments. Now look at balance the account 30,000 plus 540, 30,540 minus debit side 4,800 plus 3,000 plus 1,800. It comes 9,600 minus 30,540. This gives 20,940. This becomes the distributable profit among partners. They said profit sharing ratio is equal, so that this 20,940 is distributed equally among each partner. Then what is the entry we record? Profit and loss appropriation account debit to partners current account. If we maintain fluctuating capital method, then we write partners capital account. Okay, look at profit transfer to Ram and Rahim. This is how we prepare profit and loss appropriation account. Sometimes there may be some disputes between partners. Whenever there is a dispute between partners, we have to check partnership deed first. If partnership deed is silent regarding any particular point, then we have to see partnership deed now. So here, when we refer the partnership deed, in some situations we refer the partnership deed. They are, look at here. Suppose if the partnership deed is silent, if the partnership deed is silent regarding interest on capital, if the partnership deed is silent regarding interest on capital, then no interest on capital is allowed to partner. No interest on capital is allowed to partners. Look at interest on capital. Problem is silent. Partnership deed is silent. But partners asking interest on capital. No partner is eligible to receive interest on capital. At the same time, no interest is charged on drawings. If we have any particular point in the partnership deed, we follow accordingly. Otherwise, we see partnership act. Next, salary or commission or remuneration. No partner is eligible. Generally, partners are owners. How can they say take salaries? But if the partnership deed provides, yes, this partner is eligible to receive salary. This partner is eligible to receive commission. If partnership deed says, okay, you can give. Otherwise, no partner is eligible to receive any salary. Okay, and no partner is eligible to receive interest on capital. At the same time, no partner is eligible to receive interest on, no part from from the partners, we are not able to charge interest on drawings. At the same time, sharing of profit and losses. Suppose between two partners there is no profit sharing ratio. Now they have a dispute regarding this. Some partner is asking more share. In that case, partnership deed no profit sharing ratio. No, act says, partnership act says, okay, you people share the profits and losses equally. So sharing of profits and losses are to be shared equally. Next, interest on advance or loan by a partner to the firm. Sometimes, generally partners will provide capital to the business. Sometimes partners may lend money to the business. This is called advance taken by the firm from a partner. This is loan. Na? This is considered as loan or advance. On this, generally we allow some interest. If partners not agreed how much interest is payable to the partner, then we have to see partnership act. If it is written in the partnership deed that, okay, whenever the firm borrows money from partner, some 10% or 12% or 15% interest is payable. Yes, that is final. If there is no such provision, then we have to see the partnership act. Partnership act says interest is allowed, but at what percent? 6% per annum. Interest is allowed, but at what percent? 6% per annum is to be allowed on partners' loan to the firm. These are the provisions we have to remember. Next one. Next we discuss about capital ratio concept. That is very, very important. Capital ratio concept. Look at here we have a problem. Yeah. Capital ratio, look at. Okay. Look at this example, capital ratio. Sir, what is this capital ratio? Sometimes the partners may share profits and losses in capital ratio. First of all, they agree to share profits and losses in a particular ratio, or otherwise they may agree to share profits and losses in capital ratio. Capital ratio means effective capital. Capital ratio means what? Effective capital. Sir, what is effective capital? Suppose partner introduced at the time of starting the business 1 lakh. If he kept this 1 lakh rupee for entire year, then effectively how much capital he kept per month? Totally 12 lakh rupee. 12 lakh rupee capital kept in a year. Every month how much capital he kept? 1 lakh. Like that, if we see 12 months now, so how much capital he kept in the business? 12 lakh capital he kept in the business. On this is nothing but effective capital. But sometimes partners, what they do, they may withdraw money now. They may withdraw some amount. Automatically their capital balance gets decreased. And again they bring some additional capital. So capital balance will increase. Again they withdraw money, capital balance will decrease. Like this during the year, what happens? There is no fixed capital now. There is no fixed capital. Capital is changing on timely basis. That's why what we have to do is, now we calculate effective capital. Based on that, we can share profits or losses to the partners. Look at how do we calculate effective ratio. A and B formed a partnership with a capital contribution of 50,000 and 30,000 respectively. This is the initial capital contributed on 1st January 2022. The profits were shared in the capital ratio. Capital ratio in the sense effective capital. Right. Calculate the capital ratio on the basis of following details. If nothing is introduced as additional capital, or if nothing is taken from the business, then automatically 50,000 and 30,000 becomes capital ratio 5:3. Yes or no? But during the year, if any additional capital is introduced or if any capital withdrawn, then automatically capital ratio will get changed. Look at capital introduced 31st March. Here capital introduced and it is capital withdrawn. Observe carefully. On 31st March, A introduced 5,000. 1st July, B introduced 9,000. 1st September, 5,500. 1st November, 4,500. First we see A. Observe total capital employed by A. First, how much capital he employed? 50,000. Next, on which date the capital is changed? From 1st January to 31st March, how much capital we have in the business? 50,000. This capital we have in the business for how many months? Sir, 3 months, sir. 3 months we have 50,000, 50,000, 50,000. So total product becomes 1,50,000 effectively. Next, his capital is changed from 31st March now. Yes, now his capital became 55,000. Initial capital contributed 50, now he contributed 5,000, total became 55,000. This 55,000 rupees is there in the business till what date? Till what date? Observe, he withdrawn amount on 1st July, 3,000 rupees. First look at A. He has withdrawn amount on 1st July. From 1st April to 1st July, how many months? April, May, June, 3 months again. Till 3 months, how much capital we have in the business? 55,000 rupees capital we have in the business for 3 months. So what is the product here? 1,65,000. 55,000 into 3. Next, his capital balance decreased from 55,000 to 52,000. So 52,000 is the capital. This capital is there in the business till what date? 1st September. Again 1st September he has contributed additional capital. From 1st July to 1st September, tell me, July, August, 2 months. For 2 months we have 52,000 rupees capital. Product is 1,04,000. Next, the same 52,000 rupees again changed. On which date? He has withdrawn 4,500. So 52,000 plus 5,500, 57,500 we have till how much? How many months? 2 months. From 1st September to 1st November. September, October. Again, he has withdrawn on 1st November 4,500. 57,500 minus 4,500, 53,000 rupees. Now we have capital. This capital we have in the business till what date? November, December, 2 months. Like that, calculate total product. 6,40,000 is the total product for A. Now look at B. B. We initially contributed 30,000. On which date this amount is changed? He has withdrawn on 31st March 2000. Means till 3 months we have 30,000 rupees balance. Product is 90,000. After that his capital balance gets decreased from 30,000 to 28,000. Next, he contributed amount on 1st July. Till 1st July, how much capital we have? 28,000. From 1st to April, May, June. 3 months we have capital of 28,000. Next, from 1st July, how much is his capital? 28 plus 9, 37,000. Sorry, 30, yeah, 37,000. 37,000 is there till withdrawal of 1,000 rupees on 1st September, means July, August, 2 months. 37,000 into 2 months. Next, he has withdrawn 1,000. Now capital decreased from 37,000 to 36,000. And this 36,000 is there in the business for how many months? 1st September, October, 2 months. Next, he has contributed additional capital. Just a minute. He has contributed additional capital 4,000. Now his capital became 40,000. And this 40,000 capital is there in the business for how many months? 2 months. Now what is effective capital? Look at 6,40,000 is to 4 lakhs. This is their effective capital ratio. In this ratio, we share profits and losses to the partners. Is it clear? This is very, very important concept in the first unit. Sometimes they may ask a question on this concept. Next one, past adjustments. Look at past adjustment. Yeah, illustration 5 is on the concept of effective capital, right? Now look at past adjustments. Just a minute. Yeah, look at in the recent RTP, they have given a concept on past adjustments. Past adjustments means what? Already last year profit, already last year books of accounts closed. Finally, the profit or loss is transferred to the partners. Already the last year books of accounts closed. Profits or losses are transferred to the partners. Okay. Now in the next financial year, there may be some errors or there may be some mistakes happen out of the past years or something we forgot to record the transactions. Then how do we rectify those things? By adjusting capital accounts of partners. This is nothing but past adjustments. Or in the last year, suppose we may forgot to distribute some amount to the partners, maybe in the form of salary or maybe in the form of remuneration or any interest on capital or any interest on drawings, or the partners may decide from retrospective effectively from 2 years back we change our profit sharing ratio, or we take salary, or we take interest on capital, or we charge interest on drawings, like that they may think. Okay, now in that case how do we calculate the revised profit share between the partners? Through a through a one single entry, that is adjustment of past things through partners capital account. Okay, now look at Agarwal, Samuel and Khan are partners in a firm. Agarwal, Samuel and Khan are partners in a firm. On 1st April 2022, their fixed capital stood at 2.5 lakh, 1,25,000 and 1,25,000 respectively. What are their capitals? 2.5 lakh, 1,20,000 and 1,20,000. As per the provisions of the partnership deed, Khan was entitled to a salary of 25,000. All the partners were entitled to interest on capital at 5% per annum. Profits and losses were to be shared in the ratio of capitals of the partners. In the ratio of capitals of the partners. What is the capital ratio? 2.5 lakh, 1,25,000 and 1,25,000. These are the provisions are there in the partnership deed. Next, net profit for the year ended 31st March 2023 of rupees 1,65,000 and 31st March 2024 2,25,000. 2 years profit they are giving. 1,65,000 plus 2,25,000. Total becomes 3,90,000. Was divided equally was divided equally without providing for the above adjustments. Means they are giving 2 years data. 31st March 2023 ending, how much profit we have? 1,65,000. Generally this profit we have to distribute among partners. How do we distribute? First, out of 1,65,000 we have to pay 25,000 rupees salary to Khan, and we have to deduct interest on capital, and the remaining amount we have to distribute among partners in their capital ratio. At the same time, 2024 profit how much? 2,25,000. Out of this 2,25,000, first we have to pay salary to Khan. After that, we have to provide interest on capital, and the remaining profit is distributed among partners in their capital ratio. This must be happen, but this was not happen. That is what they are saying. Instead of giving effect to the above three things, what they did, simply they have distributed these 2 years profits equally. Now, because of this, some partners might get extra profit, some partners might get less profit. Yes or no? Yes, sir. Business profit will not affect, because 1,65,000 and 2,25,000, this is business profit. But partners, some partners may get extra credit, some partners may get less credit. Clear? Now, how do you adjust it? Simple. What we do first is, how the profits are distributed. First we take total profit is how much? 4 lakhs. How this 4 lakhs is, sorry, 3,90,000. How this 3,90,000 is distributed among partners equally? 3,90,000 divided by 3 equally means 1,30,000 is distributed to all partners. 1,30,000, 1,30,000, 1,30,000. Okay, this was credited earlier. Now we see actually how much amount we have to credit. Means 25,000 rupees salary I have to credit. This 1,30,000 already credit given, but actually how much amount we have to give credit to the partners, each partner? Agarwal Samuel Khan. Okay, Khan salary 25,000. He is entitled, I will tell you, one person, then remaining person you can visualize. Each partner is eligible to receive interest on capital. What is Khan capital here? Khan capital is 1,25,000. So he is eligible to receive 5% interest on capital. So this also we have to give credit. After giving all these effects, means Khan salary, interest on capital, remaining profit is distributed to all partners in which ratio? Capital ratio. What is capital ratio? 25, 250, 125, 125. Yes or no? That's it. In this ratio we have to distribute. You can simplify, no problem. After that we can see whether any partner is received extra credit or whether any partner received less credit or debit. This is how we have to do past adjustments. Very, very important. Okay, look at here. A, already how much amount credited? A, 1,30,000, 1,30,000, C, 1,30,000. Total 3,90,000. But amount which should have been credited actually. Khan salary 25,000 for 2 years now. 25,000 plus 25,000, 50,000 we have to give credit. Next, interest on capital for 2 years. Total capital is how much? Okay, 2.5 lakh for A into 5%, 25,000. 1 lakh, 5% plus 5%, 10% for 2 years now. So 2.5 lakh into 10%. 1,25,000 into 10%. 1,25,000 into 10%. Total amount becomes 50,000. Clear? Right. So the profit is actually, first year profit is how much? Okay, both the years profit how much? 3,90,000. Both the years profits are 3,90,000. Out of that, we have deducted 50,000 towards salary and interest on capital 50,000. What is the remaining one? 2,90,000 is the remaining profit. This must be distributed in capital ratio. What is our capital ratio? 250, 125, 125. 25, 10, 25, 5, 25, 5. Again, 5 2 ja, 5 1 ja, 5 1 ja. 2 is to 1 is to 1. Look at 2,90,000 into 2 by 4. How much? 1,45,000. This much of profit we have to give credit. Next, 2,90,000 into 1 by 4. 72,500, 72,500. Actually, we have to credit this amount. 1,70,000 we have to give credit to A. 85,000 we have to give credit to B. Means here names they have given wrong. You can write Agarwal Samuel Khan. Agarwal Samuel Khan. Okay. 85,000 we have to give credit to Samuel. 1,35,000 we have to give credit to 1,35,000 we have to give credit to Khan. But how much given credit? Look at Mr. A got less credit. Mr. A got less credit. Samuel got more debit. Actually, we have to credit Samuel account how much? 85,000. But credited 1,30,000. Next, Khan, look at how much amount we have to give credit. 1,35,000. But how much credited? 1,30,000. Difference amount is nothing but 5,000. Now look at how do we record the entry. Mr. Samuel got extra credit now. Mr. Samuel got extra credit. Now you debit Samuel account for 45,000. Yes, sir. Samuel current account debit. A got less credit. Now you credit 40,000. Khan also got less credit. Yes, sir. Now you credit with 5,000 rupees. This is the ultimate entry we have to record. Necessary journal entry will be Samuel current account, Agarwal current account, and Khan current account. This is another important problem. Is it clear, students? Yes. Now come to valuation of goodwill. These many problems important from exam point of view. Okay, profit and loss appropriation account and capital ratio, and this one past adjustments. Now come to treatment of goodwill in partnership accounts. Actually, this is a separate chapter. This is a separate chapter, but the valuation of goodwill concept we apply in either admission or retirement or death. Sometimes in case of admission of partner, retirement of partner, or death of a partner, this one may be given as an adjustment. Right. Now, how do we value goodwill first of all? For valuation of goodwill, we have different methods now. First one, average profit basis, next super profit basis, next one capitalization basis and annuity basis. Average profit, super profit, capitalization and annuity basis. Out of them, most important one is average profit basis. Most of the problems they have given average profit basis for calculation for valuation of goodwill. Under average profit basis, how do we value goodwill? Generally, do remember goodwill is valued based on the past year profits. Goodwill is valued based on the past year's profits. Past year profits means how many years, sir? That may be given in the problem. That may be 3 years, 4 years, 5 years, or that may be 2 years. Minimum 3 years they give you. Based on these past profits, we value the goodwill. Okay. Now look at first. How do we calculate average profit? Average profit is nothing but total profit given. Just a minute. Total profit given for n number of years. Suppose 3 years profits given. 3 years profits you add. Divided by 3. You get average profit. You get average profit. This we call it as simple average. Suppose first year 10,000. Second year 5,000. Third year they have given 15,000. 3 years profits. Add. Total 30,000 divided by 3. How much we are getting? 10,000. This is our average profit. Next one, adjusted profit or future maintainable profit. Sometimes at the time of preparation of profit and loss account, goodwill is purely based on business profit. Do remember, goodwill is purely based on business profit. But at the time of preparation of financial statements or final accounts, P&L account, we take various expenses and various incomes, maybe not relating to business. Suppose interest on investments. Is it relating to business? Is it your business profit? No, sir. It is non-operating profit. Non-operating profit. If we have some building and we received rent, is it relating to your business? No, sir. It is non-operating income. Non-operating income. Now, abnormal loss of goods. Abnormal loss of goods. Because of abnormal loss of goods, the profit gets decreased. That year profit gets decreased. But this abnormal loss will not happen or will not arise in the future years. Na? In that case, that year profit decreased. Now, that year profit you increase. So, goodwill is purely based on operating profit. Goodwill is purely based on operating profit. Sometimes in the examination problems, they give you these type of things which we need to adjust to the previous year profits. Is it clear? Suppose goods lost by fire. It's an abnormal loss. Every year goods will not get lost. Na? Okay. The year in which goods were lost, that year profit decreased. Now, at the time of preparation of goodwill, you increase that year profit. That is called adjusted profit or future maintainable profit. Now, look at. So, how can we calculate goodwill under simple average? Tell me. Valuation of goodwill is equal to average profit into or future maintainable profit into number of years of purchase. What is number of years of purchase, sir? Yes, the same level of profit. So, we have calculated average profit. Na? Yes, the same level of profit for how many years we get in the future. The same level of profit for how many years we get in the future. This is nothing but expected. Average profit is based on past year's profit. Now we are estimating that the same level of profit may be earned by the business in the next 2 years or next 3 years. That is nothing but number of years of purchase. Means next 3 to 4 years profits we are purchasing today itself. Why? Because the business has goodwill. Because of this goodwill, name and fame in the society, we get more profits than others. With this expectation, we purchase future years profits. Right. Next, weighted average profit basis. But here they said, if we have any clear increasing or decreasing trend, I repeat, if we have any clear increasing or decreasing trend, then we follow weighted average profit basis. So, weighted average profit basis means what? Yes, suppose continuously the profits are increasing. Continuously the profits are increasing or continuously the profits are decreasing. In that case, we assign weights for the profits. Then we calculate weighted average profit. Weighted average profit. In that case, we have to prepare one statement. But in the examination problems, even though there is a clear trend of increasing or decreasing, they have followed simple average profit. They have followed simple average profit. Okay, that's why most of the cases we follow simple average profit. Why, sir? It is simple. No need to prepare any table for calculation of weighted average profit, all those things. Okay, now look at the following table is prepared. Year, profit, weight. Weight is assigned from 1 to 1, 2, 3, 4 like that, consecutive numbers. Okay, and weighted profit. Suppose let us take this is year, profit, weight. Then how do we get weighted profit? 2 into 3. How we get weighted profit? 2 into 3. Clear? Now, this weighted profit total is taken for valuation of goodwill purpose. Then what is the formula for valuation of goodwill? Tell me. Weighted average profit is equal to total weighted profit divided by number of years total of weights. Nothing but sum of 4 divided by sum of 3. To put it simple, sum of 4th column divided by sum of 3rd column. Clear? Then we get weighted average profit. Goodwill formula, weighted average profit into number of years of purchase. Number of years of purchase. Next, straight away now I am going to admission of a partner, because here I am discussing the important point from examination point of view. Here I am not discussing super profit basis, capitalization basis, annuity basis. No. From examination point of view, in admission, retirement, death, they are asking more majority of times average profit. That's why I have discussed average profits. Next, come to admission of a partner. Very, very important. From this, admission, retirement, death, dissolution. These four chapters are very, very important chapters, students. Right. Now look at admission of a partner. Sir, what is the meaning of admission of a partner? Whenever suppose two persons they are doing business. When one person do business, then this is sole proprietorship. When two persons are doing business under the name of partnership, then we call it as partnership business. Two people are doing business, right? This is called partnership business, right? Suppose if we add one more person, then total persons becomes three persons. Already two persons are doing partnership business, and we they added one more person, then total persons becomes partners becomes three. This situation is called admission of a partner. That means new person is admitted into our business as a partner. In that case, what is the accounting treatment? Sir, whenever a new partner is added, sir, we give some party and we arrange some room for him. We arrange some nice table, okay, nice cabin, AC, all those things. Okay, forget about them. We are not discussing about those things. We have to discuss about whenever a new partner is admitted into the business, then how the books of accounts gets affected. Because we are accountants, we have to see how the books of accounts gets affected. Is it clear, students? Yes, sir. Now observe carefully. Okay, just a minute. Yes, look at here we have trading account, we have prepared profit and loss account, and profit and loss appropriation account. Then after we prepare balance sheet. Let us assume this is for the year 2023-25. Sorry, 23-24. Observe carefully. Generally, on which date the partner is admitted? Generally, the partner may be admitted from the beginning of the new financial year. Why, sir? Anyway, at the end of the financial year, we complete all the books of accounts. We close the books of accounts and we prepare all the financial statements, trading account, profit and loss account, and balance sheet. Once final previous year books of accounts completed, now a new partner is entered into the business from the new financial year. If a partner is admitted during the year, a partner may be admitted during the year also, but if he admits during the year, then what happens? During the year we have to adjust the books of accounts. It becomes little bit difficult. Generally, that's why in the examination problems also, to avoid all these confusions, they give you, but practically the partner may be admitted from any date, but in the examination problems they give you from so and so date. Most probably at the beginning of the year new partner is admitted. Okay, before admission of new partner, what happens? Observe carefully. We have prepared the trading account, we have prepared profit and loss account, and we have prepared profit and loss appropriation account, and the profit is distributed to partners, and finally we prepare the balance sheet. Now you people tell me, balance sheet contains what? Balance sheet contains assets information and capital information and liability information. Sir, what about other accounts? Other accounts already got closed na? How? By transferring to trading account, profit and loss account. Now before the admission of partner we have balance sheet alone. All nominal accounts gets closed. Now whenever a partner is admitted in the business, he contribute capital na? Capital account balance increase, means capital increases. Okay. After admission of partner, Capital increase, on the other hand, cash also increase. Very good. Sir, capital increase, cash increase, sir. Very good. Now he is owner. He has the right on assets and he has obligation to pay liabilities because he is owner. Yes, sir. Now, at the time of recording assets, we might record the assets at low value. Sometimes the assets are shown at less than the market value. Sometimes the liabilities are shown at more values or less value, or sometimes we may forget to record any liability, and sometimes we may forget to record any asset, that may be fixed assets or current assets. Means the assets and liabilities values, the assets and liabilities value might be changed. Not all assets and liabilities, some assets and liabilities value might be revalued to show the actual position. Let us say, for example, we have building in the business. Building in the business. Generally, assets are recorded at historical cost. Suppose I have recorded building at, building is purchased for 10 lakhs. Now the building, before the admission of partner, the building market value is 50 lakh. The building market value is 50 lakh. After admission of partner, suppose the building is sold. How much amount we could realize? 50 lakh. We get 40 lakh rupee profit, and this profit is shared between all partners, including new partner. Actually, this building was there in the business before admission of this partner. Now the building was sold. Why should we, the existing partners will think, na, why should I give this profit to the new partner? Because this building was there before his admission. Now we are selling, this profit we should enjoy. Like this, there are certain things in which we have to revalue the assets and liabilities. Apart from this, we have to do certain adjustments also. Like this, we have some 5 to 6 adjustments at the time of admission of partner. If you know the accounting treatment for these 5 to 6 adjustments at the time of admission of partner, the same adjustments are carried in case of retirement of partner or death of partner. Clear, students? Now we try to understand what are the various adjustments we have to do at the time of admission of a partner. Do remember adjustment and its accounting treatment. Adjustment and its accounting treatment. So before admission of a partner, which information they provide? They provide balance sheet. They provide balance sheet and some additional information. Before admission of partner, this is your balance sheet. Now on some terms and conditions, this partner is admitted. The terms and conditions they provide. Is it clear? Now by using this information, what you have to do? You have to do certain adjustments in the books of accounts, and we prepare a new balance sheet. After admission of partner. This is what we have to do in case of admission of a partner. Look at what are those adjustments. First one, revaluation of assets and reassessment of liabilities. If you do revaluation of assets and reassessment of liabilities, 50% of the problem completed. Next up, distribution of reserves and accumulated profits. The balance sheet contains the distribution undistributed profits and reserves. These undistributed profits are not distributed earlier. Yes, sir. Now when a new partner admits, so he is also eligible to share out of this undistributed profit. That's why before admission of partner itself, the undistributed profits first we distribute to all partners, because these are the profits earned by these two people, old partners. Now here we call existing partners as old partners and new partner. Right? So the undistributed reserves and undistributed profits are distributed to old partners. Sir, how we distribute? In their old profit sharing ratio. After admission of new partner, we calculate new profit sharing ratio. Okay, so determining new profit sharing ratio, another adjustment. Earlier there are two partners, they are sharing profits and losses equally, 1:1. Now a new partner is admitted. Now what is the new profit sharing ratio between these three people? that we need to calculate. Next one, valuation of goodwill and its accounting treatment. Valuation of goodwill and its accounting treatment, very very important. Here, in case of admission of a partner, in case of admission of a partner, the old partners will sacrifice their share. I repeat, in case of admission of a partner, the old partners or existing partners will sacrifice some share in favor of new partner. For their sacrifice, the new partner will compensate some amount, that is in the form of goodwill. This is from one angle. The second angle is the balance sheet contains various assets and liabilities. These may be fixed assets or current assets. Fixed assets, again, tangible, intangible. But the balance sheet may not contain one of the important intangible asset, that is goodwill. Till the admission of new partner, the old partners, they have did the business very well. They generated some goodwill. This goodwill is called self-generated goodwill. This goodwill is called self-generated goodwill. Before admission of partner, these partners, they did business. They got name and fame in the society. Now a new partner is coming into business, means he also enjoys that name and fame. By using this name and fame, the business gets more profits, and this new partner also enjoys share in the profits. Yes, sir. Yes. Now what we do is, at the time of admission of a partner, we also value the goodwill of the business. We also value the goodwill of the business. But this is self-generated goodwill. This is self-generated goodwill. After valuation of goodwill, out of this, the new partner share is contributed by the new partner either in cash or in kind. That accounting treatment we have to discuss. If you do goodwill adjustment and revaluation of assets and liabilities adjustment, then 60 to 70% problem completed. 60 to 70% problem completed. Is it clear? Next, last adjustment of capital accounts of partners. Adjustment of capital accounts of partners means, before admission of new partner, the partner's capital may not be in accordance with their profit sharing ratio. Generally, in the business we have 1 lakh rupee total capital. There are two partners, they are sharing profits and losses equally. But the partners may contribute capital either in their either in their profit sharing ratio or in some agreed ratio. Suppose if A and B partners should bring capital in 1:1 ratio, means how much capital A should bring? 50,000. How much capital B should bring? 50,000. How much capital A should bring? 50,000. How much capital B should bring? 50,000. If A and B contribute capital like this, then it is said to be the capital of firm is in accordance with or in proportion to their profit sharing ratio. Maybe before admission of partner, the capital may not be in proportion to their profit sharing ratio. But after admission of new partner, all partners may agree that our capital must be in proportion to our profit sharing ratio. In that case, how do you give adjustment for this capital accounts? If you can solve these 5 adjustments now, but sir, in the examination all the 5 adjustments given? No. First adjustment, guarantee, we have to revalue the assets and liabilities. Second, if you have any reserves and undistributed profits in the balance sheet, okay. Sometimes the balance sheet does not contain these reserves and accumulated profits. And sir, calculation of new profit sharing ratio and sacrificing ratio, is it necessary, sir? Yes. Sometimes you need not to calculate, they give you in the problem itself. Sir, valuation of goodwill you need not to do. Majority cases they give you goodwill directly, but accounting treatment you have to give. And in the problem, if they specifically give, yes, do adjustment for capital accounts of partners, then you do accordingly. Otherwise, ignore 5th adjustment. If you can solve like this, the admission of partner problem completed. Look at For the first one, revaluation of assets and liabilities, what we do is we create a new account called revaluation account. We create a new account called revaluation account. Revaluation account is debited. It is the nature of nominal account. Revaluation account debited with all decrease in the value of asset, increase in the value of liability. Revaluation account is credited with all increase in the value of asset and decrease in the value of liability. Sir, increase in the value of asset means profit, credit. Decrease in the value of liability, profit, credit. Increase in the value of liability, loss, debit. Decrease in the value of asset, loss, debit. Is it clear? So in that manner, we have to follow these entries. Look at first one. The following journal entries are recorded. First, increase in the value of asset or unrecorded asset is recorded now. Sometimes some assets are not recorded by the business. They maintain secret reserves or they maintain secret assets. They may be not recorded them in the books of accounts. Now they bring all those assets into books of accounts. In that case, what is the entry we record? Concerned asset account debit to revaluation account. Decrease in the value of asset means asset value gets decreased. Entry, revaluation account debit to asset account. Next, increase in the value of a liability or unrecorded liability recorded now. Increase in the value of liability means liability value increases, credit. This is loss for us, debit revaluation account. Next, decrease in the value of a liability. Decrease in the value of a liability means liability decreased means you need not to pay. It's a gain for us. It is income for us indirectly. So liability account debit to revaluation account. Next one, profit on revaluation. Profit on revaluation. After passing first, second and third and fourth entries, now if you see the revaluation account, the revaluation account looks like this. Increase in the value of asset, unrecorded asset, decrease in the value of liability. Asset decrease, unrecorded liability, increase liability. Now this revaluation account is balanced. The balance in revaluation account is known as revaluation profit or revaluation loss. This revaluation profit or revaluation loss we distribute to partners. In which ratio, sir? Profit sharing ratio. To whom we distribute, sir? Old partners. To whom we distribute? Old partners. Is it clear, students? If it is profit, then what is the entry? Revaluation account debit to old partners capital account in their old profit sharing ratio. Loss on revaluation, old partners capital account debit to revaluation account. Once this is done, 50% of problem is completed. Is it clear? Right. So here look at important note point. Be careful about the language of adjustments. What? For example, there is a difference between machinery reduced by 25%. Suppose machinery value is 1 lakh. It is reduced by 20% means 25%. The new value is 75,000. New value of machine is 75,000. Suppose machinery reduced to 25% means 75% is depreciation, remaining 25,000 is the value of asset. So this language we have to take care about this language, right? Now next I will show you one problem. By solving problem, then we just a minute, then we can understand how to solve it. Look at illustration 1. We try to understand how a problem is solved. Approach, problem solving approach. Problem solving approach. Look at the following is the balance sheet of Ram and Mohan. The following is the balance sheet of Ram and Mohan who share profits in the ratio of 3:2. In the ratio of 3:2 as on 1st January 2022. Okay. Look at the liabilities and assets first. Trade payables, Ram's capital, Mohan capital. Fine. Building we have plant and machinery, inventories, trade receivables, bank. Anyway, bank balance will not change. Bank balance will not change. Then which assets will change other than bank and cash? On this date means 1st January 2022, Sham was admitted on the following. Sham was admitted on the following. Now, he is to pay 25,000 as his capital. Sham is bringing 25,000 rupees capital and 10,000 rupees as his share of goodwill. Okay, Sham, Sham is bringing 25,000 capital and also 10,000 goodwill for 1/5 share in profits. What is the profit? His profit 1 by 6. Okay, the new profits sharing ratio will be 5:3:2. The new profit sharing ratio will be 5:3:2. The assets are to be revalued add under. Look at how the assets gets changed. Building 25,000. Earlier, what is the building value? 18. Now, building is increased by how much? 7,000. Next, plant and machinery, how much? 12,000. Here, plant and machinery existing value 15, but they revalued to 12,000. So, there is a loss of 3,000. Yes, sir. Next, inventory value is how much? 12,000. Here, inventory value 12,000. There is no change. There is no change. Trade receivable 9,500. Here, how much? 10,000. Means 5,000 rupees, 500 rupees reduced now. They said this is due to doubtful debts. This is not due to bad debts. Do remember, this is not due to bad debts. This is due to doubtful debts. So, at the time of showing debtors in the balance sheet, trade receivables 10,000 minus provision for doubtful debts 500, net amount 9,500. Net amount 9,500. Is it clear, students? Yes, sir. Next, it was found that there was a liability of 1500 for goods received but not recorded in the books. So there was a liability for 1500, means new liability. Liability increased? Yes, sir. Give journal entries to record the above. Also give balance sheet of the partnership firm after Sham's admission. So journal entry, for which transaction we have to record journal entries? Look at, for the adjustments, means on which terms and conditions he admitted, we have to record the journal entry. Here use some common sense. First one, how do we record the entry for this? Okay, total how much amount he contributed? 25,000 plus 10,000, 35,000 rupees he contributed total. Then what is the entry we record? Bank account debit. Here bank account is there na? Bank account debit to Sham capital account 35,000. Bank account debit to Sham capital account 35,000. Okay, and he is bringing 10,000 rupees for his share of goodwill. Okay, goodwill is always distributed to old partners. Do remember, old partners, that too who sacrificed their share. I repeat, goodwill amount is always given to old partners, that too who sacrificed. To put it simple, goodwill is always given to the partners who sacrificed their profit share. Okay, now here we have to identify who are the sacrificing partners. Who are the sacrificing partners? For that purpose, calculate sacrificing ratio. Calculate sacrificing ratio. Total how many partners we have? Ram, Mohan. New partner anyway he will gain. Okay, Ram old ratio how much? Old profit share ratio. Take old profit sharing ratio 3 by 5, 2 by 5. Okay, next we can take like this. Old, new. Ram, Mohan. Old ratio 3 by 5, 2 by 5. New ratio they have given, look at 5:3:2, means 5 by 10, 3 by 10. Now calculate sacrificing ratio formula. Old ratio minus new ratio. Here we get 10. 6 minus 5, so 1 by 10, 10. So 5 to z 4 minus 3 means 1 by 10. So what is sacrificing ratio? 1:1. This is how we have to calculate sacrificing ratio. First condition, tell me, goodwill is distributed to sacrificing partners. First condition. Second condition, then who are the sacrificing partners? Let me calculate. How do you calculate sacrificing ratio? Old profit sharing ratio minus new profit sharing ratio of old partners. Anyway, new partner always he gains. Always he gains. Sacrifice means observe old partners. Sir, Ram and Mohan both are sacrificed? Yes. Sometimes one partner may sacrifice. Sometimes one partner may sacrifice. Do remember. Now look at 1:1 ratio. So how much is goodwill? 10,000. This is given to whom? Ram 5,000, Sham 5,000. Now what is the entry we record? That is the next question. In case of goodwill, ask three questions. First, how much is share of goodwill of new partner? How much is share of goodwill of new partner? Second, to whom the goodwill is distributed? Sacrificing partners. Calculate who are the sacrificing partners. After that, record the entry for goodwill distribution. What is the entry we record? Simple. New partner capital account debit. New partner capital account debit to sacrificing partners capital account. Sacrificing partners capital account. That's it. Over. Who is the new partner? Sham. Sham capital account debit 10,000. Who are the sacrificing partner? Ram and Mohan. To Ram capital account, to Mohan capital account. Over. That's it. Clear? The same entry they record. Sham capital account to Ram capital to Mohan capital. Goodwill is completed. Next is what? Assets revaluation. First, record the entry for one by one entry also you can record, or revaluation account debit, record one entry, revaluation account credit, record another entry. Here look at building value increased na, so building account debit to revaluation account. You can write the entry building account debit to revaluation account. Next, plant and machinery decreased na, you can write individual entries also, no problem. Revaluation account debit to plant and machinery account. Inventory value no change. Trade receivable value decreased to by 500. This is due to doubtful debts. Then what is the entry we record? Revaluation account debit to doubtful, provision for doubtful debts account. Next, it was found that there was a liability for 1500, unrecorded liability. So revaluation account debit to unrecorded liability 1500. Revaluation account debit to unrecorded liability 1500. Look at, or trade payables. This is for purchase of goods, na? This is for purchase of goods, trade receivable. Over 1500. After recording entries, now prepare revaluation account. Prepare revaluation account. If you prepare revaluation account, automatically you can come to know that whether it is revaluation profit or loss. Distribute that revaluation profit or loss to the partners. So in this problem, we have revaluation profit, revaluation account debit to Ram capital to Mohan capital. Working note, sacrificing ratio. Now, important thing is how to prepare balance sheet. How to prepare balance sheet. See, I will give you simple trick to prepare balance sheet. Simple trick to prepare balance sheet. Okay, look at, concentrate everybody. Concentrate. Now look at. First look at the balance sheet. By looking at old balance sheet, we have to prepare new balance sheet. I repeat, by looking at old balance sheet, we have to prepare new balance sheet. Yes or no? Yes, sir. Now look at old balance sheet, liability side, what item you have? Sir, trade payables. How much? 15,000. Does it changed? Yes, sir. It is increased by 1500. Okay. Go to new balance sheet. Go to new balance sheet. Write down 16,500. 15,000 plus 1500. It comes 16,500. Over, sir. Okay. Next. Ram capital, Mohan capital. I always suggest prepare a separate account. Prepare account. Ram capital account, Mohan capital account. Prepare partners capital account. In that case, Ram capital account credit balance, Mohan capital account credit balance. Over. Now come to building. Building. Is this building value changed? Yes, sir. How much? 18,000 plus increase by 7,000, sir. Write down the same in the new balance sheet. 18,000 plus 7,000. 25,000. Over. Next. Sir, plant and machinery 15,000. Look at whether it is any, is there any change? Yes, sir. It is decreased by 3000. Okay. Go to new balance sheet. Write down same plant and machinery. Earlier value 15,000 minus 3000 decreased. New value automatically 12,000. Next, next asset is what? Inventory. Is there any change in the inventory? No, sir. Write down the amounts as it is. Next, trade receivable. Is there any change in the trade receivable? Yes, sir. What? Less provision. Write down in the new balance sheet. Same. Trade receivables 10,000 minus provision 500. Over. Next, bank balance. Is there any change in the bank balance? Yes, sir. Bank balance earlier 5,000. Now the new partner brought 35,000 rupees capital, sir. So total 40,000 bank balance, sir. Write down 40,000 bank balance. After completion of this, now go to partners capital account, working note. Partners capital accounts you balance, because here we have posted recorded entries, so posted them into partners capital accounts. Now balance partners capital accounts, and the closing balances of partners capital brought to the new balance sheet. Closing balances of partners brought to the new balance sheet. With this, balance sheet gets completed. Suppose if you are not in a position to solve the whole problem, then at least solve 60 to 70% problem. But don't leave it. Don't leave it. Is it clear, everybody? Yes, sir. Now look at we solve illustration 2. Here follow the technique. Follow, because tomorrow we have exam. Today it is not possible to discuss each and everything in detail. Here I am here to help you how the questions are solved by using simple technique. Right, now look at, ultimately what you have to do, you have to solve the question in the exam. That's it. Right, A and B are partners sharing profits and losses in the ratio of 3:2. A and B are partners sharing profits and losses in 3:2. Their balance sheet as on 31st March is given. First observe the balance sheet. Trade payables, partners capital accounts. Freehold premises, plant, furniture, office equipment, inventories, trade receivables, bank balance. Bank balance anyway gets changed with the introduction of capital or anything. And on the liability side, if you look at the reserves, like general reserve or any undistributed profit, immediately distribute these reserves to partners, whether they specify in the problem or not. Ignore, but immediately distribute general reserves and accumulated or undistributed profits to partners. Right, now look at, this is the balance sheet we have. Now look at the adjustments. What they have given. On 1/4/2022, they admit C on the following terms. What are those terms? C will bring 50,000 capital. This is capital. In addition to that, he also bring some amount in goodwill. So 10,000 he is bringing for goodwill. And what is his profit share? 1/5. So total how much amount he is bringing? 60,000. Next, provision for doubtful debts is to be made on trade receivables 2%. Fine. Inventory to be written down by 10%. Fine. Freehold premises is to be revalued at 2,40,000, plant 35,000, furniture 25,000, office equipment 27,500. Almost all assets gets changed, na? These are 4 assets, and inventory also changed. On trade receivables we are providing doubtful debts. Almost all assets gets changed. Next, very important point, 5th point. Partners agreed that the values of assets and liabilities remain the same. Means in problem number 1, illustration 1, here the asset values increased or decreased. The changed values we have shown in the balance sheet. But in this problem, all partners agreed that the assets and liabilities before admission of new partner, whatever the assets and liabilities values we have in the balance sheet, the same assets and liabilities value. Assets and liabilities in the sense only trade payables. Liabilities said trade payables, not capital. Capital accounts anyway change. Assets means except bank. See, not all assets, except bank, remaining assets. Whatever the balances we have, they must be same. So then what is the necessity of preparing, doing revaluation? Yes. Their intention is we revalue the assets and liabilities. Finally, what is the outcome of revaluation of assets and liabilities? Either revaluation profit or revaluation loss. That effect we adjust through partners capital account. That effect we adjust through partners capital account. For that purpose, what we have to do is we have to prepare memorandum revaluation account. The memorandum revaluation account is prepared in two parts. Do remember. First part, similar to revaluation account. First part, similar to revaluation account. Second part, reversal of first part. Reversal of first part. Suppose in the first part I have increased asset value by 10,000. In the first part I have increased asset value by 10,000. In the second part asset value gets decreased. Here asset value increase. In the second part the same amount of asset I am decreasing, means if you observe the visualize the asset account will not get changed. So then what is the importance of preparing this? Yes, in the first part whatever the profit or loss we get, that is distributed to old partners in their old profit sharing ratio. In the second part, suppose in the first part we have profit, automatically second part becomes reversal na. In the second part we get loss. This loss we distribute to all partners in their profit sharing ratio. I repeat, this loss we distribute to all partners in their new profit sharing ratio. So what is the benefit? Yes, first part profit, to whom it is distributed? Old partners in their old profit sharing ratio. Second part it is loss, it is distributed to all partners na. The difference between first part profit distribution, second profit loss distribution becomes gain for the new partner. Becomes gain for the old partners. This you can observe only if you see the partners capital account. If I say orally you cannot imagine, but if you see partners capital account, then you can visualize. Look at memorandum revaluation account here. Here asset value increase na. Look at, first we are increasing the assets, after that we are decreasing the assets and liabilities. Look at. Okay, now in the first part what is the profit? 39,000 is the profit. 39,000 is the profit. And this is distributed to whom? A and B. How much to A? 23,400. How much to B? 15,600. In the second part, we got the same loss. But it is distributed to whom? All partners. Look at. A, B, C. First I have given credit to A, 23,400, B, 15,600. C, I am giving debit now, 18,720, 12,480, C, 7,800. Look at A, 23,400 credit, 23,400 minus 18,720 debit. So how much net credit? Net credit we got, he got 4,680 net credit. B, look at 15,600 credit minus 12,480 debit, he got net credit 3,120. And this amount is equal to C. Look at C account debited. They have revalued the assets and liabilities. The effect is distributed to old partners and it is borne by new partner. If you observe the new balance sheet, if you observe, the assets and liabilities are at same values, no change except bank balance. And liability side, if you observe, the trade payables are same, no change, but capitals changed. Is it clear? This is the technique of solving this memorandum revaluation account. Then what about this goodwill distribution? Look at, we see goodwill distribution. How much goodwill we have to share? 10,000. Here they did not mention about new profit sharing ratio. Important point. He did not mention about new profit sharing ratio. Fine. Now this 10,000 rupees goodwill, to whom we have to distribute? Sacrificing partners. Who are the sacrificing partners, sir? A or B? If there is no new profit sharing ratio or there is no information regarding new profit sharing ratio, assume the old profit sharing ratio itself as sacrificing ratio. Assume the old profit sharing ratio itself as a sacrificing ratio. Means we have to distribute 10,000 rupees to A and B in 3:2 ratio, that is 6,000 and 4,000. Look at what is the entry we record? C capital account debit to A capital to B capital. So to C capital, sorry, by C capital 6,000 and 4,000 goodwill. This is goodwill. Except this, there is no new thing. Look at 6,000, 6,000, 10,000. This is how we try to solve the answer. Next one, observe. Illustration 3, observe. See, each problem differently we are solving. First problem, revaluation. Second problem, memorandum revaluation. Memorandum revaluation. Look at A and B are partners in a firm sharing profits and losses in the ratio of 3:2. The balance sheet of A and B as on 1/1/2022 was as follows. Look at first balance sheet. Trade payables, bank overdraft. Here asset side, building, furniture, inventories. Same items almost. Capital accounts. Next, trade receivables. Already we have provision, investments and cash. Right. Very important is these adjustments. C was admitted to the firm on the above data on the above date on the following terms. Look at the first term. C is admitted for 1/6 share in the future profits and to introduce a capital of 25,000. He is giving only the information of capital. He is not giving the information of goodwill till now. Okay. See, in case of admission, retirement, death, goodwill is 100% is there. Suppose if the goodwill information is missing in the problem, even though there is goodwill in the problem, that is hidden goodwill. That is hidden goodwill. Without goodwill concept, there is no concept of admission, retirement, death. Do remember. Simple fundamental rule. The new profit sharing ratio of A, B, C will be 3:2:1. Old profit sharing ratio given, new profit sharing ratio given. Now here you have to calculate sacrificing ratio. Here you have to calculate sacrificing ratio. C is unable to bring in cash for his share of goodwill. C is unable to bring in cash for his share of goodwill. That means he is not bringing cash. Okay, fine. They decide to calculate goodwill on the basis of C's share in the profits and the capital contribution made by him to the firm. Means what? C contributed how much share of capital? 25,000. He contributed for 1/6. He contributed for 1/6. 1/6. Now make it 100%. Make it full share. For 1/6 share, he contributed 25,000. Make it 100% share. For 100% share, how much is the total capital? Simple. 25,000 into reciprocal of his share. We get 25,000 into 6. Reciprocal, that we get 1,50,000. So 1,50,000 is the total capital. When he is bringing 25,000 for 1/6, then total capital how much? 1.5 lakh. Look at whether they have total capital 1.5 lakh or not. Observe carefully. So here their capital is 80,000. Actually in the firm their capital is 80,000. He brought 25,000 capital. Total capital must be how much? 1,05,000 only. 1,05,000 only total capital. But as per his calculation, how much he brought? 1.5 lakh. How much excess capital we have? 45,000. And this 45,000 is considered as goodwill of the firm. This is hidden goodwill. This 45,000 is considered as goodwill of the firm. Observe carefully. This goodwill calculation is very, very important. Calculation of goodwill. See, contribution 25,000 consists of 1/6 capital. Then total capital becomes how much? 1.5 lakh. How we arrived at this 1.5 lakh? 25,000 into reciprocal of his share. Then calculate original capital 1,05,000. What is the difference? 45,000. This is the total capital, total goodwill of the firm. Now what is the share of C? 1/6. What is the share of C? 1/6. Actually he has to bring 7,500 goodwill, but he is unable to bring. Yes sir. Even though we record the same entry. What is that entry? Goodwill adjustment entry. New partner capital account debit to sacrificing partner capital account. New partner brought how much? 25,000 credit. Now we are debiting his account how much? 7,500 debit. That's it. When he is not bringing separately for goodwill cash, then what we do? He is bringing 25,000 na. Out of that we take 7,500. Out of that we take 7,500. 500. That's it. Remaining amount we consider as his capital. Anyway, we take goodwill. Our goodwill we take. Clear? Next. Goodwill will be shared by A and B in their sacrificing ratio. What is sacrificing ratio? Look at A and B. Sacrificing ratio formula, old ratio minus new ratio, 3 by 6, 2 by 6. Old ratio, 3 by 5, 2 by 5. You can do this and you get here sacrificing ratio 3 is to 2. And this 7500 is distributed in 3 is to 2 ratio. So what's the entry for that? A C capital account debit 7500 to A capital to B capital. Hope you understood this. Yes. Next one. Furniture is to be written down by 870. Inventory to be depreciated by 5%. A provision is required for trade receivables at 5%. For bad debts, okay. A provision would also be made for outstanding wages of 1560. There might be some wages outstanding. For that, we have to create provision. The value of building having appreciated B brought up to 29,200. The value of investments is increased by 450. The total fourth point is nothing but revaluation of assets and liabilities. It is found that the trade payables included a sum of 1400 which is not to be paid off. Here we have trade receivables now. How much trade receivables we have? 50,000. Out of them you need not to pay some 1400 rupees. Means it is a gain for us. Remaining amount we have to pay. Show the remaining amount in the balance sheet. The requirement is revaluation account and partners capital account. Understood? So revaluation account, look at if any asset increase, write down on the credit side. If any liability decrease, write down on the credit side. Debit side, if any asset decreased or any liability increase, write down on the debit side. Difference profit is transferred to the partners capital account. Clear everybody? Next, partners capital account. Here they have not asked any balance sheet. Next, look at reserves in the balance sheet. I said already, if you find any reserves and undistributed profits in the balance sheet, immediately, without any second thought, immediately distribute to partners. Immediately distribute to partners. Is it clear? Now look at. We try to solve one problem. Next we take some break. Then after we solve retirement, death and dissolution. Today I think our class will go to 1 o'clock also, because in the morning session we have to complete this partnership accounts. We try to complete. In the evening session we try to complete company accounts. Right? Here I am saying again, here I am giving only inputs to how to solve the problem to the extent possible. Maybe the whole problem is not solved, not possible to solve. But to the extent possible, you can solve and come. You get good marks. Believe me. Dalal, Banerjee and Malik. Dalal, Banerjee and Malik are partners in a firm, sharing profits and losses in the ratio of 2 to 1. Fine. Their balance sheet as on 31st March 2022 is as below. Look at the liability side first. Trade payables, outstanding liabilities, general reserve. Yes. Here they have given general reserve. Directly distribute this general reserve to old partners. In case of admission. In case of retirement, all partners. In case of death, all partners. Clear? Capital. These are the capital account balances. Prepare capital accounts separately. Then this becomes opening balances. Credit side. Dalal, buy balance B by D 12,000, Banerjee 12,000, Malik 5,000. Next, land and building, furniture, inventory, trade receivable, cash in hand, cash at bank. Here they have given two things. Cash in hand, cash at bank. You can prepare cash account or cash at bank account by assuming. Automatically either one balance will get changed. The partners have agreed to take Mr. Mystery as new partner. Suppose if they ask balance sheet now, the same existing balance sheet copy paste. How sir? Trade payables, look at. If there is no change in the trade payables, write down the same amount in the balance sheet. Outstanding liabilities. If there is no change in the outstanding liabilities, write down the same in the balance sheet. General reserve. Anyway, general reserve we distribute. So that in the new balance sheet, there is no general reserve. And partners capital accounts, anyway we take closing capitals. These balances we have to take from capital accounts. Next, come to assets side, land and building. If there is no change in the land and building, write down the same in the balance sheet. Furniture. Yes sir, there is a change. Either increase or decrease and write down the new balance. Inventory. There is no change sir. Write down the same. Means by looking at the old balance sheet, you have to prepare new balance sheet. If there is any change, change it. Otherwise, write down as it is. Very simple. Admission problem, you if you get admission problem na, you can get 10 to 15 marks. Suppose if it is given for 10 marks, at least you get 8 marks. Admission is easy. Retirement also, but when it comes to death, we have to be little bit careful. Now look at, the partners have agreed to take Mr. Mystery as partner with effect from 1st April 2022. Fine. Mr. Mystery shall bring 5,000 rupees towards capital. Okay. The value of inventory should be increased by 2,000. Now look at, inventory 11,750 now, increased by 2,500. Go to new balance sheet, write down 13,000, 14,250. 14,250 over. And this 2,500 is written on the credit side of revaluation account. Write down both the things separate, simultaneously. Next, furniture should be depreciated by 10%. Look at furniture once. 6,500. Depreciation means decrease in the value of asset. Go to revaluation account, debit. Okay. Now immediately go to the new balance sheet. 6,500 minus 10% over. Next, reserve for bad and doubtful debt should be provided at 10%. Yes. Go to revaluation account. Trade receivables 5,500 into 10%, 550. Immediately go to balance sheet. And do the same. Trade receivables minus doubtful debts. Next, the value of land and building should be enhanced by 20%. Land and building is 25,000. Enhance, increase. How much? 20% now, 5,000. 25,000 into 20%, 5,000. 5,000, take it to the revaluation account credit side. Immediately go to balance sheet. 25,000 plus 5,000, 30,000 rupees. Over. Next, the value of goodwill be fixed at 15,000 rupees. In the first one, they said 15,000 rupees capital. Here they said 15,000 rupees, 5,000 capital, 15,000 goodwill. This is total goodwill of the firm. Out of this, what is the share of Mr. Mystery? He has to bring that amount. General reserve will be transferred to the partner's capital account, whether they specify or not. We will distribute. What is the entry for distribution of general reserve? General reserve shows credit balance. General reserve account debit to partner's capital account. Who are the partners? Dalal, Banerjee and Malik. Next, new profit sharing ratio shall be Dalal 5 by 15 means 5 is to 5 is to 3 is to 2. When the new profit sharing ratio is given and old profit sharing ratio is also there, 2 is to 1. Now you can calculate sacrificing ratio. Like after calculation of sacrificing ratio, out of 15,000, new partner should bring, and here the logic is, there are 3 partners. Anyway, the last partner, Mystery, he is gaining 2 by 15. Sometimes the existing partners also may gain some share. In this problem, that is an important point. The existing partners may gain some share. They also should contribute goodwill. In this problem, goodwill is very, very important. Look at. The outstanding liabilities include 1,000 due to Mr. Sen, which has been paid by Mr. Dalal. This is another important adjustment. Actually, outstanding liability how much? 1,500. Out of that, 1,000 rupees due to Sen, Mr. Sen, he is a person. But it is paid by whom? Dalal. Dalal paid. Then Dalal capital account increase. Why? Because Dalal indirectly contributed capital of 1,000. Actually, outstanding liabilities for the firm, not to Dalal, but Dalal paid. If Dalal recovers this amount from business, then okay. But Dalal is not taken this 1,000 rupees back. That's why Dalal capital account credit, revaluation account debit, or liability. Look at calculation of sacrificing ratio. Here, who are the sacrificing partners? Look at Dalal sacrifice, Banerjee sacrifice, Malik no gain, no loss, Mystery gain. Sometimes the one of the partner may also gain. Now Dalal, how much amount he has to bring? 15,000 into 2 by 15. He has to bring 2,000 rupees. And this 2,000 rupees is given to Dalal, Banerjee. Mystery should bring 2,000. This is given to Dalal and Banerjee. How? 1 by 1 is to 1 ratio. Means 1,000 rupees. 1,000 rupees. Clear? Look at the new balance sheet. Trade payables, no change. 12,850. Outstanding liabilities is a change. 1000 rupees decrease, na? Yes, sir. So write down 500. And these capital accounts are taken from here. Partners capital accounts. Here partners capital accounts is prepared one by one. If you think what is the entry for this and give postings into partners capital accounts, ultimately these are the closing capitals, and these capitals are taken to the balance sheet. After that, one by one asset look at. Land and building increase, furniture decrease, inventory compared to previous amount, inventory increase, trade receivable decrease, cash balance same, they have taken in bank. How much amount he contributed? Tell me, already bank balance how much we have? 960. He contributed 5,000 rupees capital, so that 5,960. They did not mention whether goodwill is brought in cash or not. Assume the goodwill is not brought in cash. So the bank balance becomes 5,960. So as much as possible, you try to solve and come. Clear, students? That's it. That's it. This is admission of partners. Try to solve the remaining problems in this manner. We meet again after 15 minutes. We try to complete retirement, death. In case of retirement and death, the important concept is joint life policy. Except this, remaining treatment is same. In case of retirement and death, joint life policy adjustment, and how we have to settle retiring partner capital account or executors of deceased partner capital account. This we discuss after break. Is it clear? Yes. Hello students, am I audible? Okay. Yes. Hello. Hello. Yeah. So whenever suppose there are three partners, actually it's a voice disturbance. Okay. When there are three partners in a firm, one partner is retiring. One partner is retiring from the firm. Means he is leaving the organization. He is leaving the partnership firm. Then what are the adjustments we have to do in the books of accounts? Sir, when a partner is retired, then we distribute some sweets and we do some felicitation to him, all those things. No, we are not going to discuss all those things. We are going to discuss what is the accounting treatment when a partner is retired from the organization, when he becomes partner of the firm, when he contributes capital. Whenever he retiring from the organization, then whatever the amount due to him, we settle his account. Whatever the amount due to him, we finally calculate. Okay, Mr. Partner, Mr. Retiring Partner, this is the amount due to you. Take your capital and go, leave. Is it clear? Yes. So that is what we are going to discuss here. First of all, when a partner is retired from the organization, then what are the various adjustments we have to do? In addition to the adjustments which we have done in case of admission of a partner, we do some extra two adjustments. What are those two adjustments? Observe carefully. First one, revaluation of assets and reassessment of liabilities as usual. But here the revaluation profit or loss is distributed to all partners including retiring partner. Including retiring partner. There in case of admission we distributed only to old partners, not a new partner. And here the same memorandum revaluation account concept also apply. Do you remember? That's why I said if you can understand the adjustments in case of admission, then the same adjustments may carry in retirement and death. Our task becomes very simple. Next step. So revaluation of assets and reassessment of liabilities tell me the profit or loss on revaluation is distributed to all partners in their old profit sharing ratio. Here the memorandum revaluation concept also comes. In case of memorandum revaluation account, part 1, profit or loss is distributed to all partners including retiring partner in their old profit sharing ratio. part 2. In the part 1, if it is profit, part 2 it is loss. This is distributed to continuing partners. In case of admission, what we did, part 1 profit or loss is distributed to old partners in their old profit sharing ratio. In case of part 2, what did we did? Part 1 profit or loss is distributed to all partners including new partner in their new profit sharing ratio. Here what we do, first part profit is distributed to all partners including retiring partner in their old profit sharing ratio. Part 2 profit or loss is distributed to continuing partner. Continuing partners means leave the retiring, eliminate the retiring partner share and continuing partners in their new profit sharing ratio. This is only the difference. Next one, distribution of reserves and accumulated profits. This is also same. In case of admission, we distributed reserves and accumulated profits to old partners in their old profit sharing ratio. But here we distribute to all partners in their new old profit sharing ratio. Sometimes what we can do is the share of complete the partnership accounts, retirement, death and dissolution. Then after we go to company accounts, students. Okay. After understanding admission of partner, most of the adjustments will cover again in case of retirement and death. When it comes to death of a partner, there are two different types of problems they may ask that we will discuss in case of death of a partner. Now come to retirement of a partner. Sir, what is the situation of retirement of a partner? Suppose let us assume there are 3 partners in a firm or 5 partners in a firm. One partner, out of them, one partner is leaving the organization permanently. So this situation is called retirement of a partner. Why the partner retires? What is the effect of retirement? We are not going to discuss all those things here. We are here to give accounting treatment when a partner retires from the partnership firm. We are here to give what is the accounting treatment when a partner retired from the business. Hope you are following. Yes, sir. Now, whenever a new partner is admitted, he will bring capital. Whenever we start a new business, and partners will contribute capital. Whenever a partner is retiring from the business, he will take back his capital. He will take back his capital. Yes or no? When we repay the amount due to the retiring partner, retirement of partner is completed. Now look at what are the various adjustments we do. First and foremost adjustment is revaluation of assets and reassessment of liabilities. This is exactly similar to admission in case of admission of a partner. What are the differences? First, the revaluation profit or loss is distributed to old partners in old profit sharing ratio in case of admission. But in case of retirement, the profit or loss on revaluation is distributed to all partners including retiring partner. Is it clear? Yes. Here also the memorandum revaluation account concept comes. When the continuing partners, suppose there are 3 partners A, B, C. C retired from the firm. Now who are the continuing partners? A and B. A and B may agree that the assets and liabilities value should not vary or change. Okay, fine. In that case, they follow memorandum revaluation account. The principles or methods of preparation of memorandum revaluation account is exactly similar to admission. The only difference is in case of admission, memorandum revaluation account part 1, profit or loss is distributed to old partners in their old profit sharing ratio. When it comes to part 2, memorandum revaluation account, profit or loss is distributed among all partners including new partner in their new profit sharing ratio. But here what we do, in case of part 1 profit or loss, it is distributed to all partners including retiring partner in their old profit sharing ratio. When it comes to part 2, profit or loss is distributed to only continuing partners. Only continuing partners A and B in their new profit sharing ratio. That is only the difference. Next, distribution of reserves and accumulated profits. Distribution of reserves and accumulated profits. In case of admission, the reserves and accumulated profits are distributed to old partners in their old profit sharing ratio. But here in case of retirement or death, The reserves and accumulated profits are distributed to all partners including retiring partner or deceased partner in their old profit sharing ratio. Or else the reserves and accumulated profits may be distributed the share of retiring partner or the share of deceased partner only distributed to him. Means remaining partners may continue. A and B are continuing. Yes, take the share of reserve and the share of accumulated profit of C alone and distribute to him. Automatically what happens? Earlier in case of admission, total reserve and accumulated profits are distributed. But here what is happening? Only the share of retiring partners, only the share of retiring partner is distributed. That is an important factor here. Or else simply to avoid all those confusions, what we can do, all reserves and accumulated profits distribute to all partners in their old profit sharing ratio. Next one, computation of new profit sharing ratio and gaining ratio. In case of admission, we have calculated sacrificing ratio. What is the formula for sacrificing ratio? New old ratio minus new ratio. But this is retirement. See, let us assume one is A, B, C are sharing profits and losses as 1:1:1. Suppose C is retiring. Means C's share of profit is taken by A alone or B alone or A and B. That means both the people. Suppose if the share of C is taken by A alone, A will get benefit. A has to compensate goodwill to C. If the share of C is taken by B, B is getting benefit. B has to sacrifice. B has to compensate goodwill to C. Or A and B both gain it. So both people should compensate goodwill to C. How they compensate? In their gaining ratio. What is the formula for gaining ratio? New ratio minus old ratio. New ratio minus old ratio. In case of admission, goodwill is brought by the new partner. In case of retirement, goodwill is taken by the retiring partner. That is only the difference. Goodwill distribution, same. In case of admission, the existing partners will sacrifice their share in favor of new partner. That's why he is compensating goodwill. In case of retirement, the retiring partner is giving his share of profit to existing partners. That's why the existing partners means the gaining partners will compensate goodwill to C. Next one, valuation of goodwill and its accounting treatment. 99% chances are there they give you the value of goodwill of the firm. So next, pending accounting treatment. In case of retiring a partner, the goodwill adjustment is very easy. Why? Here goodwill is contributed by whom? Gaining partners. Simply one entry we write, gaining partners capital account debit. Gaining partners capital account debit to retiring partner capital account. Retiring partner capital account. That's it. One single entry for goodwill. Calculate the share of retiring partner, the share of goodwill of the retiring partner and record this entry. Calculate first share of retiring partner, share of goodwill of retiring partner, second one gaining ratio. In this gaining ratio, you distribute this. So gaining partner capital account debit to retiring partner capital account. And very important adjustment is joint life policy or separate life policy. Now we don't have much time to discuss in detail about joint life policy or separate life policy, but I will discuss one small technique how this joint life policy or separate life policy is adjusted when it is given in the examination. Okay, next one, adjustment of capitals of continuing partners. We have seen in case of admission of partner, when all partners including new partner, after admission of the new partner, if all partners agree to maintain their capitals in proportion to their profit sharing ratio, then this capital adjustment is done. Otherwise you need not to do it. Here what is happening? After retirement of C, if A and B agreed that we contribute capital in proportion to our profit share, then this capital adjustment has to be done. Next one, determination of amount due and settlement of the same to the retiring partner. In case of admission, the new partner will bring amount of capital, but in case of retirement, the existing partner or retiring partner, he will take whatever the amount due to him. These two adjustments are new for us. Adjustment of joint or separate life policy and determination of amount due to the retiring partner. In case of death also, we do the same adjustments, 7 adjustments. In addition to that, we do one more adjustment, that is share of profit till the date of death. Share of profit till the date of death. Is it clear, students? Yes. Now look at, we try to solve one problem. By solving problem, we understand more concepts. Look at, I told you already, here I am helping you to solve the problems to the extent possible. What is the process we have to follow? Okay, what is the process we have to follow in the examination? Yes, to the extent possible. See, our aim is to attempt the accounting paper to the extent possible. Suppose one tough problem is given. Okay, in every tough problem, a student can solve 50% of the solution. Suppose toughest problem is given in the exam. Okay, out of that you can solve 50%. Solve 50% and come. You get proportionate marks, na? Is it clear, students? Okay. Yes. Now look at, A and B are partners. Excuse me. A and B are partners in a business sharing profit and losses as 3 by 5 and 2 by 5. Nothing but 3:2. Their balance sheet as on 1st January 2022 is given below. In case of admission, retirement, compulsorily they give you balance sheet and additional information. But in case of death, there are two possibilities. They give you the balance sheet and additional information, and we have to prepare, we have to do the adjustments and prepare the new balance sheet. Or in case of death, they may also give you different information. They give you after death of the partner, what are the various adjustments we have to do in the books of accounts. And finally, we have to calculate what is the amount due to the executors of deceased partner. Clear? Look at. So how the information is given? You have to keep one thing in mind. They give you the information. They ask the requirement. What you have to do? You have to convert the information into the requirement. I repeat, this is the information. This is the information. What is the requirement? Journalize the above transactions in the books of the firm and close the partners accounts as on 1st January 2022. Give also the opening balance sheet of A. This is the requirement. Information, requirement. Convert this information into requirement. We are understanding that. How the information is converted into requirement. Hope you are following. Yes, sir. Now look at the first one. Liabilities. Capital of A, capital of B. Immediately open partners capital accounts and show these things as opening balances. By balance brought down 20,000, 15,000. A, B. Next, reserve. How much reserve? Here we have 15,000. Immediately distribute this reserve to the partners. What is the entry we record? Reserve account debit to A capital to B capital. What is the ratio? 3:2. 15,000 into 3 by 5. 10,000 and 5. Sorry, just a minute. 15,000 into 3 by 5. 9,000 and 6,000. 9,000 and 6,000. Over. See, entry he is asking, na? Yes. Next. Posting, look at. Okay, partners capital accounts not prepared. You people prepare, no problem. Next. Trade payables. Trade payables. Observe carefully. If there is no change in the trade payables, show trade payables as it is. Show trade payables as it is. See, trade payables 7,500. There might be some adjustment. Next, come to asset side. Plant and machinery, inventories, trade receivables, balance at bank and cash in hand. Two balances given. Balance at bank and cash in hand. Here what we have to do, if any asset value changed, change accordingly. First, show the change in revaluation account. After that, take the same amount to balance sheet. Simultaneously, you try to solve it. Next, B retires from the business owing to illness and A takes over it. A takes it over. The following revaluation was made. The goodwill of the firm is valued at 25,000. What is the share of A out of 25,000? 25,000 into 3 by 5. 15,000. Here there are only two partners, A and B. B is retiring, A is taking over the business. Means A will gain total share of B. Yes. So who will compensate this goodwill to retiring partner B? A. Yes or no? Sorry, just a minute. Not 15,000. 25,000 into B is retiring na 2 by 5. 10,000 rupees is the share of goodwill of B. Then what is the entry we record? Gaining partner capital account debit. A capital account debit to B capital account. Over. A capital account debit to B capital account. Next. Depreciate plant and machinery by 7.5% and inventory by 15%. Plant and machinery 7.5% decrease. Inventory 15% decrease. Accordingly, you write the entry. What is the entry? Revaluation account debit to plant and machinery account to inventory account. Over. Next, doubtful debts is raised against trade receivables at 5%. Trade receivables how much? Trade receivables are 15,000. 15,000 into 5%. 15,000 into 5%, 750 rupees. Revaluation account debit to provision for doubtful debts account. Next, discount reserve against trade payables. Actually, discount reserve or provision for discount on creditors is a gain, future gain. As per prudence concept or as per conservatism concept, we should not create any discount or reserve on for discount on creditors. But in in this problem, they said create. You create. What is our creditors? 7,500 into 2% means 150 rupees. This becomes gain for us. What is the entry we record? Discount reserve or reserve on reserve for discount on creditors account debit to revaluation account. Look at reserve for discount on trade payables account debit or creditors account debit to profit and loss adjustment account or revaluation account. Okay, next. That's it. That's it. Here, if you observe, they did not mention whether B account is settled or not. Observe carefully. Here they did not mention whether B account is settled or not. In the absence of information regarding how the retiring partner's capital account is settled, it is better to transfer retiring partner capital account balance to his loan account. I repeat, irrespective whether any information is missing regarding how the retiring partner capital account is settled. In that case, it is better to transfer the amount due to retiring partner from his capital account to his loan account. Finally, observe here. Yeah. Finally, amount due. If you prepare B's capital account, then the total amount due to B is 29,200. Transfer this to his loan account. Over. Now look at balance sheet. Plant and machinery decreased, decrease. Inventory decreased, yes. Trade payables 15,000 minus provision, yes. Balance at bank, no change. Cash, no change. A's capital changed. Here we have to compulsorily prepare partner's capital account. Otherwise, how can we calculate how much amount due to B and what is the capital due to closing capital of A? Next, trade payables, they said 7,500 minus provision 150. It's a simple problem, students. It's a simple problem. Now look at the next problem and very, very important problem. FGK were partners in LLP, limited liability partnership, sharing profits and losses at the rate of 2:1. K wants to retire on 31st December 2022. Okay, who is retiring? K is retiring. Who are the continuing partners? F and G. Given below is the balance sheet of the partnership as well as other information. First, observe the liability side. Capital account of FGK. Immediately what you have to do? Open partner's capital account. Post these things as opening balances. By balance brought down. Next, reserve is there. Reserve is there. If nothing is given in the problem regarding reserve, do one thing. Straight away distribute this reserve to all partners. Straight away distribute this reserve to all partners. What is the entry we record? Reserve account debit to F capital, to G capital, to K capital. In which ratio? 2:1 ratio. Over. Next, trade payables. If there is no change in the trade payable value, straight away take this trade payables to balance sheet liability side. Next, sundry fixed assets, inventories, trade payables, including bills receivable 20,000. Including bills receivable 20,000. Okay, bank balance 50,000. Bank balance 50,000. Now look at how the assets gets changed. F and G agree to share profits and losses in 3:2 in future. This is the new profit sharing ratio. Old profit sharing ratio 2:1. So that here we calculate gaining ratio. Who is retiring? K is retiring. What is the share of K? 1/5. And this is taken by F and G. How they have taken? That we calculate by calculating gaining ratio. In future, okay, value of goodwill is taken to be 50,000. What is the total value of goodwill? 50,000. Here you can observe goodwill adjustment. Okay, F G. K is retiring now 1 by 5. F old share 2 by 5, new share 3 by 5. Calculate gaining ratio. Gaining ratio is 1 by 5. So F is gaining and K sacrificed 1 by 5. Total share is taken by F. Means if you observe G share, there is no change in the G share. Earlier we have 2 by 5. New also he has 2 by 5. So no change. Means the total share of goodwill, K's share of goodwill is compensated by F only. How much? 50,000 into 1 by 5, 10,000 rupees. What is the entry we record? Gaining partner. You have to remember this. Gaining partner capital account debit to retiring partner capital account. In case of admission, incoming partner capital account debit to sacrificing partner capital account. Okay, students, look at F capital account debit to K's capital account. Over. Next. Sundry fixed assets are revalued upward by 30,000. Means earlier we have 1.5 lakh. Now upward revaluation 30,000. What is the entry we record? Sundry fixed assets account debit to revaluation account. Go to revaluation account credit side, write down 30. Go to balance sheet, write down 1 lakh 80. And inventories by 10,000. Inventories are upward revaluation. Earlier we have 50,000. Now increased. Go to revaluation account credit side, write down 10,000. Again go to balance sheet, write down 60,000. Next, bills receivable dishonored 5,000. Bills receivable dishonored 5,000 on 31st December 2022. What is the entry for bills dishonored? Debtor account debit to bills receivable. This is the entry we have to write. In that case, what happens? Bills receivable decrease by 5,000. Debtors total trade receivables become same. I repeat, if we pass the entry for bills receivable dishonored, then bills receivable decrease by 5,000. But whereas trade receivables shows same amount. Why? Because debtors account debit to bills receivable now. We record the entry debtors account or trade receivables account debit to bills receivable. But here what happened? But not recorded in the books. Dishonor of bill was due to insolvency of the customer. Insolvency of the customer means what? Now we are unable to recover amount due from him. In that case, the total amount of bill is transferred to the revaluation account. In that case, trade receivables also reduced by 5,000. If this much of information is given, if this much of information is given, what is the meaning of that? Bills receivable decrease, debtors increase. But here they have given dishonor of bill due to insolvency of customer. Means permanently the reduction in bills receivable and debtors also. So now the new bills receivable is, trade receivables are 65,000. In the bracket we write including bills receivable 15,000. Revaluation debit 5,000. Over. F and G agree to bring sufficient cash. Yes. In the entire problem, this point is important. F and G agree to bring sufficient cash to discharge claim of K and make their capital proportionate. Or now the next question comes. How much? How much amount F and G will bring? That's the question mark. Here the capital adjustment. Look at. Also, they wanted to maintain 75,000 bank balance for working capital. Here the question mark is how much capital they contribute. To know this, first of all, we should understand what is the total capital of the firm. If we know the total capital of the firm, this can be shared between F and G in 3:2 ratio. After distributing the total capital, now we check how much of actual capital we have in the business. The difference capital they may bring. But here, how much is the total capital? Means they have given a hint. What is that hint? We know the accounting equation assets is equal to capital plus liabilities. Yes, sir. Here we have all assets information, all liabilities information. In that case, easily we can calculate capital. Na? Capital is equal to assets minus liabilities. Yes, we have all assets information and all liabilities information. Only thing we need now, capital. But here bank balance they have given 50. But what is the new bank balance? 75. If the required bank balance is given in the problem, that indicates that you have to calculate capital in this manner, assets minus liabilities. This working note finally is very, very important. Look at sundry fixed assets, inventory, trade receivables. These are changed values. These are changed values, new values. These must be written in the balance sheet. Bank balance 75. Total assets minus sundry creditors. This is the required capital. This is the total capital of F and G after retirement of K. Now this is shared by between F and G in 3:2 ratio. 3 by 5, 2 by 5, 198, 132. These are the closing balances. These are the closing balances. Now what we do immediately, these can be taken as closing balance. Now we balance F and G account. They will bring the required cash 70,000 and 34,000. Observe carefully. Now finally, what is the amount due to K? 79,000. Finally, we repay amount to K. In the new balance sheet, observe sundry fixed assets, inventories, trade receivables, bank balance, and this 1,98,000 and 1,38,000 we show as capital. Trade payables 50. After retirement of K, the balance sheet size also decreased. Look at. Yes, this is how we solve the problem. Right. So they are asking past necessary journal entries and draft the balance sheet. Okay, everything is okay. Once you know the procedure of solving problem, however the problem it is and whatever the problem it is, we can simply calculate it or solve it. Right. Next look at illustration 3 once. A, B and C were partnership sharing profits in the proportion of 5:4:3. The balance sheet of the firm on 31st March 2022 was as under. Look at capital A, B, C and trade payables. Next, fixtures, inventories, trade receivables and cash balance they have given. Okay, A had been suffering from ill health and gave notice that he wishes to retire. Okay, who is retiring? A is retiring. An agreement was therefore entered into as on 31st March 2022, the terms of which were as follows. A is retiring now. Yes. What are the terms and conditions? Look at. The profit and loss account for the year ended 31st March 2022, which showed a net profit of 48,000, was to be reopened. Yes. This is very, very important, students. This is very, very important adjustment. The profit and loss account for the year ended. You people observe, we are on what date? 31st March 2022. They are saying that 31st March 2022 already P&L account prepared, P&L appropriation account also completed and balance sheet also prepared. Observe, 31st March 2022 all the final accounts completed. Trading account, P&L appropriation account and balance sheet. But now what are the terms and conditions? They are agreeing that okay, we reopen the profit and loss account. How much? 48,000. What is the profit? 48,000. Okay. B was to be credited with 4,000 as bonus. These are the new terms and conditions. First, for opening 48,000, what is the entry we have to record? Already this profit has been distributed to partners earlier. Now we reopen it. What is the entry we have been passed in the past? P&L appropriation account debit to partners capital account. Now that entry becomes reverse. Partners capital account debit to P&L appropriation account or adjustment account. Yes, this is very, very important entry. Now after reopening the P&L account 48,000 profit. Now what we are doing? We are giving bonus to B. How much? 4,000 rupees. Okay. So P&L adjustment account debit to B capital account 4,000. Next, in consideration of extra work which had been developed upon him during the year. Okay, fine. The profit sharing was to be revised from 1st April 2021 is 344. Actually, they have given in the problem the profit sharing ratio 543. But now they are changing profit sharing ratio to 344. Retrospective effect means 1st April 2021. Now, whatever the profit we have, and whatever the reserves and undistributed profits we have, and whatever the revaluation profit we have, that is for all those things we have to consider 344 as profit sharing ratio. Okay, now look at out of 48,000, 4,000 is given bonus. What is the remaining profit? 44,000, and this 44,000 is distributed in 344 ratio. Look at profit and loss adjustment account debit to A capital account, 44,000 into 3 by 10. 44,000 into 3 by 10. How much? 12,000. 16,000 and 16,000. Clear, everybody? This is the first point. First point is very important in this problem. Remaining all we know. Goodwill was to be valued at 2 years purchase of the average profits of the preceding 5 years. Here goodwill valuation. Look at. The fixers were to be valued by, okay, first we take previous year profits. The fixers were to be valued by an independent valuer. The valuations arising out of the above agreement were already goodwill calculated. We thought we have to calculate goodwill. Tuch, they have calculated. Okay, no problem, let it be. Total 56,000 is the goodwill. Okay, out of 56,800, what is the share of goodwill of A? New ratio is how much? 3 by 10. So 3 by 10. 17,040. Just a minute. 56,800 into 3 by, sorry, 8, 11. 11, na? 3 by 11. 8 plus 3, 3 by 11. Okay. 56,800 into 3 by 11. It comes to 15,005. Just a minute. Okay, we check. And fixers 10,980. Fixers how much? 10,980. Fine. A provision of 2% was to be made for doubtful debts, and the remaining assets were to be taken at their book values. See how many assets are going to be changed. Fixers are taken at what value? 10,980. 10,980 means asset value increased na. Fixers account debit to revaluation account. Next, inventory value no change. Inventory value no change. Next, 2% provision is provided for trade receivables. 93,500 into 2%, it comes to 1870. Revaluation account debit to provision account. Remaining assets and liabilities are not changed at all. Okay, fine. B and C agreed as between themselves to continue the business, sharing profits in the ratio of 3:2. Now here we calculate gaining ratio. Decided to retain the fixers on the books at their revised value. Revised value means fixers, what is the revised value? 8,200. 8,200. All these things happened after retirement. All these things happened after retirement. Okay. And to increase the provision for doubtful debts to 6%. Already 2% is provided. Now they are increased it to 6%. Means extra 4% provision you have to create. This paragraph importance is after retirement. I repeat, after retirement of A, this paragraph will be applicable. Clear? Submit the journal entries necessary to give effect to the above arrangements and drop the capital account of partners after carrying out all adjusting entries as stated above. No need to prepare any balance sheet. But journal entries, look at. First, fixers increased na? Yes sir, fixers account debit. Yeah, they have written combined entry. Here observe, they have written combined entry. Actually, what is the entry we have to write? Fixers account debit to revaluation account. Next, revaluation account debit to provision for doubtful debts account. You can write separate entries, no problem. After that, the profit or loss is distributed among partners. But here they have written combined entry. You can check it. Next, this is capital account of A. Wait for some time. Now look at goodwill adjustment. Goodwill adjustment. 56,800 is the goodwill. Yes sir. 3 by 11. So total is 15,491. Total becomes 15,000. It is coming 15,490.909. So 15,491. This is shared between gaining partners. Who are the gaining partners? Check it. Calculate gaining ratio. See A, B, C. This calculation is very important. Old share is 3 by 11, 4 by 11, 4 by 11. New share. New share of B and C is given. Calculate the LCM and calculate how much share gained by other partners. See, total sacrifice 3 by 11. Gain of A 13 by 20, 55. C 2 by 55. So finally we take 13 is to 2. Out of 15,491, 13 by 15. It comes 14,425. 13,425. 13,425 by B and C 2066. After that you can check it. Partners capital account. All these entries are posted into partners capital account. Over. Finally, balance A capital account. A capital account. Identify what is the amount due to him. In the problem they said A account is settled. In the problem they said after carrying out all adjusting entries as stated above. Okay. Look at how much amount due to A. How much amount due to A? Total amount due to A is 1,43,669. But if you observe, do we have that much of amount in our bank? No. Cash. Only cash amount is available 74,910. And that too in the problem they did not mention whether his account is settled or not. That's why the total amount due to A is transferred to his capital account. And last point, last paragraph adjustments they are doing after retirement of partner. Fixers value how much decreased? Fixers value how much we have to decrease now. Earlier it is increased to 10,980. 10,980 minus 8,200. Now we have to decrease it by 2,780 loss. And one more thing, provision for doubtful debts. Earlier 93,500 into 93,500 into total we have to provide 6%. It comes 5,610 minus earlier already we provided 1870. Now 3,740. What is the total loss? 2780. Total loss is 6520. Now this much of loss is borne by B and C in their new profit sharing ratio 3:2. Look at the last entry and finishing touch entry. See 3000 for this is for provision 3740. 3740. What about fixers? Fixers on the books at the revised value. Okay, sorry. Fixers on the books at the revised value. Na? Revised value is 10,980. It's my mistake. Sorry. Yes. 3,740 correct. And this 3,740 is loss. And it is distributed to B and C in their new profit sharing ratio 3:2. This is the problem. Okay. In this problem, two important points. First one and last one. These two things are very, very important. Now look at next. Yes. Practical question 1. This contains a joint life policy. Look at here. Yeah. Observe. So how do we solve joint life policy problems? Now we are in retirement now. When it comes to death, I will explain again. When it comes to retirement, now we are at retirement stage. Retirement of a partner. Retirement of a partner. First one. If first check the balance sheet. Check the balance sheet. Check the balance sheet. In the balance sheet, there is no concept of JLP. Suppose in the balance sheet, if there is no concept of JLP, in that case, it is treated as first method. First method means premium method. Whenever joint life policy is paid, we treat it as an expense and it is debited to the joint life policy premium account. and finally it is transferred to the P&L account. Means in our balance sheet you cannot find joint life policy. Okay, in that case, whenever you receive joint life policy, see, whenever a partner retires, we surrender the joint life policy. We surrender the joint life policy and we receive some amount from the insurance company. And whatever the amount you received from insurance company, this can be directly distributed to partners. Entry: cash or bank account debit to partners capital account. Or else, whatever the amount we received from insurance company, that can be credited to the revaluation account. That can be credited to the revaluation account as a gain. This is the first method. Now, I have seen balance sheet. The balance sheet contains joint life policy rupees 10,000. Joint life policy rupees 10,000. When joint life policy is showing in the balance sheet means, it is nothing but what? It is nothing but what? Joint life policy paid is treated as an asset. Joint life policy paid is treated as an asset. Now what we have to do? Generally, joint life policy in the balance sheet is shown at a surrender value. Shown at surrender value. And whenever you surrender the policy to the insurance company also pays surrender value. Now here the asset is, in that case the joint life policy account looks like this. Joint life policy account is showing 10,000. Joint life policy account is showing 10,000 balance, and we also received from insurance company 10,000 balance. Now the account gets closed. Means when the second method is followed, whatever the amount we received from insurance company as a surrender value, this can be distributed to partners only that amount exceeds opening balance of joint life policy account. Then only we distribute the amount. Otherwise, this account gets closed. No distribution of joint life policy. Over. Second method. Next, look at the balance sheet, and it is showing that JLP and JLP reserve. Maximum JLP reserve they will not ask. They will not ask. JLP is showing 10,000, so that JLP reserve also must show 10,000. This is nothing but reserve method. JLP reserve method. Third method. In that case, what we have to do? We have to open two accounts, JLP account and JLP reserve account. Okay. So in this case, JLP reserve is showing 10,000 balance. Right. JLP account as usual closed. Why? Because it is showing 10,000 balance and we received from insurance company 10,000. If you receive 11,000 rupees, in that case distribute extra 1,000 rupees to partners. Or else if you receive 15,000 rupees, distribute extra 15,000 rupees to partners. Whatever the amount you receive from insurance company, if it is exceeded 10,000 rupees, then distribute them to partners. Sir, if we receive less than that, no, we will not receive less than that. Why? Because surrender value is fixed. Is it clear? Yes. Sir, JLP account is closed, sir. Yes. In that case, go to JLP reserve. Now, when JLP is not there, no need to maintain JLP reserve, Yes, sir. JLP reserve is showing which balance? Credit balance. Distribute this 10,000 to all partners in their profit sharing ratio, including retiring partner. This is the simplest method of solving problems on JLP. Now, we don't have much time to discuss in depth about JLP. Otherwise, I will discuss. Right? Keeping this concept in your mind, now come to practical question 1. Practical question 1. After completion of this practical question 1, next we move on to death of a partner. Now, on 31st March 2022, the balance sheet of Messrs. Ram, Rahul and Rohit sharing profits and losses in proportion to their capital stood as follows. Okay, fine. First one, capital account, Ram, Rahul, Rohit. Immediately what we have to do? Open partners capital accounts. Open partners capital accounts and post these items as opening balance. By balance brought down. Over. Sundry creditors 2 lakhs. If there is any change in the sundry creditors, then change it. Otherwise, take the same 2 lakhs to new balance sheet. After retirement of who is retiring? Ram is retiring. Next, land and building, machinery, closing stock, sundry debtors, cash and bank balances. Fine. Look at what next. On 31st March 2022, Ram desired to retire from the firm and the remaining partners decided to carry on. Okay, who are the retiring partners? Ram. So who are the carrying partners? Continuing partners, Rahul and Rohit. Do remember students, partnership problems they will ask in 3B and immediately 4A. If you take the whole partnership accounts as choice, that means you are going to lose marks from not only from partnership 3A, 4B. ICAI has designed the question paper in such a way that there is too much of complexity of choosing the question, which question can be left as choice. 3B, 4A partnership, 3A, 4B either company accounts, final accounts of sole proprietorship or NPO or not for profit organization. Out of these three, they may ask in under 3A and 4B. 5C, company accounts. 6A, company accounts again. Is it clear? So the most dangerous question, you have to take it as choice. Identify after reading the question. After reading the question paper, you decide whether which question can be taken as choice. Okay, fine. Now continue. It was agreed to revalue the assets and liabilities on that date on the following basis. Look at first one. Land and building be appreciated by 30%. Land and building account debit to revaluation account. Machinery be depreciated by 20%. Revaluation account debit to machinery account. Closing stock be valued at 80,000. Closing stock is valued at 80,000. Look at the difference, whether it is increase or decrease. Closing stock earlier 1 lakh. Now it is valued at 80,000, means 20,000 loss. Revaluation account debit to closing stock account. Provision for doubtful debts is to be made at 5%. How much debtors we have? 2 lakhs. 2 lakhs into 5%, 10,000. So revaluation account debit to provision for doubtful debts account. Next, old credit balances of sundry creditors 10,000 be written off. Old credit balance. Old credit balances of sundry creditors 10,000 to be written off. Okay, this we discuss later. Next, joint life policy. Very, very important. Look at joint life policy of the partners, surrendered and cash obtained 60,000. Look at, if you observe the balance sheet, will you find JLP? I have discussed now. Look at the balance sheet and identify whether JLP is given or not given. No, JLP is not given, sir. Means which method they have followed? Sir, first method, sir. When they have followed first method, means JLP premium paid is treated as expense. Now what we have to do? We have received some amount, na? Yes, sir. Directly you can transfer this amount to partners bank account debit to partners capital account distribute, or else this can be taken to the revaluation account as a gain. In this problem, what they have did? Look at. Yes, in this problem they have taken 60,000 to revaluation account, or else what you can do, you can transfer this 60,000 to partners capital accounts also, no problem at all, right? Next one, seventh point, goodwill of the entire firm we valued at 1,80,000. Total goodwill 1,80,000. Then what is Ram's share? Ram's share of the goodwill be adjusted in the accounts of Rahul and Rohit, whose share the future profits equally. Who share the future profits equally? Nothing but new profit sharing ratio. New profit sharing ratio is given 1:1. Old profit sharing ratio is profits and losses to their capital ratio. Capital. Here what are the capitals? 3:2:1. Means this is old profit sharing ratio 3:2:1. Now the new profit sharing ratio 1:1. Calculate gaining ratio. After calculating gaining ratio, 1,80,000 into what is Ram share? 3/5. Sorry, 3/6. 90,000. 90,000 is compensated by gaining partners. Okay. Next. Eighth point. The total capital of the firm is to be same as before retirement. Total capital of the firm is same as before retirement. Means before retirement of firm, how much is capital? 6 lakhs. Now this 6 lakhs is brought by Rahul and Rohit in their profit sharing ratio. What is their profit sharing ratio? 1:1. How much capital Rahul should bring? 3 lakhs. How much capital Rohit should bring? 3 lakhs. Now check how much capitals they have in our business. After doing After giving all the adjustments, effect to do all adjustments, check how much capitals we have for Rahul and Rohit. Rahul and Rohit, their capitals must be 3 lakhs. If the existing capitals of Rahul and Rohit are less than 3 lakhs, they have to bring cash. If the existing capitals of Rahul and Rohit are more than 3 lakhs, then we will pay them back. Or else the excess amounts can be adjusted through current accounts also. If nothing is set, then they will bring the amount or they will take back their excess capital. You specifically said adjust the excess or short amount with current accounts, then we have to adjust with the current accounts. Next, individual capital to be in their profit sharing ratio means 1:1, 3 lakhs and 3 lakhs. Amount due to RAM. Now, how we are going to settle RAM account is to be settled as 50% on retirement. Calculate, suppose the amount due to RAM is 10 lakhs. After doing all the adjustments, amount due to RAM is 10 lakhs. Then 5 lakhs we are paying cash and the remaining 5 lakhs is transferred to his loan account. And that amount we have to repay within 1 year, including interest. Okay, that interest part they have not mentioned, ignore. Initially what we do, 5 lakhs we pay cash and 5 lakhs we transfer to his loan account. With that, all adjustments completed. Prepare revaluation account, capital account of partners Rahul and Rohit, loan account of Ram, loan account. Finally, out of the total amount, 50% is paid, 50% loan account. Cash account and the balance sheet as on 1/4/2022 of Messrs. Rahul and Rohit. Now come to last point. Here they said old credit balance of sundry creditors 10,000 to be written off. Means we have to pay amount to creditors 10,000. That we are writing off. Means we need not to pay 10,000 to the creditors now. Why? Why? Because we need not to pay. They said they have given in the problem now. We have to follow accordingly. Why you need not to pay? You need not to bother. Write off 10,000 rupees. What is the entry for that? Sundry creditors account debit to revaluation account. Over. After giving effect to all these now, final accounts completed. Clear everybody, right? So with this I am stopping retirement concept. Now I am moving on to death of a partner. Yes, now come to death of a partner. Very interesting here. In case of retirement now, a partner can retire. Sometimes, see, a partner may be admitted in the business from the beginning of the year, from the beginning of the new financial year. At the same time, a partner may retire on the request of continuing partners. A partner may retire at the end of the year. Why? Because at the end of the year we prepare financial statements so that it is easy to us to settle the retiring partners amounts. Yes or no? In case of admission also, once the financial year is completed, then regarding previous year, all the books of accounts are completed, closed, so that fresh books of accounts are opened. Then you admit as a new partner. But in case of death, is it possible to say to a partner, hey partner, please go and die on at the end of the financial year or at the beginning of the financial year, or wait for some time, later on you leave? Is it possible? Not possible. Not possible. Why? Because we don't know. Death is certain, but what is the time of death? We don't know. At any point of time during the year, at any point of time, a partner may die. Whenever a partner died, then what is the accounting treatment? That is what we have to discuss. Whenever a partner died, then what is the accounting treatment? That we need to discuss now. Look at what are the adjustments we have to do when a partner died. Same revaluation of assets and liabilities, revaluation of assets and reassessment of liabilities. This is exactly similar to retirement of partner. Same memorandum revaluation concept also apply. Next one, distribution of reserves and accumulated profits, similar to retirement of partner. Next, computation of new profit sharing ratio and gaining ratio. Same. In case of retirement, the retiring partner will give his share to continuing partners. In case of death, already he died, his share of profit may be taken by the continuing partners. So gaining partners, the gaining partners will compensate goodwill to retiring partner, sorry, deceased partner. Next, valuation of goodwill. Yes, very important. In case of death of a partner, na, compulsorily they will ask valuation of goodwill concept. Whenever we get a problem on death of a partner, 99% chances are there. They give you information to value goodwill, and this valuation of goodwill is sure. And accounting treatment, simple. The accounting treatment for goodwill is same, similar to retirement of a partner. What is the entry we have recorded at the time of retirement of a partner? Gaining partner capital account debit to retiring partner capital account. I repeat, gaining partner capital account debit to retiring partner capital account. Here also same. Here, gaining partner capital account debit to deceased partner capital account. In the place of retiring partner, what we write? Deceased partner capital account. Yes sir, no students? Yes sir. Next, adjustments of life policy. The difference between adjustment of life policy in case of retirement and death is, in case of retirement, we receive surrender value. I repeat, in case of death, sorry, in case of retirement, we receive surrender value. In case of death, we receive full policy value. Suppose the full policy value is 10 lakhs. On the date of death, we receive total 10 lakhs. Not on the date of death. When a partner died, we receive 10 lakhs. But when a partner retired, we will not receive full amount of policy. We receive the amount of surrender value as on the date of surrendering the policy. As on the date of surrendering the policy. Hope you are following. Yes sir. Next, same JLP we have to check. If JLP is there in the balance sheet, suppose JLP is not there in the balance sheet, whatever the amount we receive, that is policy value, do remember, policy value that is distributed among partners are given credit to the revaluation account. Second one, JLP is there in the balance sheet. Here we have to discuss one thing. Look at, suppose in case of death, in case of death, I am preparing JLP account. Look at, in case of death, the JLP is showing 1 lakh balance, 2 balance brought down. 2 balance brought down how much? 1 lakh. Now partner died. How much amount we are receiving by bank? 10 lakhs. What is the entry we record? Bank account debit to joint life policy account, 10 lakh. But in case of retirement, we receive surrender value. Surrender value is 99.99% equal to opening balance. In that case, there is no balance in the JLP account to distribute. Clear students? Now what we have to do? Here in the JLP account, we have 9 lakh rupees surplus. 9 lakh rupees surplus. And this 9 lakh rupee is distributed to all partners, including deceased partner, because this 10 lakhs is received on the occasion of death of partner. That's why the remaining 9 lakhs is distributed among all partners, including deceased partner, in their profit sharing ratio, old profit sharing ratio. This is what we have to do. And in case of reserve method, what happens? Here we have JLP reserve. Here we have JLP reserve. See, when JLP is showing 1 lakh balance, JLP reserve also shows how much balance? 1 lakh balance. JLP also shows 1 lakh rupee balance. Okay. After, okay. On the death of partner, we received 10 lakhs. 9 lakh rupees distributed to all partners, including deceased partner, in their profit sharing ratio. Now, when JLP is not there, then what is the necessity of maintaining JLP reserve? This also distributed to all partners in their old profit sharing ratio. Over. Simple concept. Right now, simple trick. We can say it is simple trick. Now, yes, look at the next point. Next, this is the important point. Calculation of share of profit till the date of death. So what is the meaning of this? Suppose we have started the financial year. So we are in financial year 2024-25. We are in the financial year 2024 and 2025. Now we draw a timeline. This is a simple timeline. 1/4/2024 31/3/2025. This is the financial year. Okay. Let us assume on 1st August 2024, partner died. Partner died. Now what we have to do? Actually, we have to settle the account of deceased partner on exactly on 1st April, sorry, 1st August 2024, but it is not possible. Now what we have to do? Now, in addition to them, one extra adjustment which we have to do is from 1st April, from 1st April 2024 to 1st August 2024, we did the business. We have earned some profit. Now what we have to do? We have to give share of profit of deceased partner till the date of death. Till the date of death, out of the profit earned by the business, we have to give share to him. Now the question comes, sir, will we prepare the financial statements on 1/8/2024? No, not possible. Generally, we prepare financial statements on what date? 31/3/2025. Is it possible to prepare financial statements on 1/8/2024? Not possible, sir. Then what we have to do? Now what we do is we take revenue, we know from 1st April to 1st April 2024 to 1st August 2024. How many months? April, May, June, July. 4 months. For 4 months, how much revenue we generated? That is okay. But how much profit we earned? That we need, na? So that what we do is we take previous year profit. We take previous year profit. Previous year is what? 2023-24. Previous year is 2023-24. Previous year, let us assume we have earned 1,20,000 profit. Previous year profit. Now what we do is we take previous year profit as base. We assume the same amount of profit we earn in the financial year 2024-25. Now for how many months he is alive in the 2024-25? 4 months. Now what we do? This 1,20,000 we divide with the 12 months into 4 months. Per month we are calculating. 1,20,000 divided by 12. 10,000 per month profit we are assuming. And 4 months now 40,000 profit. This is not share of deceased partner. Profit of firm. Profit of firm. Now what is the share of deceased partner? Share of profit is equal to profit is 40,000 into, let us assume the share of profit is 1/4 for simple calculation. Now what is his share of profit? 10,000. 10,000. This is how we calculate. This is called time basis. Time basis. Current year profit it is not possible to calculate. So that what I am doing, I am taking previous year profit. I am assuming that the profit has been earned evenly throughout the year. Evenly throughout the year. This is my assumption. Evenly throughout the year. This is my assumption. So that's why I am dividing 1,20,000 divided by 12. In the current year, he is alive for 4 months into 4. Total profit is 40,000. So what is his share of profit? This is the profit for 4 months into his share 1/4, 10,000. Now for this we have to write one entry. What is that entry? Profit and loss suspense account debit. This entry is very, very important, students. This entry is very, very important. Profit and loss suspense account debit 10,000 to deceased partner capital account. Deceased partner capital account 10,000. Yes. Now deceased partner capital account is credited with 10,000. Here we have profit and loss suspense account balance. Now this is shown on the assets side of balance sheet. Important point. P&L suspense account we have to show on the assets side of balance sheet. At the end of the year, P&L suspense account is transferred to the P&L appropriation account. This is the important factor. This is one condition. It is time basis. Now second one is turnover basis or sales basis. Turnover basis. Turnover basis. What is that, sir? We see how much turnover business made during these 4 months. We calculate how much turnover, sales na. It is easy to identify how much sales made during 4 months. Let us say 4 months sales are, suppose 1 lakh, sir. 4 months sales are 1 lakh. Okay. On this 1 lakh, what is the gross profit ratio or net profit ratio? So generally business will earn some rate of profit now, and this rate of profit we take previous year, based on previous year data, we take the rate of profit into rate by 100. Let us say 10%, that comes 10,000 rupees, and this is taken as profit. This is taken as profit. And what is share of profit? This profit belongs to all partners, do remember. Now share of profit is equal to 10,000 into, let us say 1 by 4 is the share of profit of deceased partner. Now it comes 2,500. Same entry we record. Same entry we record. Profit and loss suspense account debit to deceased partner capital account. Yes. In case of death of partner, this is the exclusive point which we have to discuss. Share of, calculation of share of profit of the deceased partner till the date of death. Hope you understood. Now go to problem. Except this remaining, everything is simple, students. Similar to retirement of a partner. Similar to retirement of a partner. Next, adjustments of capital after death of a partner. This is also similar to retirement. Next, final settlement to the legal representatives of the deceased partner. In case of retirement, the amount due to the retiring partner is taken by him. But in case of death, he already died. Who will take the amount due to him? The legal representatives or executors. Is it clear? Yes. Students, if you are understanding this concept, please like the video and share it. Okay. Nobody is responding. Respond, students, respond. Now look at, we try to solve some problems on this concept. Problem number, tomorrow we have exam, so I hope your preparation is completed. Your preparation is completed. Okay. Tomorrow evening again we meet. Okay. Tomorrow evening again we meet at question paper analysis once again. Okay. Now look at illustration 1. The following was the balance sheet of Om and Co, in which XYZ were partners sharing profits and losses in the ratio of 1:2:2. As on 31st March 2022. Look at, okay, this is the closing date of the year. Mr. Z died on 31st December 2022. His account has to be settled under the following terms. Just a minute. Okay, now look at, Z died on 31st December 2022. How many months during the year? What is the financial year? 22, 23. 22, 23. For how many months he is alive during the year? For 9 months. 1st April to 31st December. For 9 months he is alive. Okay. His account has to be settled under the following terms. Okay, okay. Now I think it is audible, right? I hope this problem has some concept. That's why I am choosing. Initially, I am choosing easy problem to understand the concept. Later on, I am taking some tough problems. Okay, I hope you can understand. Now look at, trade payables 20,000, bank loan 50,000, general reserve. Yes. irrespective of any information about general reserve. First, if you have any further information about general reserve, you transfer, sorry, you distribute accordingly. Otherwise, you distribute straight away. To whom the general reserve is distributed? To partners X, Y, Z. Entry: general reserve account debit to X capital account, to Y capital account, to Z capital account. Next, capital balances, what we do? Open partners capital accounts and write down the opening balances. By balance brought down 40,000, 80,000 and 80,000. Next, building. Building is 1,20,000. Computers, inventories, trade receivables, cash at bank and investments 1 lakh. Fine. Now look at here, goodwill is to be calculated. I said already, whenever you get a problem on death of a partner, compulsorily they give you goodwill valuation. 99% chances are there, so be ready for that. Goodwill is to be calculated at the rate of 2 years purchase on the basis of average of 3 years profit and losses. Look at the profits and losses for the 3 years were detailed as below. These are the 3 years profits. First year 31st 3 2022, 21, 20. 30,000, 20,000, 10,000 loss. How much is the profit? If there are no adjustments, sometimes they may give you adjustments for these profits. Sometimes they may give you adjustments for these profits. You have to do adjustments. After that, you have to calculate average profit. But here, hope we don't have any adjustments. So straight away we can calculate goodwill. 30,000 plus 20,000, 50,000 minus loss 10,000. So that 40,000 is the total capital divided by 3 years. 40,000 divided by 3, we get 13,333 into, for how many years? As a rate of 2 years purchase into 2 years. So we get total 26,667 as our goodwill. Next one, profit for the period from 1/4/2022 to 31st December 2022 shall be ascertained proportionately on the basis of average profits and losses of the preceding 3 years. So here, previous year profits they are asking, take average profit. Based on that you calculate. Okay, fine. During the year ending on 31st December 2022, a car costing, this is very important, students. This is the hard adjustment in the problem. Look at, during the year ending 31st 3 2022, last year. Now we are on which date? 31st December 2022. 31st March 2022 is the previous year. A car costing 40,000 was purchased on 1/4/2021 and debited to traveling expenses account. That means treating capital expenditure as revenue expenditure. Okay, account on which depreciation is to be calculated at 20%. Suppose if I have written, or if I have written this car in the previous year itself, 21/22, 21/22, then this 40,000 entry is there in the books of accounts. Yes sir, car account debit to cash or bank account. Okay, in that case I will provide 20% depreciation na? Yes sir, in that case P&L account shows how much depreciation? 8,000. P&L account shows how much depreciation? 8,000. But how much amount you debited to P&L account? Sir, 40,000 sir. By traveling expenses you debited na? Yes. Means excess debit given 32,000. Excess debit is given 32,000. Now what we have to do? 32,000 we have to take it back. Reverse. Now car we have to bring to the books of accounts. Car we have to bring to the books of accounts. How sir? Simple. Car account debit, how much? 32,000. Car account debit 32,000 to partners capital account. Because this car we have to bring to the books of accounts. Yes sir. Earlier the profit is decreased na. So partners capital accounts have less credit. Now that's why what we do? Now we increase partners capital accounts. What is the entry we record? Car account debit to partners capital account. Car account debit to partners capital account. This is the adjustment we have to do. Look at. Just a minute. Yes. Partners capital account debit to car account. How much? 32,000. In which ratio? In their profit sharing ratio. In their profit sharing ratio. Next one. This asset is to be brought into account at the depreciation value. We brought asset at 32,000 after deduction of 20% depreciation in the last year. But now what they are saying? Now this asset we have to bring it to the books of accounts after deducting depreciation till 31st March. Because this asset is brought into books of accounts on 31st December. sorry, 31st December. Now what we do, on 32,000 we simply calculate depreciation. How much? 20% into 9 by 12. 9 by 12. 4,800 depreciation we calculate. 32,000 asset brought into books. At the same time, depreciation provided for 9 months. Entry, revaluation account debit to depreciation account. Revaluation account debit to depreciation account. Okay, now look at. Just a minute. Revaluation account debit to depreciation account. And here, if you observe the profits, previous year 2023, if the information is given like this, now this one, now it is the goodwill. But here, what is the information they are giving? They have treated capital expenditure as revenue expenditure, so that the profit on 31st March 2022 is affected. Now the profit on 31st March 2022 is affected. Now what we have to do? Profit is increased. Earlier 30,000 is the profit. Now we have to increase it to 62,000, because 32,000 is different. Now increase it to 62,000 profit. 31/3/2022, the profit is increased to 62. Look at. Anyway, next year profit is 20. 62 plus 20, 82 minus 10, 81,000. Based on that, we calculate depreciation. Sorry, goodwill. Look at. Average profit is how much? 72,000 divided by 3, 24,000. 24,000 into 2, 48,000. 48,000. Now, here itself, we calculate share of profit of Z also. They said take 3 years profits based on average profits and losses of preceding 3 years. Take 24,000. Take 24,000. 24,000 is the average profit. Out of that, take 9 months profit. 24,000 is the total profit of the firm. Take 9 months profit. 24,000 into 9 by 12. How much? 18,000. Out of 18,000, what is the share of Z? What is the share of Z? Share of Z is 2 by 5 into 2 by 5. Now how much it comes? 7,200. For this 7,200, what is the entry we record? Profit and loss suspense account debit to Z capital account. Over. Next, other values of assets were agreed as follows. Inventory 16,000. Observe what is the inventory value here. Inventory value is 20,000. It is decreased to 16, means 4,000 loss. Okay. Building at 1,40,000. Building original value how much? 1,20,000. 1,40,000 means increased. Okay. Revaluation account debit to building account. Next, computers 50,000, investments 6,000. Trade receivables were considered good, means no need to provide any doubtful debts. Computer value increase or decrease? Computers earlier 80, now 50, decreased. Next, investments. Investments earlier 20,000, sorry, just a minute. Investments earlier 10,000, now it is decreased to 6,000, means 4,000 loss. Now accordingly you can solve this problem. Fine. What is the requirement? Calculate goodwill, already calculated. Z share of profit, already calculated. Prepare revaluation account. Okay. Assuming that other items of assets and liabilities remain the same. Fine. Prepare partners capital account and balance sheet of the firm of Om and Co. as on 31st December 2022. Right. Whatever we understood, now you can do it as a problem. Next, look at. I am taking one more important problem here from death of a partner. This is one type of problem. They give you balance sheet, additional information. You have to calculate, you have to prepare partners capital accounts, valuation of goodwill, and preparation of new balance sheet, all those adjustments. We have another type of problem. Just a minute. Another type of problem is okay, just a minute. Okay, look at this problem, illustration 5. Then after we see illustration 5. Dia, Ria and Kia are partners of Messrs. DRK Fabrics, sharing profits and losses in the ratio of 2:1:2. On 31st March 2022, their balance sheet was as under. On 31st March 2022, their balance sheet was as under. Look at capital accounts as usual, simple. General reserve distribute to partners. Trade payables, look at the adjustment. If there is no adjustment, straight away take so the same 60,000 in the new balance sheet. Land and building, furniture, yes. Joint life policy, observe carefully. Joint life policy. Here joint life policy is shown in the balance sheet, means which method they are following? Surrender value method. Surrender value method. So joint life policy paid is treated as asset. Inventory how much? 88,740. Trade receivable how much? 96,740. 750 and bank balance 1,14,510. Now Kia died on 30th September 2022. Means till 30th September 2022, whatever the profit earned by the business, out of that we have to give share to Kia. Look at the adjustments. The partnership deed provides as follows: that partners be allowed interest at 12% per annum on their capitals, but no interest be charged on drawings. Interest on capital is provided, but interest on drawings not provided. Upon the death of a partner, the goodwill of the firm be valued at 1 year purchase of average net profits after charging interest on capital for the 4 years at 31st March preceding the death of a partner. See, this is the death of a partner. Compulsorily, they give you a concept on valuation of goodwill. Next, the profits of the firm before charging interest on capitals were. Here they are saying these capitals are before charging interest. Now what we have to do? From each year profit, we have to calculate, we have to deduct interest on capital. Interest on capital. Okay. Average capital during the preceding 4 years may be assumed as 3 lakh. Now we are on what date? 30th September 2022. These profits are relating to previous 4 years. To calculate interest on capital, we need to know in the year 2018-19 how much capital we have, 19-20, 20-21, 21-22, how much capital we have. Is it clear? But that's why to avoid all those confusions, they said on an average they have 3 lakh rupee capital during the 4 years. So on these 3 lakhs, we straight away calculate 12% interest. 3 lakhs into 12% interest, 36,000. What we can do is first we calculate average profit. Out of the average profit, here straight away you can deduct 36,000 interest on capital. Next, profits till the date of death be ascertained on the basis of average profit of previous 4 years. Profits till the date of death. Now what we do? Previous 4 years profits are averaged. Multiply with the number of months he is alive. Kia alive in the business. How many months Kia is alive? 1st April. April, May, June, July, August, September. For 6 months she is alive. So average profit into 6 by 12. We get business profit. Out of that, what is Kia's share? Kia's share is 2 by 5. 2 by 5. Is it clear? This is how we calculate profit. Next, upon the death of a partner, she is to be credited with her share of profit. Okay, calculated. Interest on capital. Okay, we provide. And etc. calculated till the date of death. If you observe, till 30th September 2022, we have to give interest on capital also. We have to provide interest on capital also. Fine. Next one. After the death of Kia, 2 lakh was received from insurance company against joint life policy. If you observe, here joint life policy is shown at 60,000, but we received 2 lakhs. 2 lakhs minus 60,000, remaining 1,40,000 is distributed to all partners. Land and building was appreciated by 20%, revaluation account debit to land and building account. Furniture to be depreciated by 10%, revaluation to furniture. Inventory to be revalued at 80. What is the inventory value originally? 88,740. Now they revalued at 80. So 8,740 decrease. Bad debts amounted 1,760. Bad debts. So permanently reduction. Revaluation account debit to trade receivables 1,760. Next, amount payable to Kia was paid in cash. Finally, whatever the amount due to Kia was paid in cash. Okay. Now you are required to prepare revaluation account, partners capital accounts, and balance as on 30th September. Balance sheet as on 30th September 2022. Assuming that other assets and liabilities remaining the same. Is it clear, students? Yes. Look at the revaluation account. Simple. Only you have to make the changes. Finally, what is the amount due to Kia? 2,79,800. Okay, here joint life policy is distributed among partners. Look at 1,40,000. And sometimes they may ask only prepare Kia capital account and executors of Kia account in that case. And one more important thing, interest on capital. What is Kia's capital? 70,000, opening capital 70,000 into what is the rate of interest? 12%, 12 by 100. She is allowed for 6 months, 6 by 12. 70,000 into 12% into 6 by 12. This comes 4,200. And in the balance sheet, and look at share of profit, 27,600 share of profit. Clear? Look at average capital, 162 plus 199 plus 187 plus 196. This is the average profit, 7 by 4 minus 36,000. 1,50,000 is the average capital into 6 months, 6 by 12. 75,000. Out of that, her share of profit is 2 by 5. Yeah, just a minute. 1,86,000. 1,86,000. Okay. Okay. How much it is? 1,50,000 average profit minus we have to deduct interest on capital of all partners. What is the interest on capital of all partners? Observe here. Yeah, this is goodwill, average profit same 7,44,000. 1,86,000 is the average profit. From that we deduct interest on capital 36,000. What is the average capital here? 1,50,000. 1,50,000 multi 1 year profit na. Goodwill is calculated at 1 year purchase. So 1,50,000. What is Kia share? 2 by 5, 60,000. This is contributed by gaining partners. Look at who are the gaining partners. Calculate gaining partners. Okay, journal entry. This is a journal entry. Okay. Now Kia share of profit. Look at total profit 1,86,000. Out of that we take 6 months profit 93,000. Till the date of death 30th September. How much interest on capital is provided? We have to provide interest on capital. Na? Total capital is how much? Tell me. Total capital is 1.5 lakh plus 1,80,000 plus 70,000. 4 lakhs na. 4 lakhs into 12% into 6 by 12. For 6 months is calculated 24,000. 24,000. Now look at what is the remaining profit? 69,000. Out of 69,000, 2 by 4. Sorry, 2 by 5. 27,600. Next. That's it. Simple problem. Okay. This type of problem, there may be chances of getting this type of problem in the exam. Clear? So with this, I am closing death of a partner. But do remember students, in case of death of a partner, compulsorily they will ask goodwill adjustment. And sometimes they may ask prepare executors of deceased partner account. Nothing but first calculate. In that case, what we have to do, first calculate amount due to deceased partner. After that, transfer the total amount to executors account. From there, the executors account, from there the amount may be transferred to executors loan account. Okay, now look at. Now come to dissolution of partnership firm. Dissolution of partnership firm. This is also very important chapter. This time we may expect a problem from dissolution of partnership firm. We may expect a problem from this chapter. Look at dissolution of partnership firm means what? The partnership business is completely closed. Now the relationship between all partners comes to an end and the business is closed. When the business is closed, then how do we close the books of accounts? See, when business is opened, the books of accounts also opened. When the business is closed, then the books of accounts also closed. Yes or no? How do we close the books of accounts? And how do we settle the outside liabilities? And how do we repay the capital amounts due to the partners? This is what we learn in this chapter, dissolution of partnership firm. Okay, in case of dissolution of partnership firm, what we have to do, we have to completely close all the books of accounts. Okay, now look at what is the accounting treatment we have to follow. First, look at the consequences of dissolution of partnership firm. First, the books of accounts are closed. Fine. The assets of the firm, including goodwill, are realized first. Out of the proceeds of realization, we repay amount to the outside liabilities first. Okay, look at the application of the amount. First, realization expenses. Fine. Payment of outside liabilities. Next, repayment of partners' loans. If any loan taken, see, loan taken from partner is not an outside liability. Okay. Next, repayment of partners' capital balance. If still has any surplus amount, then that is also distributed to partners in their profit sharing ratio. This is what this is happened. This happens after dissolution of partnership firm. Next, look at accounting for dissolution of partnership firm. Whenever you get a problem on dissolution of partnership firm, then prepare these many accounts. 1. Realization account. Once the partnership business is closed, then we start realizing the assets and we start repaying the amounts due to outside liabilities. During this process of realization, if we get any profit or loss, that is transferred to the partners. To know whether we get profit or loss on the realization process, we are preparing a new account called realization account. In case of admission, retirement and death, we have prepared revaluation account to know the profit or loss on revaluation process. And here we prepare realization account to know profit or loss on realization of assets and repayment of liabilities. And this profit or loss on realization is distributed to partners. Now look at, first we prepare realization account. Next, loan taken from partner account is prepared if required. Next, loan given to partner account is prepared separately. Next, partners capital accounts and cash or bank account. Most and important, we prepare realization account most of the times, and partners capital accounts and cash or bank account we prepare. Now look at closing procedure. What we do? Now they give you balance sheet. Now they give you balance sheet and they tell you these many assets are realized and this much of liabilities paid, and finally partners account settled. Now what we have to do? First, we have to empty the balance sheet. From balance sheet, first come to assets side. All assets are transferred to realization account, because asset account we have to close now. All ledger accounts must be closed. Whatever the ledger accounts contains in the balance sheet, asset side, all the ledger accounts of assets or asset account balances are transferred to the realization account. Whenever you are transferring assets, all assets to the realization account, do remember one thing. First, asset account balances we have to transfer to the realization account at their book value. Second, cash account balance or bank account balance not transferred to the realization account. Third, if any partner capital account is showing debit balance, or if any partner's current account is showing debit balance, then don't transfer. Next, if any advance given to the partner account is showing on the asset side of balance sheet, then don't transfer. And if any fictitious assets or any debit balance in the profit and loss account is showing on the asset side of balance sheet, don't transfer. Except these accounts, remaining all accounts are transferred to the, including goodwill. Goodwill also can be transferred to the realization account at their book values. Because now let us assume building I have in the books at 1 lakh. To close the building account, what I have to do? Credit building with 1 lakh, then only building account closed now. That's why the assets are transferred at their book values. And one more important thing, if you have any provisions against any fixed assets or current assets, these provisions are transferred separately. Means, suppose if we have provision for doubtful debts 1000 rupees, debtors 10,000. Whenever you are transferring debtors account to realization account, transfer at 10,000. Provision 1000 separately. Okay, next. Or suppose if you have any provision for depreciation on any asset, building, suppose on building we have provision for depreciation, building you transfer at 1 lakh, provision separately you transfer, because provision shows debit balance, right? Next, transfer all liabilities to outsiders and provisions against assets. Liability shows credit balance na, transfer debit, liabilities account debit to realization account. Which liabilities? Only outside liabilities, not liabilities to partners. Whenever you are transferring liabilities to realization account, do remember, don't transfer capital account balances, don't transfer any loan taken from partner account, and don't transfer any current account balances also. Remaining all accounts you can transfer. Next, on realization of assets. Now what we do, we start realizing the assets. We start realizing the assets. Entry, bank account debit to realization. Whenever you are realizing the assets, do remember one thing. One, realization assets can be realized in cash. In that case, entry, bank account debit to realization account. Second, assets can be taken by the partner. Sometimes assets may be taken by the partner. In that case, what is the entry we record? Assets, sorry, realization account debit. Oh, once again, partner's capital account debit to realization account. If it is sold, then what is the entry? Bank account debit to realization. If it is taken by partners, then what is the entry? Partners capital account debit to realization. Sometimes any asset may be given to liability holders. I repeat, sometimes any asset may be given to liability holders to settle the liability. In that case, no need to record any separate entry. Why? Because in our books, liability account closed. In our books, asset account also closed. Now what we are doing, just we are physically handovering the asset to liability holders. In that case, no need to record any separate entry. Check in the problem that whether any asset is released in cash, or any asset is taken by the partner, or any asset is given to liability holders to settle their accounts. Is it clear? Based on that, we have to write the entry. On realization of asset, if it is realized, cash or bank account debit to realization. If partner taken, partner's capital account debit to realization. On making payments of external liability, and do more, at the time of making payment to external liabilities, do remember one thing. First one, external liabilities paid by the business. Entry, realization account debit to cash or bank account. If you receive any discount at the time of making payment to outside liabilities, don't consider discount. Whatever the amount you are paying, record entry for that. Don't write the entry realization account debit to cash account to discount received account. No. Write down the actual amount paid. Second, if any liability is agreed to pay by the partner, suppose there is one liability called loan from spouse of partner. Loan from spouse of a partner. In that case, what is the entry we have to write? This loan is agreed. See, loan from spouse of a partner is outside liability. It is not internal liability. It is outside liability. Now, this liability is agreed by the partner. Yes, part. In that case, what is the entry we got? Realization account debit to partner's capital account. Realization account debit to partner's capital account. These are the points we have to remember at the time of making payment to them. And whenever we are paying liability by giving an asset, we are settling the liability by giving an asset. Give the asset. That's it. No need to record the any entry. Next, expenses on dissolution of firm. On at the time of dissolution, we actually employ one person. Okay, liquidator, official liquidator or liquidator, whoever it may be. He will look after the proceedings of realization. In that case, what is the entry we record? Realization account debit to cash or bank account. If the realization expense is paid by the partner, then realization account debit to partner's capital account. Next one. Now look at unrecorded asset sold or taken over by any partner. Suppose at the time of realization of assets, if you find any unrecorded asset, in that case what we have to do, you need not to record any entry for that. But in case of retirement or death or admission, we have recorded entry for unrecorded asset, but here you need not to record. Straight away, what is the entry we record? Cash or bank account debit if it is realized. If it is taken by partner, partner capital account debit to realization account. Over. Next, if any unrecorded liability is paid, no need to record any entry, separate entry for recognizing liability in the books of accounts. Why? We are closing the books of accounts now. What is the necessity of recording liability again? So straight away pay the liability. Entry realization account debit to cash or bank account. After doing adjustments till ninth one, after doing all these transactions, after recording all these transactions, now what we have to do? Our realization account shows either profit or loss. Realization account credit more than debit, then it is realization profit. If realization account debit side is more than credit, then it is realization loss. It is distributed to the partners. If it is profit, realization account debit to partners capital account. If it is loss, partners capital account debit to realization account. Now the realization account looks like this. Clear everybody? Right. Now settlement of partners accounts. After completion of realization procedure, how partners capital accounts are closed. Now, after making payment to all outside liabilities, now partners loan is repaid. Entry partners loan account debit to cash or bank account. Suppose if any partner capital account is showing debit balance, I repeat, if any partner capital account, suppose A is a partner, his capital account showing debit balance, whereas his loan account showing credit balance, because means the firm borrowed amount from him. In that case, you need not to pay amount to the A. Simply adjust the loan account against the capital, because loan firm has to pay loan amount to A has to pay capital amount to firm. Adjust it. Okay. Next one. Transfer of current account balance to capital account. If suppose if partners are maintaining fixed capital method, in that case they maintain two accounts now, capital account and current account. In that case, current account balance is closed by transferring it to partners capital account. Next, transfer of current account debit balances. Any debit balance is there, same, transfer to partners capital account. Next, transfer of any reserves and accumulated profits, straight away transfer to the partners capital account. In case of admission, retirement, death, what we did, all the reserves and accumulated profits are transferred to the partners capital account. Next, transfer of any accumulated losses, here also same, losses shows debit balance na, transfer partners capital account debit to losses account. Next, if any partner capital account shows a debit balance, after doing all the adjustments, suppose there are three partners A, B, C. After doing all the adjustments, suppose C capital account is showing debit balance. Generally, capital account shows which balance? Credit balance. If any partner capital account is showing debit balance, means he has to bring that much of amount to the firm. He has to pay that much of amount to the firm. When he is in a position, to pay that amount, then record the entry cash or bank account debit to partners. It is not a particular partner capital account. The partner whose account is showing debit balance. Okay. Or else suppose if any partner capital account is showing debit balance, he is unable to bring that amount to the firm, then he is said to be insolvent. In that case, the insolvent partner's loss, whatever the capital deficiency, this is called capital deficiency, whatever the capital deficiency is there, that is borne by solvent partners, that we discuss in case of insolvency. Okay, now come to next point, payment of credit balance after final balancing. Finally, whatever the amount due to all partners, settle. In that case, what is the entry we record? Partners capital account debit to cash or bank account. With this, partnership books of accounts closed and dissolution also completed. Now look at, based on this, we try to solve one simple problem. Not simple problem, actual problem. Observe. See, look at, X, Y and Z are partners of the firm XYZ and Co, sharing profits and losses in the ratio of 4:3:2. X, Y and Z are partners of the firm XYZ and Co, sharing profits and losses in the ratio of 4:3:2. Following is the balance sheet of the firm as on 31st March 22. Balance sheet as on 31st March 2022. Look at, fixed assets, stock in trade, sundry debtors, cash in hand. Partners capitals XYZ 4 lakh, 3 lakh, 2 lakh. General reserve, sundry creditors. Now you people tell me, out of the assets, which assets are transferred to realization account? Fixed assets transferred, sundry stock in trade, sundry debtors. These three are transferred to the realization account. Entry realization account debit to fixed assets, to stock in trade, to sundry debtors. Book values. Cash in hand, open cash account. Open cash account, debit balance, to balance brought down 10,000. Now here partners capital accounts are there. Open partners capital accounts, show these balances as credit balances, buy balance brought down. Now general reserve, immediately distribute to partners. General reserve account to debit to XYZ capital account in their old profit sharing ratio. Next, sundry creditors. Sundry creditors. Sundry creditors transfer to realization account. Entry. Sundry creditors account debit to realization account. Next, partners of the firm decided to dissolve the firm on the above said date. Okay, fine. Fixed assets realized 5,20,000 and book debts 4,40,000. Stocks were valued at 2,50,000 and it was taken over by partner. Means, and one more thing we have to remember is here total how many assets we have. Fixed assets, stock in trade, sundry debtors. We have to see that whether all assets are realized or not. We have to see that whether all assets are realized or not. If it is a tangible asset, we have to check whether all assets are realized or not. If any particular asset is not given, whether it is realized or not, in that case we assume that this particular asset is realized in cash at book value. This particular asset is realized in cash at book value. When it comes to intangible asset, suppose in the books of accounts we have goodwill. Goodwill first transferred to the realization account. In the problem they did not mention whether goodwill is realized or not. In that case, we assume that goodwill is not realized. Its realizable value is 0. Suppose patents are there. Patents first transferred to the realization account. Next, it is not given whether patents are realized or not. What we assume? We assume that patents are not realized because it is intangible asset. This is the assumption we have to take. But in case of tangible assets, we have to see that whether all assets are realized. No, sir. In that case, this particular tangible asset is realized at book value. That is the assumption we have to take. Now here you observe fixed assets realized, book debts nothing but sundry debtors realized. Now stock is taken by Y. What is the entry we record for fixed assets realization and book debts realization? Bank account, cash or bank account debit to realization account. And what is the entry here we record? Who is taking? Y is taking. Y capital account debit to realization account 2,50,000. Next, creditors allowed discount 5%. I already said if any discount allowed by creditors, don't consider. What is the amount payable to creditors? 3,20,000. Minus how much discount they are giving? 5%. So how much amount we have to pay to them? 3,04,000. Pay 3,04,000 straight away. What is the entry we record? Realization account debit to bank account, cash or bank account. Over. That's it. Next, and the expenses of realization amounted to 600. What is the entry for expenses of realization? Realization account debit to cash or bank account 6,000. Over. Prepare realization account, partners capital account and cash account. At the end, after completion of realization procedure, after repayment of partners loans, all those things. Now if you observe partners capital accounts and cash account, whatever the amount due to the partners, all partners, that should be matched with the cash balance which you have finally. I repeat, if you balance partners capital accounts, you can come to know that how much amount due to them. This must be equal or this must be tallied with the cash balance which you have. This must be tallied with the cash balance which you have. Is it clear, students? Yes, sir. Next. So this is how we solve the problem. Look at realization account. Yes, the profit or loss. If credit is more than debit, it is profit. If debit is more than credit, it is loss. Next, partners capital account. Observe here. These are the final balances of partners. These are the final balances of our final amounts payable to the partners. This must be equal with the cash balance. Before recording the final payment entry, the cash balance or cash account balance must be equal to partners capital account balance. Is it clear, students? Yes, sir. Now look at Yeah, this is the simple problem. Now look at, we try to solve another problem. Huh. Here I will discuss when a partner becomes insolvent. When a partner becomes insolvent, sometimes we get this concept also in the dissolution. Insolvency of a partner. Previously, I have discussed that after doing all the adjustments, if any partner capital account is showing debit balance, means he has to bring that much of capital to the firm. If he becomes insolvent, in that case, he is unable to bring that amount. Na? So, whatever the amount of capital not able to bring by the partner, this particular amount is called capital deficiency. This particular amount is called capital deficiency. And who has to bear this capital deficiency? Unless this short capital brought by either in that particular partner or other partners, it is not possible to settle the remaining partners capital accounts. Why? Already just now I told you, before repayment of capitals due to the partners, check that partners capital account balances must be equal with the cash account balance. But here one partner capital account is showing debit balance and other partners capital accounts are showing credit balance. Means this partner whose capital account showing debit balance, he has to bring that amount. In that case, the amount will be matched. Otherwise, the cash balance is not equal to the amount due, final amount due to the other partners. Now, who has to bear this capital deficiency? The capital deficiency may be borne by other partners in any ratio. In any ratio, that may be in their profit sharing ratio, or that may be in their other any particular agreed ratio, whatever it may be. That depends on partnership deed first of all, or the mutual agreement between the remaining partners or solvent partners. If nothing is happened, then we have to follow one rule. What is that rule, sir? Garner versus Murray rule. Garner versus Murray rule. This rule we have to follow. What this rule says? This rule says that whatever the capital deficiency we have, capital deficiency of insolvent partner, that is borne by the solvent partners in their capital ratio. Which ratio? Capital ratio, not in regular profit sharing ratio, because it is capital loss. Capital loss we have to bear in their capital ratio. Here the problem comes. Sir, capital ratio means what? Capital ratio means they may follow fixed capital or they may follow fluctuating capital. If partners follows fixed capital method, then we prepare fixed capital account and current account. Whatever the capital account balances we have, those capital account balances are taken as capital ratio. But in case of fluctuating capital method, what we do? After doing all adjustments, I repeat, after doing all adjustments, but before distribution of realization profit or loss, after doing all adjustments means if partnership deed provides remuneration, salary or interest on capital, interest on drawings, any distribution of general reserves balances, all those things. After distribution of all those things, but before distribution of realization profit or loss, whatever the capital balances we have, that capital balances are taken as capital ratio. That capital balances are taken as capital ratio. Do remember, students. Is it clear? Yes, sir. Next point, what he is saying, the solvent partners should bring in cash equal to their respective shares of the loss on realization. One more condition he is saying. Suppose in the during the dissolution process, if we have any realization loss, I repeat, if we have any realization loss, that particular realization loss, other partners should bring in cash. I repeat, during the process of realization or after completion of all the realization process, if realization account shows any loss, that particular loss amount, all the partners including insolvent partner, as much of as possible, they have to contribute in cash. Suppose realization loss distributed to partners A, B, C, 10,000, 10,000, 10,000. This is the realization loss distributed. C became insolvent. Means C is unable to bring the amount. Na? Yes. Remaining two partners A and B, they have to contribute 10,000 realization loss in cash. This is just a notional entry. This is just a notional entry which we record. Okay, next. Based on this concept, now we try to solve one problem. Insolvency of a partner. Insolvency of a partner. This is not this one. Yeah, look at illustration 2. Look at illustration 2. Illustration 2. P, Q and R were partners sharing profits and losses in the ratio of 3:2:1. No partnership salary or interest on capital being allowed. Means no partner is eligible to take interest on capital or any salaries. Their balance sheet on 30th June 2022 is as follows. Their balance sheet on 30th June 2022 is as follows. Look at fixed capital. They are following which capital? Fixed capital. P capital, Q capital, R capital. Prepare partners capital account. Opening balances by balance brought down. And current accounts. Open current accounts also. P account showing credit balances by balance brought down. Whereas if you observe our current account is showing debit balance, means two balance brought down. Next one, loan from P. P borrowed, the firm borrowed amount from P. Open a separate account, loan from P. Next one, trade creditors. Trade creditors transfer to realization account. Creditors account debit to realization account. Next one, assets side come. Fixed assets. Trademark, freehold property, plant and equipment, motor vehicle. These are the fixed assets. Transfer to P&L, sorry, realization account. Entry. Realization account debit to assets account. Here transfer value assets at book values. Observe here trademark is intangible asset. Check in the problem that whether the intangible assets are realized or not. Current assets, stock 3,900, trade debtors 2,000, provision 100. Do remember, provision is separate. Provision is separately transferred. Now what is the entry for this? Realization account debit to stock account 3,900. We write total entry, fixed assets and current assets. Realization account debit to stock account 3,900, debtors 2,000, cash at bank separately open the account. And miscellaneous losses, don't transfer these miscellaneous losses. So finally, how many accounts we transfer? Trademark, freehold property, plant and machinery, motor vehicle, stock, debtors. But debtors are transferred at 2,000 rupees, not at 1,900. Now what we do? Our current account anyway we have opened. Profit and loss account, which balance it is? Debit balance. Accumulated loss. Distribute to partners. Entry. Profit and loss account already showing debit balance na? Yes sir. Partners capital account debit to profit and loss account. Or else we can do one thing. Here current account balances are there na? Generally, if we get profit, to which account we transfer? Current account. They are maintaining two accounts, capital and current. And this accumulated loss first transfer to current account. This accumulated loss of 12,000 transfer to current account first. Now balance current accounts. Final balances of current accounts transfer to capital account. This procedure also we can follow. Next. On 1st July 2022, the partnership was dissolved. Fine. Motor vehicle was taken over by Q. Immediately, what is the entry we record? Q capital account debit to motor vehicle account at a value of 500. Okay, but no cash passed specifically in respect of this transaction. He has not paid any cash. So, okay, so that what is the entry we record? Q capital account debit to realization account. Next, sale of other assets realized the following amounts. Don't forget to compare whether assets shown in the balance sheet are realized or not. Look at motor vehicle anyway realized. Total how many assets we have? Trademarks, freehold property, plant and machinery, motor vehicle 4, stock, debtors. Total 6. Out of them motor vehicle realized. Next, trademarks realized nil. They said freehold property realized, planted machinery, stock, and trade debtors. Total amount realized this much 7,000, 5,000, 3,000, and 1,600. This much of amount realized. Entry bank account debit to realization account. Over. Next, total creditors were paid 11,700 in full settlement of their debts. What is the amount due to total creditors? 12,400. What about remaining difference? 300 plus 400. 700 difference is nothing but discount received. No need to write separate entry for discount received. Finally, what is the entry we record? Realization account debit to bank. Next, the cost of dissolution amounted to 1,500. Nothing but realization expenses. Entry realization expenses account debit to bank account. The loan from P was repaid. Entry loan from P account debit to bank account. P and Q were both fully solvent and able to bring in any cash required, but R was forced into bankruptcy. R was forced into bankruptcy. Here, insolvent. There are two situations. One, all partners insolvent. All partners insolvent. Two, only one or more partners insolvent, but not all partners. In this situation, we have three partners. Three partners P, Q, R. Who became insolvent? R. Not all partners. Na? Yes, insolvent. When a person becomes insolvent, a partner becomes insolvent, whatever the amount of deficiency, capital deficiency is there, that is borne by remaining solvent partners. Who are the solvent partners? P and Q. What ratio? Capital ratio. Already capital ratio is given now 20,000 and 20,000. 2 is to 2. 1 is to 1. 1 is to 1. Fine. Finally, and was only able to bring 1/3 of the amount due. Are bankrupt, but how much amount he is able to bring? 1/3. 1/3. Required cash and bank account we have to prepare. Realization account we have to prepare. Partners capital account we have to prepare after transferring current account balances. That's it. This is the requirement. Already I have explained whole problem. Now only the thing is answer. Right? Now look at. Here check whether realization account has profit or loss. If realization account has loss, that loss should brought by the partners in cash. In which situation? Insolvency situation. That is a point we have to consider. Look at. Here we have a loss. How much loss? Total 51,000 rupees loss. Anyway, R is not in a position to bring the loss, 8,500. Then who has to bring? P and Q. Look at whether this entry has been passed or not. First, share this realization loss. Yes, this is the sharing of realization loss. And the same amount is brought by partners. Look at 25,500 and 17,000. We need to check this. Finally, what is the amount due from R? For that, balance R capital account 10,000 plus 300. Sorry, 10,000. Debit side, look at 2,400 plus 8,500. Total 10,900. Minus credit side 10,000. So how much amount R should bring? 900. Now he is not in a position to bring 900 now, but he is in a position to bring 1/3 amount. How much? 300. Write down the entry for 300. Bank account debit to R capital 300. Now finally how much amount he is unable to bring? 600 rupees. And that this 600 becomes capital deficiency. This is borne by P and Q in which ratio? Equal 1 is to 1. Means 300 by Q, P 300 by Q. Entry R capital account debit. Sorry, P and Q capital account debit to R capital account. P and Q capital account debit. Look at 600 by R capital account. Sorry, by P and Q capital account 600. With this, R capital account gets closed. With this, R capital account gets closed. Observe carefully. After closing R account only, I repeat, after closing insolvent partner capital account, I repeat, after closing insolvent partner capital account, we have to close remaining partners capital accounts. We have to close remaining partners capital accounts. Do remember. Finally, remaining partners capital account balances should be matched with the cash balance which we have. Clear. This is insolvency of partner. You may ask, sir, in case if all partners becomes insolvent, then what we have to do? I- All partners become insolvent means we are unable to pay the amount due to creditors. If we can pay amount due to creditors, then it is okay. But when all partners become insolvent, we are unable to pay amount due to the creditors. In that case, don't transfer creditor account balance to realization account. Realization account. In that case, what is the approach we have to follow? Look at insolvency of all partners. When all partners become insolvent, don't transfer assets. Transfer assets to realization account, but don't transfer creditors or outside liabilities to realization account. We have to deal creditors or outside liabilities separately. Don't transfer. Now, realization of assets, sorry, transfer assets to realization completed. Don't transfer liabilities. Instead of transferring liabilities, open liability account separately. Now start realizing the assets one by one. Out of the proceeds of realization, first repay as much as amount possible to creditors. As much possible amount due to creditors. For that, what is the entry we record? Creditors account debit. Creditors account debit to bank account. Suppose amount due to creditors is 1 lakh, but with us we have only 50,000 rupees. What about remaining 50,000? We are unable to pay, na? Yes, sir. So 50,000 we transfer to deficiency account. Means this much of 50,000 we are unable to pay. This much of 50,000 we are unable to pay. Transfer this amount to deficiency account. Finally, balance all partners capital accounts. All partners shows debit balances only. Why? Because all partners became insolvent now. All partners capital account shows debit balances. Now, whatever the deficiency we have, credit 50,000, transfer to partners capital account. Here deficiency credit, their partners capital account debit, transfer. Deficiency account debit to partners capital account. Automatically all accounts gets completed. This is the concept of insolvency of all partners. Now we go to another important concept, that is piecemeal payments or piecemeal distribution. This time we may expect this type of question. Why? Because in the first attempt, June 2024, they have asked a question on piecemeal payments. After that, September 2024 and January 2025, they have not asked a question from this piecemeal payments or distribution. This time we are expecting a question from piecemeal payments or distribution. Look at, observe carefully. Till now, whatever the dissolution procedure we have observed, I repeat, till now, whatever the dissolution procedure we have observed, that we assumed that on a single day, all assets realized, all amounts due to outside liabilities are paid, realization expenses paid, and partners capital accounts also completed. Total dissolution process happened in one day. That is what we observed now, previous problems. But practically it will not happen. Practically what happens? Okay, we resolved that from 31st March 2025. I repeat, we resolved that from 31st March 2025 we are closing the business. Okay, stop all business operations. Stop all business operations. Okay, sir. From 1/4/2025, from 1/4/2025, you start the proceedings of realization of assets. Clear? All assets of the business, it is not possible to realize on a single day. These assets are realized one by one. One by one. Now, what is here the assumption is whenever the assets realized, we start distributing that amount to first realization expenses, after that amounts due to outside liabilities. After repayment of amount due to outside liabilities and partners loans, all those things, now the amount due to partners. Now come to the amount due to partners. Here the amount available is less, but whereas amount payable to partners are more. I repeat, here in our hand amount distributable amount is less, whereas amount due to partners are more. In this scenario, how do you deal? How do you deal with this scenario? I repeat, from 1/4/2025 we start realizing one by one asset. Whenever asset realized, we distribute amount due to the outsiders, or amount of after distribution of amount due to the outsiders, as per a particular ratio or as per the preference. Some secured creditors are there, unsecured creditors are there. To the secured creditors we repay the amount first, to the unsecured creditors we repay the amount proportionately or as a percentage, some percentage. After payment to creditors, remaining amount payable to partners loans. Okay, partners loans also repaid. Now the next preference is to partners capital account. Amount due to partners capital account is more, but the amount available to distribute is less. How do you deal with this scenario? You may ask, sir, why are you thinking, sir? Whatever the amount you have na, that amount distribute to partners. How do you distribute? There are three partners A, B, C. A is asking, sir, please give me that amount, sir. I have to go to some Dubai, or I have to go to some US, sir, for a trip. Anyway, business is closed now, sir. Give me that amount. I will go to some pleasure trip, sir. Huh? Okay. B is asking, sir, please give that amount to me because business is closed, sir. I have to pay college fees or school fees for my children. C is asking, sir, please give me that amount to me because some medical emergency, sir. No, it is not possible. Okay, the available amount, if all partners agree, practically, if all partners agree, okay, the amount is shared by us in this manner. Okay, you can distribute, no disputes. Distribute, no disputes. But when it comes to accounting, now dispute comes. That's why the available amount is less. Available amount is less, but amount due to partners, I repeat, amount due to partners are more. How do we deal with this situation or scenario? That is the concept. Here we have two methods. One is maximum possible loss method. Second one is highest relative capital method or surplus capital method or proportionate capital method. Sir, which method is important, sir? We cannot say, because in the examination they may ask any method. Sir, what is maximum loss method? What is highest relative capital method? Now we enter into that. Look at maximum loss method. Here we have to follow certain steps. First one, prepare a statement showing distribution of cash. We are realizing the assets, na? Yes, sir. Out of the proceeds of realization, how you are distributing the amount? So prepare a statement showing distribution of cash. After that, pay off the external liabilities. Out of the proceeds, first pay off the external liabilities. Okay, sir. After all the payment is made for external liabilities, the partners will be paid off. Yes or no? Yes, sir. All the liabilities are paid, sir. Now the next preference is to partners. Okay. Check how much is the amount due to partner. Suppose, let us say the amount due to partner is 1 lakh, sir. Acha. Okay, fine. Deduct the amount available. Sir, amount available is just 5,000, sir. Amount available is just 5,000. Then tell me, what is the deficiency amount? How much amount we are unable to pay? Sir, 95,000, sir. Do one thing. Treat this 5,000 as final settlement. Assume remaining assets we have to realize. There are some assets to realize, but at present, I have only 5,000 rupees. Okay. If this is the final settlement, assume in your mind, if this is the final settlement, then how do you settle the partner's capital account? If this is the final settlement, then how do you settle the partner's capital account? Tell me. Yes, sir, I will do one thing. Whatever the remaining amount of loss is there, this loss, first I will distribute to the partners in their profit sharing ratio. Fine. After distribution of this 95,000 rupees, if all partners capital accounts shows credit balance of 5000, ultimately partners capital account shows credit balance of 5000, and this 5000 I will pay to them. Okay, suppose if any partner account shows debit balance, then what is the scenario? This 95,000 we are distributing now. This 95,000 rupees we are distributing. Yes. During the distribution of this 95,000, if any partner capital account shows debit balance, then what is the scenario? Sir, partner capital account shows debit balance means he has to bring the amount to the firm now, sir. Ah, yes, why not? But what that particular partner says, hello, mister, this is just imagination. This is just imagination, not actual, na. Why, sir? Already we have assets to realize. Why are you asking me amount? Why are you asking me amount of deficiency? Already we have assets, na. Yes. Okay. Then this is treated as notional deficiency. Notional deficiency. We treat that particular partner as notional insolvent. Notional insolvent. He is not actually insolvent. We imagine he is insolvent. Then what is the procedure? Okay. What is the amount to due from him? So and so amount. When a particular partner is insolvent, then what is the rule we follow? Garner versus Murray rule. What is the rule of Garner versus Murray? Distribute the deficiency amount to remaining partners. The same logic we follow here. Till the repayment of last installment, we follow this procedure. What is that? First we take what is the total amount due to partner. Before distribution of amount to the partners, we take what is the amount due to the partner minus available cash. Remaining amount is treated as maximum loss. We treat every settlement, every installment is the last and final installment. In that manner, we start distributing amount to the partners. During the process of distribution of maximum loss, if any partner capital account shows debit balance, means negative, then the negative amount is redistributed to the solvent partners in their capital ratio. So that here we have to follow Garner versus Murray rule. Okay, next. The maximum loss shall be shared amongst the partners in their profit sharing ratio as if there will be no further realization. Now, whatever the steps I have followed, I have discussed till now the same steps here. Based on this, we try to solve one problem. I repeat, students, this method is very, very important. Maximum loss method, piecemeal distribution, piecemeal payment is important. Why? Because since 2 attempts they are not asked, they have not asked a question from this concept. Now look at illustration 6. Observe illustration 6. Maximum loss method. First one, read. A, B and C are partners sharing profits and losses in the ratio of 5:3:2. Their capitals were 9,600, 6,000, 8,400 respectively. Fine. After paying creditors, the liabilities and assets of the firm were, look at, liability for interest on loans from spouse of partner. Spouse of partner is always taken as outside liability, and partner's loan or any interest due to partner is taken as internal liability, separately paid. Investments we have 1000, furniture we have 2000, machinery 1200, stock 4000. The assets realized in full in order in which they are listed above. Means first investments realized, after that furniture realized, after that machinery realized, after that stock realized. Okay, you are required to prepare a statement showing the distribution of cash as and when available, applying the maximum possible loss procedure. First we prepare distribution table. Look at here. First observe this table. First column, realization steps, one by one we write. Second column, realized amount we write. Third column, first amount due to spouse of a partner. Second, interest due to loan on partner. Third, partner's capital. Third preference, total. First look at who are the partners, A, B, C. First write down amounts due. How much amount we have to pay interest to spouse of a partner? 2000. Loan on interest, partners loan, interest on partners loan 1000. A, B, C. These are the total amounts we have to pay. What is the total amount we have? 24,000. This much of amount we have to repay. Okay. What is the first realization? 1000 is the first realization. 1000 to whom we pay? First we pay interest on loan from spouse of a partner. This 1000 rupees is paid. Sale of investments. How much amount received? 1000. This 1000 first I am paying to interest on loan taken from spouse of a partner. Okay. After payment of 1000, tell me the remaining balances. 1000 rupees still payable. Here 1000 rupees still payable. Second realization is what? Second realization furniture. How much realized furniture? 2000. Out of this 2000, first pay amount to partners loan from partner spouse. After that, loan from partner. Observe, all outside liabilities are repaid. Now only the amount pending to A, B, C. How much payable? 9600, 6000 and 8400. And what is the third realization? Tell me. Third realization machinery. How much amount we have here? 1200. But what is the amount due to all partners? 9600 plus 6000 plus 8400. Total amount is 24,000 payable to partners. But how much amount you have? 1200. What is the deficiency here? 22,800. 22,800 is the deficiency. Now this deficiency is shared among A, B, C in 5:3:2 ratio. That is what we have to do now. Look at sale of machinery. How much amount we received? 1200. What is the maximum loss? Tell me now. 22,800. How we arrived this maximum loss 22,800? Amount due to all partners 24,000 minus 1200 available cash. Maximum loss 22,800. And this maximum loss is distributed to all partners in their profit sharing ratio 5:3:2. How much we are getting? Tell me. 11,400, 6,840, 4,560. Total 22,800. Next, here amount. See, amount in the bracket in the sense this particular partner should bring that amount. This particular partner should bring that amount. Look at what is the amount due to A? 9,600. But here we have distributed loss. How much loss we have distributed? 11,400. Means actually, if this is the final payment, A has to bring 1800 rupees to the firm. To B we have to pay 6,000, but amount due from him, sorry, amount of loss distributed 6,840. If this is the final settlement, he has to bring 840 to the firm. If he brings 1800 and 840, then we repay amount to C. Observe, to C we have to pay 8,400. Last distribution 4,560. How much amount payable to C? 3,840. How much amount payable to C? 3,840. But how much cash we have? 1,200. We need more. How much? 2,640. Who has to bring this 2,640? 1,800 by A, 840 by B. But you people tell me, will they bring this amount? No, sir. Now what we have to do? Redistribute this 1,800 and 840 to C over. See, deficiency. Deficiency of A and B written off against C. Look at 1,800, 840, total 2,640. Deduct. A account shows 0 balance now, B account shows 0 balance, and C account shows 1,200 balance. C account shows 1,200 balance. Now whatever the 1,200 we have, pay that 1,200 to C first. Pay that 1,200 to C. Over. Next one. Balance in capital accounts. After payment of 1,200, how much capital account, how much amount showing capitals? A 9,600, B 6,000 as usual. C, to see how much amount we have to pay actually 8,400 minus how much amount paid 1,200, remaining amount payable 7,200. Is it clear, students? Yes. Now last asset realized 400, sorry 4,000. But what is the amount payable to partners total? What is the amount payable to partners total? 22,800. 22,800. But how much is the available cash? 4,000 is the available cash. 22,800 minus, just a minute, 22,800 minus 4,000. 18,800 becomes 18,800 becomes maximum loss, and this 18,800 is distributed among partners in their 5:3:2 ratio. Distribute 9,400, 5,640, 3,760. Deduct. What is the meaning of this? Amount due to A 9,600, loss distributed 9,400, still the business has to pay 200. Next, B, amount due to B 6,000, amount distributed 5,640, loss distributed, remaining amount 360. Next, amount due to C 7,200, loss distributed 3,760, remaining amount 3,440. Now, finally, to all partners ABC, we pay 4,000 rupees. How? 200, 360, 3,440. Ultimate loss should be borne by all partners. How much? 9,400. How do we get it? 9,600 minus 200, we get 9,400. 6,000 minus 360 paid, remaining balance we get 5,640. 7,200 payable to C, paid 3,440, not able to pay 3,760. These are the final loss borne by remaining partners. This is the distribution table. This is how we have to prepare the distribution table. Clear, everybody? This is maximum loss. I repeat, we may expect this piecemeal distribution in the exam. Don't forget. Next one. After that, highest relative capital method. Highest relative capital method. Now, before distribution of amount, see that if partners' capitals are in proportion to their profit sharing ratio, I repeat, where is the problem coming? Where is the problem coming? So, the problem comes at the time of distribution of amount to partners, sir. Okay. The problem comes how the amount, the available amount is distributed to partners, sir. Super. Do one thing. Check amount due to partners. If the amount due to partners is in relation to or in proportion to their profit sharing ratio, then distribute the available cash in profit sharing ratio. Suppose if the amount due to partners is not in proportion to their capital ratio, then follow this method, highest relative capital method. In the problem they specify. Here what are the steps we have to follow? Instead of discussing all these steps orally, let us take one example so that you can understand. Na? So here I am taking highest relative capital method. One problem I am taking, very, very important. Look at. Easy but important. Here writing part is more. And do remember, under piecemeal payments, you are not going to prepare any single ledger account. I repeat, under piecemeal payments, you are not going to prepare any single ledger account. Only thing you are going to prepare statement, distribution table. A partnership firm was dissolved on 30th June 2022. Fine. Its balance sheet on the date of dissolution was as follows. Look at the balance sheet. These are the capital account balances. And loan account, B loan account, 10,000, sundry creditors 30,000. First, to whom the amount is paid, sundry creditors 30,000. Second, to whom the amount is paid, loan to B 10,000. After that, we start repaying amount due to partners. Now, cash balance we have 10,800 and sundry data, sundry assets we have 1,89,200. First, we have 10,800. Now, this amount we distribute to creditors. First, we have 10,800. Give the amount to creditors. But before distribution of this 10,800, the liquidator or the person who is responsible for this dissolution process, he will keep some amount of money for realization expenses. I repeat, out of this 10,800, the person who is responsible for this dissolution process, he will keep some amount for realization expenses. He has that right. And the remaining amount is distributed. Okay, now look at it. The assets were realized in installments. We know assets realized in installments, and the payments were made on the proportionate capital basis. Proportionate capital basis means highest relative capital method. Creditors were paid 29,000 in full settlement of their account. Sir, we received 1,000 discount, na sir. No, no need to worry. You pay 29,000 over. Expenses of realization were estimated to be 5,400, but actual amount spent was 4,000. Now you people tell me, out of the first amount of 10,800, what the official liquidator he will do? He will keep 5,400 rupees aside, and he will start distributing the remaining amount 5,400. So he kept 5,400 na. Yes sir. But if we see the actual amount of expense, the actual amount of expense is 4,000. The actual amount of expense is 4,000, and this amount was paid on 15th September. Means we have minimized the expense of 1,400 na, by 1,400. Yes, at the final settlement, or at the final realization amount or installment amount, we add more 1,500 rupees, sorry, 1,400 rupees, and we distribute amount to partners. Drop a statement showing distribution of cash which was realized as follows. Here sundry assets total 1,89,200. How the sundry assets realized? Look at, on 5th July 2022, 25,200 realized. On 30th August 2022, 60,000 realized. On 15th September 2022, 80,000 realized. On the date of realization, how do you distribute this amount and to whom this amount is distributed? That you need to identify. Okay sir, fine. The partners shared profits and losses in the ratio of 2 to 1. Okay. Prepare a statement showing distribution of cash amongst the partners by highest relative capital method. Fine sir. Prepare a statement like this. First, statement showing distribution of cash. First, write down order of payments. First, we have to pay amount to creditors. Next, we have to pay amount to B's loan. After that, A, B, C. Write down amounts due first. 30th June, what is the amount due? 30,000, 10,000, 76,000, 48,000 and 36,000. After that, at present, how much balance you have? Sir, I have 10,800, sir. From 10,800, you keep 5,400 for expenses, and remaining 5,400, first you give it to creditors, sir. Yes, sir, I am doing the same. Cash balance less provision for expenses, 5,400 I distributed. After distribution of 5,400, how much balance left? 30,000 minus 5,400, 24,600. B's loan as it is 10,000, A, B, C capitals as it is. Next, on 5th July, how much amount realized? 25,200. First, pay amount to creditors. What is the amount due to creditors? 24,600. Whereas 1,000 rupees they allow discount na. So how much amount we pay? 23,600. We have extra 1,600 rupees, and next pass this amount to B's loan, 1,600. After repayment of this 25,200, what is the remaining amount left? Discount received 1,000, and this discount we transfer to realization account. Finally, now remaining amount left, to B we have to pay 8,400, C 76, B sorry A 76, B 48 and C 36,000. Now come to second realization. Second realization 60,000. Okay, out of 60,000, first pay 8,400 to B's loan. Okay sir, I have paid 8,400 to B's loan. What is the amount left? Sir, 51,600 amount left, sir. 51,600 amount left, sir. Okay, good. Now, next priority, this 51,600 I have to distribute to all partners. Okay, but how much amount payable to partners? Tell me. 76,000 plus 48,000 plus 36,000. Total amount payable 1,60,000, sir. But I have 51,600, sir. Okay, what's the remaining amount payable? 1,08,400, sir. If it is the maximum loss method, we distribute 1,08,400 to partners. If it is the maximum loss method, then we distribute 1,08,400 to partners. But it is not maximum loss method. It is highest relative capital method. Means out of 3 partners, whose capital is more in proportion to their profit sharing ratio. Now we have to calculate. For this, go to a working note. Highest relative capital, working note. This working is very, very important. First, what we have to do? First, write down the present capitals. It is a sequential step, students. Sequence of steps. Follow these steps as it is. First, sir, present capital is how much? Present capital 76, 48, 36. Okay. Present profit sharing ratio how much? Sir, 2 to 1. Okay. Divide. Calculate per unit profit share. Capital per unit of profit share means 76,000 is the total capital, divided by profit share is 2, means we get 38,000. B, 48,000 is the capital, profit share 2 divided by 2, 24,000. C, 36,000 divided by 1, 36,000. And this is called capital per unit of profit share. Capital per unit of profit share. Okay. We have calculated capital per unit of profit share. Out of them, identify least capital per unit of profit share. Sir, least one is 24,000, sir. 24,000. Now multiply 24,000 with the profit share. Multiply 24,000 with the profit share. 24,000 into 2, 48,000. 24,000 into 2, 48,000. 24,000 into 1, 24,000. Means, actually if we see, the capitals must be like this. Capitals must be like this, 48,000, 48,000, 24,000 in proportion to their profit share. That is the fourth point. Proportionate capitals taking B whose capital is at least as the basis. Okay, fourth point. Now calculate excess capital. Actual capital must be 48,000. Just a minute. 48,000, 48,000 and 24,000. But originally how much capitals are there? 76, 84, 36. Calculate the difference. 76 minus 38, 24. 48 minus 48, 0. 36 minus 24, 12,000. Means here we have excess capitals of A and C. A and C. Now the question comes. Among A and C, to whom the amount is payable first? Among A, B, C, to whom the amount is payable first? To A and B. Sorry, A and C. Okay, for two people we have to pay amount. Now, among A and C, to whom the amount is payable? Among A and C, to whom the amount is payable? To know to whom the amount is payable, first among A and C, follow the procedure from third step once again. Follow the same procedure which we have followed in case of third step. What is that? Profit sharing ratio to 1. Profit sharing ratio to 1. This time exclude A. Calculate capital per unit of profit share. Calculate capital per unit of profit share again. 5 by 6. 24,000 divided by 2, 14,000. 12,000 divided by 1, 12,000. Again take least capital per unit per share. Least capital per unit per share. 12,000, sir. 12,000, sir. Multiply 12,000 with the profit share. 12,000 into 2, 24,000. 12,000 into 1, 12,000. Now tell me the difference of, here they have given steps, students. You have to follow these steps. No other alternative. No other alternative. Okay. What is the earlier amount payable? Excess amount 24,000. 28,000, sir. Earlier amount is payable 28,000. Now it is 24,000, sir. How much is excess capital? 4,000, sir. Now tell me, among A, B, C, first we have to pay amount to A and C. Among A and C, first to whom the amount is payable? To A. How much amount we pay first? 4,000. 4,000 is excess. 4,000. Next we pay 24,000 and 12,000 to A and C. Total excess capital is how much? 28,000. Out of 28,000, first we have to pay 4,000 and remaining 24,000 is payable. Now how much excess capital of C? 12,000. 12,000 pay later. After payment of this 28,000 and 12,000 to A and C, whatever the remaining amount available with us, that is paid to all partners A, B, C according to 2 is to 2 is to 1 ratio. Why? Now here we set, in step 4, we set the partners capital according to their profit sharing ratio, 48,000, 48,000 and 24,000. Till the repayment of this 28,000 and 12,000, first we have to pay amount to A and C. After repayment of this 28,000 and 12,000, we start repaying amount to remaining partners A, B, C in 2 to 1 ratio. This is the procedure we have to follow. Based on that, look at the distribution sequence. First 4,000. Total amount is payable to A. Next 36,000. How, sir? 24,000 plus 12,000, 36,000. Next 36,000 is paid according to 2 is to 0 is to 1. Means 0 means no need to pay any amount to B. 36,000 is paid according to 2 is to 1 ratio, 24,000, 12,000. And over 40,000 means 28,000 to A, 12,000 to B, total 40,000. After making payment of 40,000 to A and C, whatever the remaining amount we have, that is distributed to all partners in 2 is to 1. Okay, next. Now distribution of second installment. What is the second installment? Second installment amount we have 51,600. Total second installment we have 60,000. Out of that, first we have paid 8,400 to partners loan. Okay, first 8,400 we have paid to partners, sorry, creditors. Not creditors actually, B's loan. B is not B's loan. Here you can write B's loan. First 8,400 paid to B's loan. Next 4,000 paid to A. Next 36,000 paid to A and B, 24,000 plus 12,000. Out of 60,000, after making payment of these things, what is the remaining amount left? 11,600, and this 11,600 is paid in 2 is to 1 ratio. Finally, how much amount is paid to A? 32,640 total. B 4,640. C 14,320. The same amounts are substituted here. The same amounts are substituted here. Look at here. 8,400, 32,640, 4,640, 14,320. What is the balance left? B's loan cleared. B's loan cleared. A, how much amount is payable? 76,000 minus 32,640, we get 43,360. 48,000 minus 4,640, we get 43,360. 36,000 is the amount payable to C. Now we are paying 14,320, amount due 21,680. Now last realization how much? 80,000. Now this 80,000 is paid to A, B and C in 2 to 1 ratio. 2 to 1 ratio. Look at how much amount realized? 80,000. How much amount saved in expenses? 1,400. Total how much amount we have now? 81,400. This amount is distributed to A, B, C in 2 to 1 ratio. 32,560, 32,560, 16,280. Finally, whatever the amounts left, that becomes loss for partners. This much of loss they have to bear. After preparing this statement, now the accountant, by looking this statement, accountant will record the entries. I repeat, by looking this statement, the accountant start recording entries. This statement is prepared by the official liquidator, accountant is different, official liquidator is different. After taking this statement from the official liquidator, we start recording the entries in the books of accounts. Is it clear, students? Yes, this is our highest relative capital method. Highest relative capital method. Don't neglect this method, maximum loss method and highest relative capital method. You will get either one. We are expecting based on previous 3 attempts, right? This is our whole partnership accounts, students. With this, I am stopping the live session now. I thought to complete company accounts also, but due to time constraint, I was unable to complete company accounts, right? So company accounts you try to prepare, but if you have any doubts in company accounts, tomorrow morning session from 8 o'clock to 12 o'clock, from 8 o'clock to 12 o'clock I am available. You can, whatever the doubts you have in accounting subject, you can send your queries to my number 9573778943. You can send telegram, to this number. I will quickly respond to your query. Is it clear? So this much support I can give you tomorrow morning from 8 o'clock to 12 o'clock. So I will wait for your doubts. I am ready to clarify between 8 to 12. And tomorrow evening we meet again with question paper analysis. If possible, live session or else recorded session. But by tomorrow 7 o'clock or 8 o'clock, I will post question paper analysis. So all the best, students, for your tomorrow's exam. Do remember one thing, to the extent possible, try to solve and come. I repeat, to the extent possible, try to solve and come. Believe me, suppose the question paper is 100% tough, sir. The total question paper is for 125 marks, including internal choice. But you have to attempt it for 100 marks. Suppose total question paper is difficult, sir. Yes, even though you have a scope to get minimum 40 to 50 marks, don't leave even single question. Don't leave even single question. Do remember, try to do the problem as much as possible with the process. I have completed final accounts of in for part 1. Marathon part 1 is there. There we have discussed category A chapters. In these live sessions, we have completed final accounts, NPO, incomplete records, and this partnership accounts. Now I have discussed a strategy how to solve the problems. Follow the process. To the extent possible, you can complete the answer. Forget about the final answer. If you do the process correctly, if you write the amounts or if you write the items and amounts in the appropriate place, automatically you get the final answer correct. If you will not get any final answer, suppose if you don't get any final answer correct, even though ignore, but you get stepwise marking now. That is the advantage of this accounts paper. So tomorrow, share your question paper. How did you write your question paper in the comment section? Tomorrow we post question paper analysis. That's it, students. So all the very best for your tomorrow's exam. Tomorrow is the first exam, and first exam must be best exam. Is it clear? So all the best, my dear students. We meet again tomorrow. Till then, bye bye. Good night, everybody.